So let's start our chapter number 3 part 2 today. I hope you have done with the chapter number 3 part 1. So in chapter number 3 part 2 we are going to see various alterations in your memorandum and articles of association. In the previous chapter we have learnt what are the clauses in the memorandum, what is articles of association, what are the various doctrines. So let's revise what are the clauses in the memorandum. First we have a name clause, then registered office clause, then object clause, liability clause, capital clause, and the last one was subscription clause. So except of this subscription clause, all other clauses can be changed, can be altered. So this is what we are going to learn under this particular chapter. What are the ways, what is the procedure to alter all the clauses of your memorandum and all the clauses of your articles of association. Okay, so let's start with the alteration of memorandum. Now for alteration of memorandum, we have a section number 13. So section number 13 talks about procedure how to alter the memorandum of association. So we are going to see the basic of how to alter your MOA. The very first thing, okay, we have to understand that when we have a company, okay, all the decisions will be taken in a board meeting. So the very first step comes in the procedure is call board meeting. We have to call a board meeting because all of the directors, they will not know that you are having a board meeting. So you have to give notice of the board meeting that on so and so date this company will be holding its board meeting. You have to mention the time, the agenda, everything in that. Okay, so we have to call board meeting by giving 7 days advance notice. How many days advance notice? 7 days advance notice. Now where it is given? Remember, listen to this very carefully. When we talk about the board meeting or when we talk about the general meeting, okay, in both of this, we not only have to follow your Companies Act 2013, but also you have to see the secretarial standards for this. What do you have to see? Secretarial standards. Now you might be hearing this word for the first time. Secretarial standards are standard issued by our ICSI, Institute of Company Secretaries of India. Okay, so like Chartered Accountant Institute, that is Institute of Chartered Accountants, they issue the accounting standards. On the same lines, ICSI issues a secretarial standards. Okay, so secretarial standards have to be as per the Companies Act 2013. Now you will ask, ma'am, why is it required to have the secretarial standards? We already have the Companies Act. It is required to have a secretarial standards for the extra compliances. We are the compliance officer, so always we will be responsible for the corporate governance, and our ICSI wants their members to do the best corporate governance. So ICSI issues various secretarial standards. Okay, till now it has issued 4 secretarial standards, but only 2 are mandatory. That is SS1. Secretarial standards 1 is for the board meetings, okay, and SS2 is for the general meetings. SS1 is for the board meeting and SS2 is for general meeting. So whenever we are doing board meeting, whenever we are doing general meeting, we have to read secretarial standards along with the Companies Act 2013. So I hope it was very clear. So when we are calling a board meeting, the first thing we need to do is we need to give 7 days advance notice to all the directors of the company at their registered address. You can even send the email if directors have consented to it. Now on the fixed date, what do you have to do? We have to hold a board meeting. hold a board meeting on the fixed date. Now you have to be very much conversant about BM, BR, GM, SR. BM stands for board meeting, GM stands for general meeting, SR stands for special resolution. But very important, we are not going to write the shortcuts in our exam. In exam we are going to write full forms only, but yes, for making short notes we can do that. Okay, so we are going to hold a board meeting. In that we are going to pass various board resolutions. Okay, what are we going to pass? We are going to pass various board resolutions. Now for what purpose we are going to pass a board resolutions? The first board resolution will be passing will be proposal for alteration of memorandum. Okay, so first of all we have to present the proposal for alteration of memorandum before your board of directors, because first board of directors will approve, only after that you can go to the shareholders. Okay, so once this resolution is passed, the second thing, for altering your memorandum of association, this is a basic procedure. Okay, we have to take the shareholders consent also. So that's why second one, we have to pass a resolution for fixing day, date, time and venue of the general meeting of the members. What we need to fix? Day, date, time, venue of the general meeting where we are going to call the shareholders for taking the approval. The next, we have to give notice to the shareholders also. Yes, even that notice has to be approved by board. Okay, so resolution for approval of general meeting notice. For general meeting notice, along with the notice we have to also attach an explanatory statement. Explanatory statement. These are the two things very important: notice and explanatory statement. We have to explain the shareholders of the company, saying that why are you altering your memorandum. So you have to give them reasons for alteration of memorandum. So you have to explain them so that shareholders can very nicely go through that. Okay, so first board resolution we passed for alteration of memorandum. Second, for fixing day, date, time, venue of the general meeting. Why are we writing only general meeting? Because the general meeting can be the AGM or the EGM, that we need not mention. Okay, third one, we have to approve the notice and the explanatory statement which we need to give to the shareholders. And fourth one, we have to pass a authority resolution. Okay, board resolution for giving authority to a company secretary. If you have one in your company, where you don't have a company secretary, any director. Okay, authority to company secretary or any director for giving effect to the event. That means in order to alter the memorandum, they need to make various notice, agenda, explanatory statement, give it to the shareholders, book the venue for the meeting, okay, call the shareholders meeting, then you have to file various forms with ROC. So company has to give authority to either a CS or a director for doing all these things. So this is a resolution of authority. Okay, so in the second step, what did we do? Just revise it. We passed various board resolution. See guys, at the end of this particular chapter, you will be very much conversant to write the procedure, because first 4 to 5 points are very easy and very repetitive in nature. Okay, so what is the first point? Always call board meeting by giving 7 days notice. Second one, hold board meeting and pass 4 resolution. 1, proposal for the event, that is change. Second, fixing day, date, time, place for the general meeting. Third one, approval of notice and explanatory statement, and the fourth one was authority. Okay. Now we will proceed to the next step. The third one. Now the third step is, once everything is ready, notices and all, we have to issue notice of general meeting. Okay, this notice of general meeting has to be issued of at least 21 clear days notice. Now what is the meaning of this 21 clear days? 21 clear days notice means the day of meeting, listen to this very carefully, the day of meeting and the day of dispatch, the day of meeting and the day of dispatch, this both we have to exclude. Okay, so suppose our meeting is on 30th September, we are going to exclude 30th September and count 21 days. Suppose we are giving notice on 1st of September, we have to exclude 1st of September and give the notice. Understood? So these 2 days are excluded. After that, if you are dispatching by post or you are sending by courier, okay, so you have to exclude the days in transit also. How much? You have to exclude 2 days in transit. How much you have to exclude? 2 days in transit. So total, what we are doing, we are excluding 4 days. 4 days are excluded. Understood? So in short, we are giving 25 days notice. But what does the law say? 21 clear days notice is to be given. I hope this is clear. Okay. After that, the next point, we will be giving notices, that is general meeting notices. Whom do we give the notices? Only shareholders? No. These notices are to be given to the directors also, to the company secretary also, because it is duty of all of them to attend the meeting, right? What will shareholders do alone? Okay, that's why it is our duty to give notice to the shareholders at their registered address, directors of the company, company secretaries, statutory auditors, and any other person who can attend the meeting. You can give them notices. Okay, but will you give it to the preference shareholders? Will you give it to the debenture holders? The answer is no. Okay, in general meeting they are not allowed to vote, not allowed to attend. So this was our third point. Now on the date we have to hold the general meeting, and in this general meeting, for alteration of memorandum, we have to pass a special resolution. Which resolution are we going to pass? Pass special resolution. What do we mean by special resolution? 3 times votes. Correct? So if 100 people are there, minimum 75% votes we require, then only we can say your memorandum is altered. Okay, so in general meeting we'll be passing a special resolution. Once we pass a special resolution, okay, we have to file that change, alteration of memorandum with the ROC. Okay, so which form are we going to file? The form name is MGT 14. Okay, so remember this very carefully. Whenever we will pass special resolution in all the events, not only for change of memorandum but for all the events, always we have to file MGT 14. So we have to file MGT 14 with ROC within 30 days of passing special resolution. So within 30 days of passing special resolution, we have to file MGT 14 with whom? With our registrar of companies. I hope it is clear. Right? Understood? So special resolution form MGT 14. Always remember this. Then we have to make necessary changes. Wherever the changes are there, we have to make necessary changes. So once your memorandum is altered, we have to make sure whenever you are issuing copies of memorandum to anybody, you have to issue only the altered one, that is the new one. By mistake, if you give the old copy to anyone, it would lead to a penalty of 1000 rupees per copy. Okay, we'll be discussing that in the last session of this. So as of now, you have understood what is a procedure for alteration of memorandum. First, we called the board meeting by giving 7 days notice. Okay, then we held the board meeting, we passed the various resolutions in that. Then we issued a notice of general meeting, that is 21 clear days notice, and that we excluded 4 days. Then we held general meeting and passed a special resolution for alteration of memorandum. So for altering all clause of memorandum, do we require a special resolution? No. For alteration of 4 clauses, we require a special resolution, that is name clause, okay, registered office clause, then object clause and liability clause. For your capital clause, that is if you want to increase the share capital, only for increasing in share capital we require ordinary resolution. Clear with this? We will come to that slow by slow. Okay, but as of now you remember, we have to do all these steps if you want to alter the memorandum of association. Last but very important, whenever we will be passing a special resolution, which form are we going to attach with the ROC MGT 14. Now let's start with our first procedure to alter the memorandum of association of your company. Okay, so for example, any company, okay, called as Zerodha Private Limited. Now this company wants to change its name. Now why will any company wants to change its name? Many reasons are there. Very funny reason I can tell you. The company is not running well. So promoters of the company, they approach the Jyotishi, okay, the Baba, you call it any language, and he tells you to change the name. Start from this letter, the company will make profits, it will grow up like anything. One of the reason. Very funny reason, as I told you. Second reason I can give you, company is changing its business. So when company is changing its business, it had to change the name also. Why? Because company's business and name should be similar. Okay. So company's business and name should be similar. So company is changing its business. So this may be one of the reason to change the name of a company. Okay. So right now we are not going to indulge into what are the reasons for change name. Okay, but we are going to learn what is the procedure to change the name of a company. Okay, so let's begin. Very first step, you know it, right? We are going to call a board meeting over here. Why are we calling a board meeting? Because first proposal of name change will be passed in the board meeting. Only after that we can go for the name reservation, right? Yes. So how do we call the board meeting? By giving 7 days advance notice. This is as per your secretarial standards, right? Second one. After that, we'll be holding the board meeting. So, hold a board meeting, and in this now we are going to pass various resolutions. So, first resolution, proposal for change of name. Okay, board of directors have to decide which name they want to apply with the ROC. Okay, then we have to call the general meeting, and in that we have to pass a special resolution for name change. So we have to fix day, date, time and venue of the general meeting. Third one, we have to approve notice and explanatory statement of general meeting. And the fourth one, we are going to authorize now. Authorize director or a company secretary to give effect to this transactions. Okay, these are the basic two rules we wrote. After that, now we are going to the third one. Once name is approved by board of directors, we have to reserve that with the ROC also, because we have to ask ROC whether this name is available or not, right? You remember this in the previous chapter we have discussed. When an existing company wants to change the name, okay, which form is it going to use? Very good, the answer is there, run application, right? Apply for reservation of name. Okay, in which form? Under run application. In the run application we have to do it. Okay, now over here we have to attach certain documents to the run application. So which documents are we going to attach? These are the attachments. Okay, first one, board resolution, that board of directors approve this particular name to be used by the company. So we have to attach a board resolution. After that, if you are using some existing company's name, then you remember I had told you have to attach the NOC also. NOC from existing company. Okay, when is this applicable? In case using similar name, right? So these are the attachments to the run application. Your run application does not require any digital signature. Why? It's a web form. Yes, obviously we have to pay the fees for that. Okay, so now we have applied to the ROC. This run application we are going to file with our ROC. Okay, so now we have to wait and watch. So the fourth step we have, we'll assume that ROC has approved our name. So once ROC approves our name, okay, it is valid for 60 days. What is the validity? 60 days validity. Now why 60 days validity we have over here? Because over here for changing the name of the company we require central government approval, and for taking central government approval we require number of days. That's why 60 days time is given to complete all the documentation. Okay, now the fifth step. Now we are going to issue notice of general meeting. Okay, this will be 21 clear days notice. This point is also clear. Sixth, now on the fixed day we are going to hold a general meeting, and in this general meeting we are going to pass a special resolution. Which resolution are we going to pass? Special resolution. Okay, so in general meeting we have to pass a special resolution, but when we are passing the special resolution, in bracket or in the resolution we have to mention that we have to take the central government approval also for this. So even though shareholders have approved the name change, but if central government does not approve, then also we cannot do the name change. So what are we going to write over here? Subject to CG approval. Okay, what are we writing? Subject to CG approval. Now next one, seventh one. Okay. Once we pass a special resolution, which form are we going to file? Tell me. File form MGT 14 with ROC. Okay. We have to file MGT 14 with ROC. When are we going to file MGT 14 with the ROC? Within 30 days of special resolution. So within 30 days of passing special resolution, we are going to file MGT 14 with the ROC. Okay. Now over here there is one more concept of a shorter notice. Okay. So instead of giving 21 clear days notice, shareholders may be given shorter notice. But this provision you will be learning in your Companies Act, so I am not covering it over here. Right. So now we are going to apply to the central government. So which form is there for application? Apply in form INC 24. Please remember the name of the form, guys. INC 24 is a form for application to CG for permission to alter the name of the company. Okay. This is application to your central government for approval of name. Okay. And now this form, okay, we have to file within 30 days. To be filed within 30 days of special resolution. So we have to file two forms over here within 30 days. One is MGT 14 and another one is INC 20. Now there are certain attachments to this form. What all attachments are we going to do? We cannot give blank form to the central government any proof, right? So first one, we require a notice of general meeting. We need to attach. Then certified true copy. Okay. CTC. Now we are going to write it as a CTC. Please remember, certified true copy means the resolution will be signed by the two directors along with the company stamp. That is a CTC. Okay, so CTC of special resolution along with the explanatory statement. CTC of the special resolution along with the explanatory statement. After that, we require altered memorandum and articles, altered AOA and altered MOA. And the last one, minutes of the general meeting. So these are the four attachments of your INC 24. INC 24 we filed with the central government for permission for approval of the name change. Okay. Now, this was which point? 8th point it was. Now we are going to the 9th point. Once name approval permission is given. Once name approval permission is given. Okay. Then, you know how they will give us name approval permission? They will grant us order. Central government shall grant us approval order. Okay. Now, do you think from this day our name has been changed? The answer is no. Once we receive approval order, no name change. It does not amount to name change once we receive the approval order. Why? Because just central government has given a permission to change the name of the company. Still, we cannot change without giving this order to the ROC, because ROC is our ultimate regulator. So we need to intimate this to the ROC saying that we have received confirmation from central government that we can change the name now. Okay, so if you stop the process over here, it will have no effect, because ROC can only change the name on the ROC portal. So if you don't file this central government order with the ROC, then it's of no use. Hence, this order of ROC has to be filed with the ROC. So we have to file approval order of central government with ROC. Okay, in which form are we going to file? In form INC 28. Okay, so in form INC 28 we are going to file central government order. Okay, so if ROC is satisfied with this form, ROC will not again give us approval whether we can change the name or not. No, the approval authority for name change is the central government. It will just verify the important points in INC 28. If we have filed everything in INC 28, ROC is not going to object that. Okay, so ROC shall issue a new certificate of incorporation. What it will issue? A new COI. Why are we going to receive a new COI? Because we have changed the name. Okay, that's why we require a new COI. So when we are altering the name clause of memorandum, we receive a new COI. Okay, so ROC shall issue us a new certificate of incorporation. Now listen to this very carefully. Whatever date is mentioned in this COI, that will be effective date of the name change. Okay, so that is your effective date of the name change. So your name change is valid from the date mentioned by ROC in the COI. Clear? And not from the central government order. Okay, after this, now we have to make necessary changes at all the places, right? Where we have to make necessary changes, we have to alter all our memorandum, articles, all our letterheads. Okay, we have to intimate all the authorities also, income tax, wherever, with whoever authority we have taken some license or opened a bank account, we have to intimate that our name has been changed, right? And very important, we have to change our nameplate also, company's nameplate. Okay, so how do we write? At every places we are going to write these two names together for how many years? 2 years. Okay, so suppose Zerodha Private Limited change its name to 5 Paisa Private Limited. Okay, so our new name is 5 Paisa Private Limited, and in bracket we will be writing earlier known as Zerodha Private Limited. Correct? So this you have to write for how many years? This we have already discussed, for 2 years from name change. I hope everybody has understood the procedure to change the name. And with this, the highlighting point was form number INC 24, which we filed with the central government for the name change. Very clear with this? Understood? Now, when you are a listed company, okay, now when you are a listed company, you have to do certain additional formalities. Now, what is the additional compliances we need to do? We are going to see that. Additional compliances, it is only for a listed company, only listed company, because listed company has to comply with the 2 laws, right? One is your Companies Act 2013 and the second one is LODR, that is listing obligation regulations and delisting. That is your LOTR. Okay, so this two they have to comply. So now your listed company has complied with Companies Act 2013. It is not enough. They have to comply with both of this. So we have seen procedure under Companies Act 2013. So what are the additional things you need to do when you are a listed company? We are going to see that. So for name change, we have LODR regulation number 45. Which regulation we have? Regulation number 45. So what is the first compliance under that? It says that gap between two name changes cannot be less than 1 year. Okay. So minimum gap required between two name change. Okay. That is 1 year. What is requirement? We require at least 1 year gap between two name changes. So listed company cannot change its name frequently. It has to wait at least for a year once it has done name change. Okay. Now the second one. Don't ignore just because it's for a listed company. They may ask you in the paper. What are the additional compliances under regulation 45? So you should know this compliances. Okay. So now second one. Wherever a listed company is changing name because of its business, because it is starting a new business. Okay, so it has to comply with any one criteria. Now what is that first criteria? The first criteria says that at least 50% of the revenue should have come from a new venture. Okay, at least 50% of revenue should have come from the new venture. Suppose total profit is 100 rupees. 50 rupees came from the new business which you have started. So now you can change the name, no problem. Now this depends on your last year's balance sheet. You also have to write that as per last audited balance sheet. As per last audited balance sheet. Or the second provision says that suppose you have not started with the business till now, but you are into the process of that. Still you are doing construction or purchasing the machineries, etc. for that. So if first provision is not complied, at least you have to comply the second one. What does the second one says? Company has invested at least 50% of its assets in new venture. Okay, so since you have not started with the generating revenue in the new business, but you have at least invested 50% of your assets, okay, in that. So you're confident enough you are going to continue with the new business for at least 4 to 5 years. So then in that case you can change the name. So any one of this has to be complied with, hence the conjunction I am writing is or. Clear with this? Understood? Okay. Now one more additional compliances, that is the third one. After name change, once you do the name change, what is the requirement we have to do? We have to write the old name, new name for a period of 2 years, right? This is as per the company law. But your regulation 45 tells you that new name along with the old name. Okay, this both you have to display on the website also. Display on the website of the company. Okay, so along with you writing in letterhead and all the memorandum articles everywhere, you have to display on the website of the company that This is a new name, that is 5 Paisa Private Limited, earlier known as Zerodha Private Limited. This you have to do it for at least 1 year. At least 1 year from a name change. Clear? Everybody understood this? Any doubts still here? Sure. Okay, so this was a procedure. If anybody wants to change the name of the company, procedure is very important. They can ask you in the form of case law that a particular company change its name. So as a company secretary, please check whether all compliances are done or not. So in this you have to remember the form number, very important, whose approval we require. Okay guys, so please go through this. You can take the screenshots. I prefer you should write. Writing practice is just amazing. You will not notice change now, but within 15 days you will notice change in yourself. Okay, because when you write, you're slowly, steadily memorizing the things. Okay, so please go through. If you have missed anything, you can just rewind, you can just pause the video and write it, no problem at all. Okay. So that's it for the change of name of the company. Now let's start with the alteration of object clause of the company. Okay. Now object clause means what? It is business clause, right? This is a clause where company writes the nature of its business. Okay, what type of business it is carrying on. So now when any company wants to alter its business or change its business from retail to manufacturing or from banking to non-banking, it wants to do anytime, company can change the business, no problem at all, but they have to follow some procedure. Okay, so when company wants to switch the business, in that case they have to alter the object clause of the memorandum. So there is some procedure for change of object clause. Before going to the procedure for change of object clause, very important thing we are going to discuss. Now whenever any company, okay, it has raised capital from public, it has raised capital from the public. How it has raised capital from the public? Through prospectus, by issuing prospectus. Prospectus is a legal document which is issued by the company in case company wants to do initial public offer or a further public offer. Okay, so in that case it will be issuing a prospectus. So when any company has raised capital from public, by issuing prospectus they have to follow one procedure before they change the business. Okay, so what all things this company need to take care? Now let's understand this with the help of an example. There is a company called as Zucon Limited. This Zucon Limited had raised 400 crores from public, okay, for doing retail business. What business it was doing? It was a retail business. Now out of this 400 crores, still 50 crores are unutilized. Okay, this 50 crore is unutilized. Unutilized means still it is there in the company's reserves, company has not used that in the business. So now company wants to change the business. What company wants to do? It wants to change the business and it wants to do the pharmaceutical business now. It wants to become a pharmaceutical industry now. So from a retail, it is going to a pharmaceutical. And this 50 crore now, do you think company will be allowed to put into the pharmaceutical? No. Why? Because public has given them money for doing a retail business and not a pharmaceutical business. Okay, so when company has raised funds from public by issuing prospectus and there is some unutilized money, okay, company directly cannot change its business. First, company has to follow some procedure. Now, what is the procedure company needs to follow? Let's check out in case there is some unutilized money. The very first thing they need to do is take approval of existing shareholders. Okay, this approval, it is not for change of business. It is just a approval that we are having this much unutilized money. Okay, so for this approval, we need to issue notice to the shareholders. In this notice, we are going to give all the details about the new business, also about unutilized money. Okay, how are you going to use that? Use of such money. Okay, so all the detail will be given to the existing shareholders that we are having 50 crore rupees which we had obtained from you from a retail business. Now we want to put that money into a pharmaceutical. So please give us approval. So this approval is not for the change of business. It is for permission that shareholders will allow them to put this 50 crore into a new business. Clear with this? So this approval has to be taken through postal ballot. How you have to give this? You have to take through postal ballot. In company law, you will be learning there are various types of voting. One is by show of hands, poll. Poll, show of hands happens in the general meeting only. Okay, postal ballot, for this we don't require a general meeting. We'll be posting a copy of resolution which is called as a ballot paper. What do you call it? Ballot paper. In this ballot paper, we'll be writing the resolution and in that we'll be giving them space to approve or to reject. Now this ballot paper will be sent to the shareholders registered address. So shareholder shall be giving their vote by sitting at their home. Understood? So this is a postal ballot. Once they vote, they will fold that, again put it into the envelope and send back to the company. All the provisions of post and all, everything is done by the company only. Shareholders just have to pack it and send it back. So once company sends that, receives all of them, there will be a ballot box wherein all the votes shall be connected and that ballot box will be handed over to a professional. Now that professional can be a practicing company secretary but definitely not officer of a company. So he'll be opening that ballot box, counting the votes and they will be giving a report to the chairman of the company and then chairman will decide whether resolution is passed or resolution is not passed. Clear with this? I hope it is clear. Okay, so this approval for putting the unutilized money into a new business will be taken through postal ballot. Okay, second, we have to give notice in the newspaper. Issue the notice in newspaper also. Okay, that we have sent notice and resolution to all the shareholders. Please check it and please give your votes. Okay, now this will be in two newspapers. One English newspaper, another one will be in the vernacular newspaper. Okay, which language? Where your registered office is situated, the most common language in that locality, and you cannot give in any newspaper. It has to be a famous newspaper, people who reads that newspaper. Okay, so we are going to post it at shareholders address, give the advertisement, that is notice in the newspaper also. After that, Third one, through postal ballot, okay, through postal ballot, we have to pass a special resolution. Okay, so how many votes we require in our favor? 3 times vote we require in company's favor, then only you can say that resolution is passed. And whoever are the dissenting shareholders. Okay, some of the shareholders might not like their money to be put into the pharma, right? So dissenting shareholders, okay, this dissenting shareholder should be given an exit route. Company cannot force somebody to put their money into other business without their consent, right? So dissenting shareholders are to be given exit route. So this is a procedure we need to follow in case we have an unutilized money. I hope it is very clear to all of you, right? If you have not understood anything, you can rewind the video and watch it again, no problem at all. Okay, now let's start with the exact procedure. Procedure to alter the object clause of the company. Okay, so what is the first step? The very first step, now you know it, you can write along with me also, no problem at all. It is issue board meeting notice. You can also write call board meeting, 7 days notice. Second one, hold board meeting. Now in board meeting, what all things we are going to do? First, proposal for change in object clause. Fix day, date, time and venue of the general meeting. Third, approve notice of general meeting. And fourth one, authorize CS or a director. Okay, these 4 board resolutions are very common now. Very good. Chalo. If you are able to write this, that's an achievement. After that, we have to check whether company has unutilized money or not. Okay, if it has to first follow the procedure for unutilized money. Okay, so in the third one, whatever procedure we saw earlier, that you have to follow over here. Okay, so follow procedure in case of unutilized money raised through prospectus. Okay, so once we are done with that, now we are going to take the approval for the change of object clause. Okay, so earlier approval was for utilizing the money in the new business. I hope you have understood now. Okay, so now issue notice of general meeting, 21 clear days notice, right? Okay, after that, hold general meeting, and in this general meeting we are going to pass a special resolution for this, right? Pass a special resolution for the object clause change. Okay, now you know that once we pass a special resolution, we have a special form attached, right? Yes, so we have to file form MGT 14. Okay, this form is to be filed with ROC. When we have to file this? Within 30 days of special resolution. Clear? Understood? Now we are going to write the attachments of this. What are the documents we need to attach in MGT 14? I hope you all are making the list of sections and the form numbers, right? Okay, so you can add up the forms whatever we are learning today and sections whatever we are learning today. So CTC of SR, what is CTC? Certified True Copy, right? After that, notice of general meeting along with the explanatory statement. ES stands for explanatory statement. Altered MOA and AOA, that is after changing the business clause. Consent in case of a shorter notice. Shorter notice provision you will be learning in your Companies Act. And the minutes of the general meeting. So all this you have to attach in MGT 14 form. I hope it is very clear. After that, last one, once ROC will receive your form, ROC shall take a note of it. Okay, so in this particular change of object clause, we need not go to any central government for the approval. No, it's not required. Only approval is needed, that of the shareholders and the ROC, that's it. Please remember the form numbers. Please remember the procedure relating to the unutilized money. Okay, so that's it for alteration of object clause. I hope you're enjoying the procedures now. If you're able to write it, that's great. Now we are going to start with the next alteration of your next clause of your memorandum, that is alteration of liability clause. Listen to me very carefully, okay? Alteration of liability clause. Now what do we mean by alteration of liability clause? Listen to this very carefully. Whenever any company which is limited by shares, okay, whenever any company which is limited by shares, it is converting itself into limited by guarantee. Okay, it is converting into limited by guarantee. Okay, or it is converting itself into unlimited liability company. So it is converting itself into unlimited liability company. So this clause, whenever we are changing the liability clause, we are not just changing the clause of the company, but we are altering the type of a company. So we are doing conversion from one type of a company to other type of a company, right? So for example, right now we were limited by shares company, okay, and then we converted ourselves into limited by guarantee. So we changed the liability clause, along with that we changed the type of the company. Understood? So this kind of alteration, that is alteration of a liability clause, whenever we are changing, we are altering its type. Okay, what are we doing? We are altering its type of a company. So this alteration of a type of a company is called as a conversion. What do you call it? We call it as a conversion. And this conversion from one type of a company to another type of a company, we are going to read in chapter number 12. Okay, in chapter number 12 of your SBC, we are going to read how to convert limited by shares to unlimited company or limited by shares to guarantee company and vice versa. Okay, so for now, I hope you understood what is the alteration of limited liability clause. We are going to alter the type of a company, so we are not doing it in chapter number 3 right now, but we will be doing it in chapter number 12. Okay, Now going ahead to the next one, that is alteration of capital clause, we are going to read over here. So we are going to do alteration of capital clause. Now this capital clause is a fifth clause of memorandum. Let's recollect. First was a name, then registered office clause, object clause, liability clause, and this one is a fifth clause, that is your capital clause. Now alteration of capital clause is governed under section 61. The section 61 of Companies Act 2013, it will tell you that what are the various ways in which we can alter our fifth clause, that is the capital clause. So we are going to read that. So 61 is types of alteration in capital clause. Okay. Types of alteration in the capital clause. So let's start with the first one. The first one talks about increase in share capital. Increase in share capital. Now what is this increase in share capital? Before starting this, let me tell you something. Okay. Let us understand what are the different types of capital. What are the different types of a capital under Companies Act 2013? The first type we have is the authorized share capital. The capital with which company gets registered, you also call it as a nominal capital. We also call it as a registered capital. So three names are given. Okay, three names are given: authorized capital, registered capital, and the nominal capital. This is capital with which company gets itself registered. So right now we were going to see how to increase the authorized share capital of company. So coming to the example of this, if any company, that is ABC Private Limited, when its authorized share capital, ASE's authorized share capital is 10 lakh rupees, how much equity shares it can issue? Only up to this 10 lakh. It cannot issue more than that. Why? Because the authorized share capital is only 10 lakhs rupees. Is it clear? Understood? So, if we want to issue more shares, if company's financial requirement is more, then we have to increase this capital. Right now the cap is 10 lakh rupees, and if you want to issue shares of 12 lakh rupees, you have to increase the cap by 2 lakh rupees. Understood? So this is the cap, authorized share capital nominal, or the registered capital as cap of a company with which it can issue the share capital. So first type of a capital is authorized share capital, nominal and registered, all three are one and the same. The second type of a capital is a issued capital. So issued capital. Okay, so let's take an example. 10 lakh rupees is the authorized share capital. Out of this, company only wants to give 8 lakh rupees to the shareholders. So capital which company offers to the public or the private group of people is called as the issued capital. So it's not necessary entire 10 lakh will be raised at once, no. Okay, as and when company will require funds, it may do the issue of shares. So right now, as on today, company is in requirement of 8 lakh rupees only. So out of 10 lakh, it issued only 8 lakh shares. So remaining 2 lakhs, this is a reserve capital you can call. Okay, this reserve capital is nothing but this capital company can issue any point of time. So 10 minus 2, 10 minus 8 is 2. Okay, so that is your issued capital. Then the third one, whenever company issues, okay, some part may be unissued also. You can call it as a unissued capital, you call it as a reserve capital. Okay, so right now it is 2 lakh rupees. Everybody is fine with this? Yeah. After that, it comes to subscribed capital. It's not required, no, that entire part may be subscribed. It's not required, correct? Subscribe means what? People are interested in taking that shares and people have taken the share. That is called as a subscribed capital. So subscribed capital issued was 8 lakh rupees and out of this 8 lakh rupees, 7 lakh rupees was subscribed. Okay, so what is an unsubscribed capital? It's 1 lakh rupees, right? This much nobody has taken. So can we put that in the reserve capital? Definitely we can put it into the reserve capital. Okay, so this 1 lakh can be added over here, making it to 3 lakh rupees. I hope you're getting. So first was authorized, then issued, then subscribed, then how much is the unsubscribed one. So out of 8 lakh rupees which were issued by the company, 7 lakh was subscribed. Entire may not be paid up, right? So how much is a paid up capital? From this 7 lakh rupees, shareholders have paid 6 lakhs. Okay, what is paid up share capital? Shareholders have paid money. So out of 7 lakh, entire 7 lakh may not be paid up, but they have paid the 75% or 80% of the amount. So they have paid 6 lakh rupees. Okay. So your paid up share capital is 6 lakhs. So how much is the unpaid? Unpaid capital is 1 lakh. On this 1 lakh rupees, they make calls. What do they make? They make calls. Okay, so these are the various types of share capital. First is authorized, then you have issued, unissued, subscribed, unsubscribed, paid up and unpaid. On unpaid you get a calls. Now remaining this 3 lakh rupees, remember guys, remaining this 3 lakh, how do we get this 3 lakh rupees? 2 lakh is a part which company has not issued and 1 lakh is a part which was not subscribed. So any point of time company can raise 3 more lakh rupees. So out of this 10 lakh, how much is a raised part? Raised part come to 7 lakh rupees. And how much is the unraised part? 3 lakh rupees. I hope it was clear. So this was the types of capital. This is very important as far as your company law is concerned and also this SBEC part is concerned. Okay, you can revise it one time and then we will proceed to the alteration of types of a capital. I hope you have revised it properly. Now let's proceed. We were doing section 61, that is alteration of different types of a share capital. Now whenever any company wants to issue its authorized share capital, so let's take an example. If the existing share capital, SC stands for share capital, was 10 lakh rupees. If existing share capital was 10 lakh rupees, now they want to issue more shares. So now they want to make the new authorized share capital to 12 lakh rupees. So they want to increase their share capital by 2 lakhs. That is called as an increase in share capital. How to do it? We are going to see the procedure. As of now, we are going to see what are the different types of alterations a company can do. Okay, so first one is the increase in share capital and also we have understood what are the different types of share capital. Let's revise it. Authorized share capital, issued capital, Then you have the unissued capital, subscribed, unsubscribed, paid up and unpaid. Okay. Now the second type of a capital or second type of alteration of capital is consolidation. Okay. Consolidation of a share capital. Now what do we mean by this word consolidation? Consolidation means merging two or more shares. Okay, merging two or more shares into one is called as a consolidation of share capital. I can give you example of this. If share capital of ABC Private Limited, okay, share capital of ABC Private Limited was 1 lakh, okay, which was divided into, listen to this carefully, 10,000 equity shares. Okay, it was divided into 10,000 equity shares of rupees 10 each. Okay, so how many equity shares are there? 10,000. And what is the price per equity share? 10 rupees. Now consolidation means two or more shares will be merged together. That is called as a consolidation. So this was your old share capital. Now how will your new share capital look in case of a consolidation? The amount of authorized share capital will not change, only the consolidated part will change. So the amount of share capital is rupees 1 lakh, same, but it will be divided into, okay, it will be divided into 1,000 shares. Earlier it was 10,000 equity shares, now shares became 1,000. So we have decreased the number of shares. So when we are decreasing number of shares, at that same time we have to keep the same share capital. What we have to do? We have to increase the value, right, of rupees 100 each. Now just take a look what happened. Earlier we had 10,000 equity shares and now we are having 1,000 equity shares, right? Earlier we had 10 rupees per share, but now we are having 100 rupees per share. So in consolidation what happens? We'll be decreasing number of share, but at the same time we are going to increase the value of the share. Why this consolidation happens? Because shareholders don't want more number of shares to be traded, okay, don't want more number of people to participate now, okay, that's why they are consolidating the share, thereby increasing the value. And very important, keeping the voting rights as same. Very important point, highlighting part. Consolidation does not amount to alteration of voting rights. Okay. So if your existing voting rights are altered, existing voting rights are changed, then we require permission of a NCLT. Okay, we'll write that point as well. If existing voting rights change or changes, then what we require? Prior approval of NCLT. So without prior approval of NCLT, we cannot alter the voting right. So in consolidation, without permission of NCLT if we want to do, we have to keep the existing voting rights as it is without altering that. Is it clear? So what is a consolidation? Let's revise one more time. Decrease in number of shares and increasing the value of the shares. Now we will go to the next one. That is a subdivision. So third one is the subdivision. Subdivision of the share capital of the company. This is a third type of the alteration. This is totally opposite of what we learned right now, that is your consolidation. So consolidation means merging of the shares together. Subdivision means splitting of the shares. So your one share will be divided into 2 or 4 or 5 parts. Like IRCTC recently did a split up because they want more number of people to trade their shares. They want more public participation in the shares. Such kind of company will go for the split up. Okay, you can also call it as a subdivision. So over here what will happen in the splitting of the shares? Number of shares will increase. Your share capital is same? Yes, we are not altering the share capital. The share capital, authorized share capital is the same. Okay, so in split up what are we doing? The number of shares will be increased, right? Number of shares will be increased and the value of shares, what will happen to the value of the shares? Very good, it will be decreased. Number of shares will increase, the value of shares will be decreased. I hope this is very clear, right? Let's take an example and you will understand. ABC Private Limited, it had authorized share capital of 1 lakh rupees, okay, which was divided into 1000 equity shares, right? So right now the shares were 1000 equity shares of rupees 100 each, So after split up, post split up, what will be the share capital? How will it look? The authorized share capital will be same, that is 1 lakh rupees, but it shall be divided into, now that 1000 equity shares are split up. So now number of shares are increasing, right? Divided into now 10,000 equity shares and the value obviously it will decrease of rupees 10 each. Okay, now let's highlight. Earlier those were 1000 equity shares, now the shares are 10,000 equity shares. The value was 100 per share and now the value is 10 per share. So in split up what happens? Number of shares increases and the value decreases. In consolidation it is just vice versa. Okay, so this was the third type of alteration of share capital. First one we saw was increase in share capital, second one was consolidation, third one was a subdivision. After that let's go to the fourth one. This is conversion of shares into stock and vice versa. Okay, now what is this? See, whenever you have a fully paid up share capital. So for example, we have a share capital of rupees 1 lakh and this is fully paid up share capital. Now this fully paid up share capital of 1 lakh rupees can be converted into a stock. So what is a stock? Stock is nothing but it's a bundle of shares. Okay, it is bundle of shares. So this 1 lakh rupees which is totally paid up, fully paid up, it can be converted into stock. So earlier people were called as a shareholder of the company, now they will be called as a stockholder of the company. Now mere because of conversion, does their right changes? The answer is no. They get all the rights of the shareholders, that is right to attend the meeting, right to vote, right to get dividend, everything will be same. What changes? Only the nature changes. Now it is no more a share but it's a stock. Now why companies do that? Whenever company has enough capital, they don't want more and more shares to be traded on the stock exchange, so they will reduce the number of shares. How can they reduce? They can delist. The answer is no. So what they will do, the part which is totally paid up, they will convert some of the part into the stock. Stock is not traded on the stock exchange. Okay, so only fully paid up can be converted into a stock. Then your stockholder has all rights similar to the shareholder. Their rights do not change at all. And stock, the stockholders will get a certificate. So this is an entire stock of 1 lakh rupees. So each stockholder will be holding a part of this. Okay, and stock can be sold in fractions. Can we sell the shares in fractions? The answer is no. We cannot sell the shares in fractions, but stock can be sold in fractions. Now, whenever company feels that now my shares have to be traded in the stock exchange, what they can do, this stock again they can convert into the share. That's why a company can convert shares into stock and stock into share any point of time, but it should be fully paid up. Okay, and they do not hamper with the rights of the shareholders. Okay, so now we are going to the last one, that is the fifth type. It's a cancellation of share capital. Okay, it's a cancellation of share capital. Now what is this cancellation of share capital? I hope you remember I had taught you in this session only what is authorized, what is subscribed, what is paid up, right? So company has issued 10 lakh shares. So it's not important that all of them will be subscribed. So whatever is the unissued part, okay, so suppose out of 10 lakh rupees only 8 lakh was subscribed. So out of 10 lakh rupees, 2 lakh rupees in unsubscribed capital, or you can say it's an unissued capital. Okay, so total authorized share capital, out of that it issued 10 lakh rupees shares. Okay, yeah, this is my mistake. I'll write over here unsubscribed. So unsubscribed part is 2 lakh rupees. So cancellation of share capital means what? Company can cancel its share capital. Which share capital it can cancel? Only which is unissued and only which is unsubscribed. Okay, only which is unissued and only which is unsubscribed part can be cancelled, because once the shareholder has taken the shares, you cannot cancel that part of a capital. So which part of capital can be cancelled? Unissued and unsubscribed. If company wants to cancel the subscribed capital, then it has to go as per section 66 of Companies Act and with approval of the NCLT. So over here, whenever company cancels the unissued part or the unsubscribed part, no prior approval of NCLT is required. We don't require prior NCLT approval in this. Okay, but if company is cancelling the subscribe part, okay, then NCLT approval is required as per section 66 of Companies Act 2013. So whenever company is cancelling its unissued capital, unsubscribed capital, it does not amount to reduction of share capital. Hence, we don't require prior approval of NCLT. Is it clear? Understood everything? So first we saw increase in capital, consolidation, subdivision, then cancellation of share capital, and before that we saw conversion of share into stock or stock into shares. I hope this was very clear to all of you. So this way the types of the capital we can alter. But now we are going to see what is a procedure to alter the share capital. So now we are going to start with procedure for alteration of share capital. Okay, in this we are going to see the method to increase the share capital. How to increase the authorized share capital. Okay, what are the two other names for the authorized share capital? I hope you have got it. It's a registered capital or a nominal capital. Okay, so when a company wants to issue more number of shares than whatever is authorized, if company is authorized to issue only 10 lakh and then now it wants to issue 15 lakh rupees, so it has to increase their authorized and increase that cap also. The procedure we are going to see. Now tell me one thing, are we going to alter the memorandum for this? Obviously, because authorized share capital we write in the memorandum. So we are going to alter the memorandum as well. So let's begin with our procedure. Very easy procedure it is. First of all, we have to check the authorization of articles. What we have to check? Authorization of articles of association. If article don't authorize you, if in article it is not written company can increase its authorized share capital, first thing we have to do is alter the articles. Okay. So if not authorized, then alter articles of association first and then proceed to the alteration of share capital. Now the second one, we are going to call a board meeting. For calling board meeting, we require 7 days advance notice. Okay, I hope you are remembering all these things. Yes, and I hope you are comfortable with writing the procedure as well now. After that, on the determined day, we are going to hold the board meeting. In board meeting, we are going to pass various resolutions. The first one, the proposal for alteration. The second one, we have fix date, day, time, venue of general meeting. Third one, approval of notice. Along with that, we need the explanatory statement as well. Of general meeting, and the last one is the authorization. Okay, so these are the resolutions we are going to pass. Okay, I hope this point is clear. After that, what we'll do? We shall issue notice of general meeting notice, along with that explanatory statement. And this notice, it will be 21 clear days notice. Okay, now we are going to hold the general meeting. And in general meeting, we are not going to pass a special resolution this time, because whenever company wants to increase authorized share capital, it is an ordinary resolution in the general meeting. So please make a note of it. And we are going to pass a ordinary resolution in the general meeting, right? After that, we also have to alter our memorandum, right? Pass special resolution in general meeting for alteration of memorandum of association, fifth clause. So for altering your capital clause, you require a special resolution. But for permission of members for increasing authorized share capital, we always require an ordinary resolution. Okay, now the seventh one, what we have to do, whenever we alter our share capital, the form is SH7. Like we altered our name clause, we had to file a written with the ROC. In the same way, the written for alteration of share capital is SH7. So we have to file form SH7. Which form are we going to file? SH7 with the ROC. Okay. Now within 30 days of passing ordinary resolution, now what all things we are going to attach to this SH7? SH7 we are going to attach the notice of general meeting, then we are going to attach CTC, that is certified true copy of your ordinary resolution. After that, we require your altered memorandum articles. And the last one, minutes of the general meeting. Okay. Now the next one. ROC shall take a note of all this, that is increase, consolidate, subdivide. But in consolidation and subdivision, both of them, we cannot alter the existing voting rights. And in cancellation of share capital, we are going to just cancel the unsubscribed and the unissued capital. We cannot cancel the issued or the subscribed capital. For that we need the NCLT approval, and for that we need to see section 66. Okay, so this was about your alteration. Now ROC shall alter the share capital in the master data of the company. Okay, so this was very, very important. I hope you understood all this. Very important point to be noted over here. SH7 form number you have to remember, and the ordinary resolution we are going to pass, this you have to remember for the share capital. So this was for the alteration of capital clause of the company. We saw section 61. Along with that, we saw the procedure how to alter the share capital. Please listen to this video and learn this entire thing very carefully, because this is also going to help you in the Companies Act. Now let's start with the procedure for the registered office of the company. Now you will wonder, why have I kept this registered office at last? Because in registered office we have various changes. Okay, so now let's understand. We all know what is a registered office, right? With the main office of the company. Okay, we have given the address of that. We have done the verification of registered office with the ROC. So whenever a company changes its office from one place to another, we have to follow this procedure. So what are the changes? We are going to see that. Okay, It's a alteration of registered office of the company. The very first change which will come here, it is alteration of registered office within the local limits. Okay, it is within the local limits of the company. Local limits means what? It is within the same district, in the same area only. So they are not changing the district, that is within the local limits. Okay, so whenever company changes its registered office within the local limits, are we going to alter our memorandum? The answer is no, because in memorandum we are only writing the state. This is the reason we are only writing the state in memorandum. So when are we going to alter our memorandum? Only in case when we are doing change of our registered office from one state to another state. Okay. After that, the second change we have is outside the local limits. Okay, but it is within the state. So the second one is outside the local limits but within the state. So over here also we are not changing the state, so we are not altering the memorandum. But this does not mean we don't have to follow the procedure for change of registered office. We do have to follow, we do have to file the forms with the ROC as well. So the third one we have is change of registered office from one ROC to another ROC. Okay, so what is this change about? From one ROC to another ROC. But this is also within the state. Okay, you might not know this, so let's learn this. Generally what happens is, as of today, each state has one ROC. Each state has one ROC. Okay, but there are two exceptions to this rule. There are two exceptions. Now what are these two exceptions? Only two states in India have more than one ROC. Okay, so first one we have state of Maharashtra, and the second one we have the state of Tamil Nadu. So Maharashtra and Tamil Nadu are the only state which have more than one ROC. So in Maharashtra there are two ROCs. One is Mumbai ROC, another one is a Pune ROC. So two ROCs are there, one at Mumbai level and one at the Pune level. As far as Tamil Nadu is concerned, one ROC is at Chennai and another one is at Coimbatore. Okay, so what is the general rule? One state, one ROC. But there are only two states which has more than one ROC. One is Maharashtra, and Maharashtra two ROCs, one at Mumbai, one at Pune, and another one we have a Tamil Nadu. Even that state has two ROC, one at Chennai, another one is at Coimbatore. I hope it is clear, right? So whenever in state of Maharashtra any company is registered in the state of Maharashtra with the Mumbai ROC. So when company which is registered with the Mumbai ROC, it changes to the Pune ROC. So it is change of one ROC to another, but it is within the state of the Maharashtra. So this third one, it is possible in two states only, either in Maharashtra or in Tamil Nadu. It is not possible for the other states because each state has only one ROC. So when in other states we are changing ROC, automatically we are changing the state also. So the third one only for two states, Maharashtra and Tamil Nadu. Please remember this. Okay. Now the next change, the fourth change we have, it is from one state to another. Okay, this is from one state to another. In this particular change, we are going from Gujarat to Maharashtra or Tamil Nadu to Madhya Pradesh. So we are changing the ROC along with that state also. So from one state to another state. And in this, definitely we are going to alter the MOA. In all other changes, that is in within the local limits, outside the local limits, but within the state. The third one, from one ROC to another, but within the state, we are not going to alter the memorandum. So in all these three, no alteration of MOA. We are going to alter the MOA only and only in fourth one. I hope this was very, very clear to all of you. Yes, you can go through this slide, very, very important, and then we will go and start with the first procedure, changing the registered office within the local limits. So the very first procedure we have is change of registered office within the local limits. So let's revise one more time. Are we going to alter the MOA? No. Are we going to change the state? No. Okay, so within the local limits means what? What is meaning of within this local limits? Company is not changing its area. Within its area only. So not changing the district, I can say. The answer is yes. So procedure over here is very simple. What is a procedure? Important points to be remembered. No shareholders approval is required. Only and only board approval is required. So what is required? Only board approval. That's it, nothing else. So the procedure is very simple. Yes. Okay, in this chapter, full of procedures you will get. So the very effective way to study this chapter is just remember whose approval is required and which form is relevant. That's it, you are done with this chapter. Okay, so for changing the registered office within the local limits, we just have to pass a board resolution. That's it. So let's quickly start. So we have to call the board meeting by giving 7 days advance notice. This we have seen. The second one, we are going to hold the board meeting, and in that we are going to pass a board resolution. I hope all of you are writing along with me. This will give you confidence to write the procedure in the exam. So pass a board resolution for change of registered office. We are not allowed to write RO. RO is a shortcut of registered office. Don't write RO. Okay, registered office within the local limits. Okay, the next one, whenever we are changing our registered office, our form for that is INC 22. Okay, so even though we are not altering the memorandum, we have to intimate ROC about our change of registered office, because that is our main address, correspondence address, right? So we have to file form INC 22 with ROC. Over here the time period is also important. Within 15 days of passing board resolution. So within 15 days of passing board resolution, we have to file INC 22 with the ROC. We have to attach the relevant documents, and that's it. We are done with the procedure for within the local limits. So So within the local limits, we don't take the shareholders' approval also. Is it clear? I hope it is very clear. We'll add one more point over here. No need to alter memorandum of association. Why? Because we only write a state. Okay. So this is your procedure to change your registered office within the local limits. Okay. I hope you are done. So let's quickly start with the next procedure. So let's begin. Next one in this, change of registered office outside the local limits but within the state. Okay, so what you are going to alter? Outside the local limits but within the state. So over here we will require board approval also. So board approval is required, means board resolution is required, and the second thing we require shareholders approval also. Okay, so we'll be calling a general meeting in this and also passing a required resolution. No other authority approval is required. Okay, so let's quickly begin with our procedure. The first thing we need to do is a call board meeting. That's correct. So call board meeting by giving 7 days advance notice. The B point, we have to hold a board meeting, and in that we have to pass various resolutions. First of all, proposal for registered office change outside the local limits. Second one, we have to fix day, date, time and venue of the general meeting. Third one, approval of notice along with the explanatory statement. Of the general meeting. And the last one, authorization. So the 4 resolutions which will be passed by your board of directors. Okay, after that we are going to issue a notice of general meeting. So issue notice of the general meeting. And how do we issue? 21 clear days notice, right? 21 clear days notice is mandatory. After that, on the fixed date, we are going to hold a general meeting. So hold a general meeting. And now for change of registered office within the state but outside the local limits, we need to pass a special resolution. Okay, pass a special resolution. Very important point to be noted over here. Wherever postal ballot is compulsory. Okay, so where postal ballot is compulsory, where companies are listed or it has more than 200 shareholders, right? So wherever postal ballot is compulsory, you have to pass this resolution via postal ballot only. Okay, so let's write that point. Wherever postal ballot applicable, pass the resolution through postal ballot only. Okay, So no need to call a general meeting for this. They can pass a resolution by a postal ballot. But in private limited company, do we have a postal ballot? The answer is no, because the cap of number of members is 200. So we have passed a special resolution over here, and along with the special resolution we have our form MGT 14. I hope you have not forgotten. So file form MGT 14 with ROC within 30 days, right? Then one more form, you have to intimate ROC about the change of the registered office, right? So you have to file form INC 22 with ROC within 30 days of passing special resolution. Okay, if you can find some change over here. In the previous process, which was change of registered office within the local limits, we filed INC 22 within 15 days of passing board resolution, right? But whenever we are changing our registered office outside the local limit and we are convening the general meeting, we are filing the form within 30 days of the special resolution. So please remember this, very important. Now tell me, do we need to alter the memorandum? The answer is no. No alteration of memorandum is required. Okay, we are done with this procedure as well. You can go through this procedure one more time. Okay, and then we will go to the next procedure. I hope you have understood this. So let's begin with our next procedure. This procedure will be little lengthy because we are going to change from one ROC to another. Okay, so the next one, procedure for change of registered office from one ROC to another ROC, but this is within the state. Okay, one ROC to another ROC, but within the state. So this will be possible only two states. This we have learnt earlier also. So in which state this happens? First one is the state of Maharashtra, and second one we have a state of Tamil Nadu. So only in these two states this kind of alteration or change of registered office is possible. So let's quickly begin with the procedure. The very first point, call board meeting by giving 7 days advance notice. Second one, hold a board meeting, and in that various resolutions we are going to pass. First one, proposal for shift of registered office. Second one, for fixing day, date, time, venue of general meeting. Third one, approval of general meeting notice along with the explanatory statement. I am writing ES for that, you have to write the full forms. And the last one is authorization. So these are the 4 resolutions. Along with that, one more, we require a regional director approval over here because RD is a region head. Like we have various region, eastern region, western region, northern region. So regional director is a head of a region. Understood? So when we are altering or changing from one ROC to another, we have to take approval from the RD. So the fifth authorization, application to RD. Okay, so this is the authorization we need to give. Now the third step will be, firstly issue notice of the general meeting. 21 clear days notice we will be giving. After that, this notice, when you are a public limited company, okay, in case of public company, this notice has to be advertised in the newspaper also. So notice to be advertised in the newspaper as well, only when if you are a public limited company. For private limited, you don't need to do all this. Okay. After that, we have to hold a general meeting, and in that we have to pass a special resolution. Okay, in the special resolution, we are going to write something different. Like you remember in the name change, we had written subject to CG approval. Likewise, we are going to write over here subject to RD approval. RD is your regional director, please remember. Okay, so if RD will not approve this, we cannot give effect to this resolution even though we have received approval from the members. Okay, so we are passing a special resolution. So once we pass a special resolution, we have to file form MGT40 with the ROC. Within 30 days of passing SR. That is your special resolution. Okay. After that, now we are going to file an application with the regional director. File application with regional director in form, to remember the name of the form, INC 23. Which form is there? INC 23 for change of registered office from one ROC to another ROC. Okay, so which is a form number? INC 23 is a form number. Now what are the attachments to this INC 23? Attachments are very important. Okay, we have to remember that. CTC of board resolution, that is certified true copy of the board resolution. Then CTC of special resolution as well. Then notice of the general meeting. Minutes of the general meeting. Now we are going to give various declarations. Now this declaration will be given by whom? It will be given by number 1, the KMP of the company, and number 2, the directors of the company. So KMP and directors of the company have to give certain declarations. Now what are the declarations they need to give? First declaration, very first one, they have not made any default, no default in dues of workmen. Okay, so all the dues of workmen have been paid. So there none of the workmen's salary is outstanding. That is a dues. After that, second one is they have obtained consent of all the creditors. What is the second declaration? They have obtained consent from all the creditors. These are the two declarations required to be made with KMP and a director. After that, the next declaration we require from a director. Only directors will give declaration over here. Now, what declaration we require? First one, there is no litigations or inquiry or investigation. Okay, no litigation, inquiry, investigation pending before any court. Okay, so no litigations are pending, no investigation, no inquiry is pending. This is a declaration, basically three declaration, one given by KMP director both and one given by only one director. Okay, now all this documents we have to send to the regional director. In which form are we going to send? INC 23. Okay, so once we are sending this declaration and form INC 23 to the regional director, we have to also submit this INC 23 with the other authorities. So along with the RD, we are going to submit this with other authorities. So we have to submit copy of application. Which application? INC 23 application. With whom? It is to be submitted first of all to Chief Secretary of State. Okay, we have to send the copy of this INC 23 along with all the documents, all the attachments to Chief Secretary of State. How are we going to file with them? We have to send by registered post. Okay, we have to submit to the Chief Secretary of State by registered post. Secondly, we have to also submit this application to the ROC. ROC we have to file in the E form only, and the form number is by form GNL 2. What is GNL? These are the general forms. Okay, wherever no dedicated form is there, we can file the application in GNL 2 with the ROC. Third one, if there are other regulatories I mean if you are a banking company, then you need to file this application with the RBI under Banking Regulations Act. If you are NBFC, you have to file this application with the RBI under RBI Act 1934. So that is the other regulatory. So example of the other regulatories I can write. It can be RBI, it can be SEBI in case you are a listed company, it can be your insurance regulatory in case you are a insurance company. So even here also we give by registered post. I wanted to show all these things under one slide only, so I have made some khichdi over here. Okay, so what have we done? We have filed application with the RD in INC 23 with all the documents. Along with that, we also made the same application to Chief Secretary of State by registered post, to ROC in GNL 2 and to other regulatories if applicable in by the registered post. Okay, I hope this is clear to all of you. Now, we are going to the next step. We left in point number F, so now we are going to the point G. Till now we have made an application. Now what will happen after that? if any of the authority or if anybody, they have any problem with the shift of registered office, they will raise objections. Okay, so if objections are received, then in that case your regional director shall hold hearing. Okay, what it shall hold? In case objections are received, regional director shall hold the hearing. But when no objections are received, when no objections are received, so do you think we are in need of the hearing? The answer is no. RD shall examine our application and decide. What it shall decide? Either it will grant us approval or it will deny or reject the approval. Okay, but this process of approval denial, in case no objections are received, has to be completed within 30 days. Okay, it has to be completed within 30 days of application. So once company files application, within 30 days RT should determine whether it wants to accept or deny. Now the next one, once approval is received, we will assume whenever we have received approval, okay, we will assume we have received an approval. So that approval order will be filing with the ROC. Okay, so file approval order of RD with ROC, and in which form we have to file? In form INC 28. In form INC 28 we shall be filing order with the RD. See, RD is just giving us permission that you can change from one ROC to the another ROC. That was okay, but it is not effective from the date of RD's approval. We need to communicate this to our ROC. Our ROC will make note of it, and after that it shall be effective. So if you stop your procedure once you get the approval of RD, it's a half procedure and it does not mean change of one ROC to another ROC. I hope it is clear. Okay, so once we file approval with the ROC, what will happen? This INC 28 we have to file within 60 days of receipt of order. Okay, now the next point. Now we have to give intimation to both the ROC. Suppose you are transferring from Pune ROC to Mumbai ROC. So you have to intimate the Mumbai ROC also and the Pune ROC also. So INC 22 will be filing with both the ROC. Okay, file form INC 22, okay, with both the ROC, old ROC also and new ROC also. Okay, INC 22 has to be filed with both the ROC. This we have to do within 30 days of order of RD. Okay, so when this INC 22 goes to both the ROC, are they going to reject that we cannot go to their ROC? The answer is no. What they will do, they will only check the validity of documents. Okay, ROC shall vet the validity of documents. They are not the authorities who can tell you, yes, you can come to our ROC, we have some space for you. The answer is no. RD has given you approval, the process is over. They are just going to check the validity, and if they find the documents are correct, then the old ROC shall transfer all the files to the new ROC. Okay. So as I told you, once the documents are correct, old ROC, it shall transfer all the files to the new ROC. Okay. After that, companies have to publish this notice of change, okay, in newspaper. It is compulsory, we have to do it. That before we were in Pune and now we are going to the Mumbai ROC. After that, we have to make all the necessary changes. We have to intimate so many authorities, right from the bank to the PAN, GST, wherever we are dealing. So you have to make necessary changes each and every place. Are we going to alter the memorandum? The answer is no. No alteration of MOA is required. Okay, this is all the procedure, and this what was important. Form INC 23, RD approval, that's it, and the important document. So once you are done with this, you will understand this. Okay, let's start with the change of registered office from one state to another. I hope you have done with rest all procedure, that is within the local limits, outside the local limits, and from one ROC to another ROC. This will be little big procedure. Okay, but don't worry, as we have done from one ROC to another, there will be certain similar points. Okay, so let's quickly begin with the procedure. I request all of you to write along with me. That will give you a very good practice. So the very first step, what do? We are going to issue a board meeting notice. So we are going to call a board meeting by giving 7 days advance notice. Okay, this is a basic step. First 4-5 steps will be very basic. Next one, we are going to hold a board meeting. In that, what all things we do now? Very easy. Proposal for shift of registered office. Second one, to fix day, date, time, venue of the general meeting. After that, we are going to approve notice of general meeting along with the explanatory statement. We cannot forget that point. After that, we have to authorize. That authority may be given to a company secretary or a director. Okay, authority to apply to the RD. Also authority to take consent from all the creditors of the company and the debenture holders of the company. Okay, so authorization is very specifically required. If there is no authorization, director or CS cannot do this task. Special authority is required, and the third authority to do other acts as required. Okay, after that, we are going to issue notice of general meeting, and it will be 21 clear days notice. Everybody knows this very well, right? After that, we are going to hold a general meeting and pass a special resolution for such shift. Okay, we are going to pass a special resolution for shifting of registered office from one state to another. Again, this will be subject to the RD approval. Okay, so we can add that point. Subject to RD approval. Okay. After that, now little different provision we have. MGT 14 will be same. So file form MGT 14 with ROC within 30 days of special resolution. Okay. After this, now we are going to publish an advertisement in the newspaper. Okay. So the next step, publish in newspaper notice of change of your registered office. Okay, and this notice we need to give in INC 26. Please remember this. Okay, so in which format we have to give this advertisement? In INC 26. Now this INC 26 is to be published in the newspaper. So two scenarios may be there. One, if we are a listed company, and another one, we are not a listed company, so we are an unlisted company. So in case of a listed company, we need to give this publication in the 3 newspapers. One in English, another one in vernacular language, and third one in Hindi. But in case of an unlisted public company, only in 2 newspapers, one will be English, another one will be the vernacular language. So listed company, English, Hindi and vernacular, whereas unlisted we have English and vernacular. Clear? Okay. So we have published notice in the newspaper saying that we are going to file a proposal to RD for change of registered office from one state to the another state. And in case anyone has objection, what are we going to write in that notice? In case anyone has objection from the shift of one place to another, objections may be raised within 30 days of publication of notice. Okay, so we have to raise this objection within 30 days. So within 30 days, anybody, it can be employee, it can be shareholder, it can be creditor, anybody has problem with the shift of registered office from one state to another, they can raise their objection with the RD or with the company, but within how many days? Within 30 days of change of this registered office. Okay. After that, now we are going to prepare list of creditors and debenture holders. Okay. Now this list is very important because this list you have to make it properly and it will go with the application in the form of affidavit also. Okay. So this list of creditors, it will be filed with application. We are going to do application, right? So it will be filed along with the application and it will be duly verified also with the affidavit. Why it should be verified with the affidavit? What is the affidavit? Everybody knows, right? Because an affidavit will be certifying that whatever information is given by the company is true and correct, and anything false will be the liability of a company. Okay. So we are making the creditors and the debenture holders list. So only the amount whose amount is outstanding. See, what is basically a creditor and a debenture holder? Company has to pay their outstanding debts. Okay. So when company is shifting from one state to another, definitely they will have a problem. They will have an issue because they have to receive certain amount from the company. So we have to make a proper list of creditors and a debenture holders to whom company has to pay, and whose outstanding amount is there, only they will have to be included in the list. Suppose I was a creditor of the company of 5 lakh rupees and company has paid me 5 lakh. So will my name will come in that list? The answer is no, my name will not come. So creditors and debenture holders who has outstanding amount, only their name will be appearing in the company's list. So this will be filed with the application. It will be duly verified with an affidavit. Also, it will be verified by your statutory auditor of company. Who will verify this? The statutory auditor of the company. And this list should be latest one. It cannot be older than 1 month. So list cannot be older than 1 month. Of filing application to RD. So whenever we are going to file application to RD, the list cannot be older than 1 month. If it is older than that, the list is not valid. Again, we have to make a new list. Okay, so all these things are very important. And what are we going to include in that list? What are the content of that? The content will be the name, address, and outstanding amount of each and every creditor and a debenture holder. Okay, this was very important part. Yes, so we have started with the documentation. So we have made the list now. After that, documents required for application to the regional director. The first one we made was list of creditors and debenture holders. We saw the rules for making this list. Okay. After that, we require certain affidavits. Okay. Now, what all affidavits we require? We are going to see that the first affidavit, very important, is for the list of creditors and debenture holders. DH is debenture holders. So what are we going to confirm in this list? That whatever list prepared is full correct. Okay, company has inquired into it affairs and then only made the list. None of the creditors and debenture holder name is missing and none of the names are purposely written. So the list is true and correct. So first affidavit will confirm your list of creditors. After that, the second affidavit will be for the list of employees. We have to also make list of employees. So affidavit will be made for the list of employee, and what we have to write in that? None of the employees are retrenched. Okay, retrenched means removal. None of the employees are removed from their job because of this change in registered office. If they have retrenched, then it is because of the employee themselves. There is no fault of a company. So the second is about the list of employees. The third affidavit will be for the application. Okay, So application in INC 23. So for making application with the RD, also we have to give affidavit that whatever information we have given in the application is true and correct, nothing is missing. We are not giving untrue information, so this is what is the trueness. Okay, so these are the 3 affidavits. Now what are the important things about this affidavit? This affidavit shall be signed by, who shall sign this affidavit? It shall be signed by a company secretary, along with that 2 directors. Okay, company secretary and 2 directors, one of them to be MD. One of them shall be the managing director. So affidavits will be signed in this format. Okay. After that, we saw the documentation. So once our documentation are ready, we have to make application to the regional director. Now application to the regional director shall be given in form INC 23. I will say, ma'am, for one ROC to another and again for one state to another, it is the same application form. The answer is yes, it is the same application form. Okay, so INC 23 to be filed with the RD for approval. Can we change our registered office from one state to another or not? Okay. In this, we have to attach required documents. What are the required documents? We have already seen that, right? List of creditors, debenture holders, affidavits, all these things we have to attach. CTC, notices. Okay, so you have to combine the documents of the previous change and this change, combining together you have a documentation from one state to another. Okay, after that, the next one, we have to also send this application to the other authorities. They've also seen, right? So also sent this application for change of registered office. To whom we have to send? First, Chief Secretary of State, right? We are going to send them application by registered post. After that, second one we are going to send to ROC in form GNL2, right? After that, third one will go to the other regulatories. It will be by registered post. And who all are involved in this? Other regulatories. It can be SEBI, it can be IRDA, it can be RBI, etc. Okay. And acknowledgement that you have sent to this many people also need to attach in the application with the regional director. Okay, so I hope you have understood till here what all things we did. Now the next one, now let's check out what are documents required at this particular stage when we are filing application with INC 23. Okay, so what are the documentation? We are going to read that from our notes. All of you can come to our notes. So in form INC 23, we are going to attach these things when we are filing application with the RD for the change from one state to another state. So we have to attach copy of memorandum and articles, then certified true copy of a special resolution for shifting from one state to another state. Then copy of minutes of the general meeting, and we have to give details of that, at how many votes were casted in favor, how many votes were casted against, and how many of them were neutral. Then we have to give affidavit verifying the application in INC 23. This I have taught you. Then list of creditors and debenture holders who have objected this application. Then affidavit verifying the list of those creditors. Then we have paid the fees, that document we have to attach. Then authorization board resolution, okay, like a person is authorized to give application to the RD. We also call it as a wakalatnama or a power of attorney, even that we need to attach. Along with that, latest list of creditors and debenture holder, and what all information will be there in that list: name, address of every creditors and their outstanding amount. This list has to be latest as discussed earlier. Now affidavit will be signed, as I told you, a company secretary and two director. One of them should be the managing director, that they have checked the affairs of the company before making this list, and this list has to be a latest one. Then affidavit from the directors that none of the employees are retrenched. This we have already seen, right? Then also we require a acknowledgement copy of service we have given to other regulatories, ROC, Chief Secretary of State. Then we have to also attach a proof that we have served by registered post to various authorities. Okay, then details of creditors, depositors from whom we have received the objections, if any. We have to give details of prosecution, inquiry, investigation. Basically, if there are prosecution, inquiry, investigation, we cannot get approval of a regional director. Then notice which we have published, okay, that is in INC 26, we have to give notice of that. Then publication of notice. See, whenever we have a hearing, we have to give advertisement in the newspaper, okay, and this advertisement will be also clipped along with that application form. Then we have to also give statement of reasons why are we shifting our registered office from one state to another state. Justification given by company in case objection received previously, okay, before this INC 26. I hope this was clear. Now let's go back to our procedure. Now, what shall RD do? See, remember, in this particular step, don't get lost. Okay, we have published this in newspaper, talking about we are changing from one state to another, okay, and we have told them if you have any objections you can tell us, no problem at all. So whatever objections we have received before the application, fine, we have done with that, but whatever objection we receive after that, what to do in that case? So now what will regional director do? We have applied to the regional director in INC 23. The two circumstances are there: objections received, and second one is objections not received. Okay, objections received and objections not received. So whenever objections are received, RD shall order hearing. What will RD do? It shall order the hearing, and when the hearing is ordered, okay, in that case we have to publish date of hearing in newspaper before 14 days of hearing. Okay, so once date of hearing is announced, company has to publish that in the newspaper, that hearing is going to be held in this particular date. So if anybody has any problem, you can join the hearing. Okay, then hearing to be conducted Now, whenever objections are received, okay, the hearing and everything has to be completed within 60 days of application. Okay, so RD shall complete entire process of approval, okay, within 60 days of application. So within 60 days of application, everything has to be completed in case of objections has been received. So within 60 days, RD should be in capacity to tell whether the approval is given or denial is there. Okay. RD shall decide whether approval is given or denial or rejection. So where approval is given, what shall RD issue? It shall issue a approval order. Clear? Understood? Now we'll go to the next, where objections are not received. Okay. So wherever objections are not received, there will be no hearing. Very simple. So no hearing shall be conducted in that case. Okay. Then what to do in that case? RD shall decide approval is given or rejection is there. So whenever approval is given, it shall issue the order of approval. Rejection is there, the game is over. RD don't want you to change your registered office from one state to another. You can't do anything. Okay. Now this approval order we have to file with the ROC. Yes. We have to file with ROC in form INC 28. So approval order of your RD will be filed with ROC in form INC 28. Please remember this, within 30 days of receipt. I'll show you the entire one, you don't worry on it. Okay, first you understand the procedure. So what happened? In the K point, your approval or rejection was there. In the L point, we filed the application, that is order of RD with the ROC in INC 28. In the M point, now we have to file the return of the shift of registered office, that is in INC 22. Okay. So company shall file form INC 22 with 2 ROC, we know this, yes, with old ROC also and new ROC also. When it has to file? Within 30 days. Within 30 days of RD order, company has to complete all these formalities. Okay. Now what shall ROC do? ROC shall evaluate the application. Is it going to approve or reject your shifting? The answer is no. The order has already been given. It will just evaluate the documents. So once ROC evaluates that, what it will do? Your new ROC, okay, in the new state, wherever you are going, that will issue a new certificate of incorporation. Issue a new COI. Till now, we have seen 3 changes, right? Within the local limits, outside the local limits, and one ROC to another. In any of this time, did any ROC issue us a new COI? The answer is no. But why this time? Because in the COI also the state is mentioned. So over here we are going to alter the memorandum also, and also we will receive a new COI. And who will give us a new COI? The new ROC. Wherever we are going into the new state. Okay, old ROC will not issue us a new COI. New ROC shall issue us a new COI. Very clear with this, understood? Okay. So once we receive this new COI, okay, we also have to do one more thing. Alteration of memorandum, right? So over here we have to call a board meeting. So over here we have to call a general meeting, pass special resolution for alteration of memorandum, and also file MGT 14 with the ROC. So over here we are going to alter the memorandum. Okay. So pass special resolution in general meeting, then file form MGT 14 with the ROC. Okay, so now we have done with the entire process for one state to another. Okay, you can just go through the steps. I'll just show you the entire one. So now we are just nearing to end this chapter. I know you all are tired because of this procedures. Now you will not see procedures. The last procedure we'll check out is for alteration of articles, but that is again the same kind of, the way we altered the memorandum, in the same way we are going to alter the articles also. So before that, first let's see what is the impact of this change. Whenever any company is changing its name, or whenever any company is changing its registered office, what is the outcome of that? So first, let's begin with impact in case of a name change. So when any company is changing the name, do you think the new entity is coming into effect, or does name change mean we are incorporating a new company? The answer is no. Okay, and this impact, of name or registered office, these are very famous as far as your case laws are concerned. Okay, so you will get too many case laws on this, you have to read it properly. So what are the questions on this? Very important. Whenever any company is changing the name, is name change constitution of a new company? So with the name change, are we incorporating a new company? The answer is no. Okay, so name change does not amount to incorporation of a new company. The same entity, only the name has been changed. Okay, then does it affect current rights and liabilities? So whenever a company changes its name, will it alter its existing contracts, rights, liabilities? The answer is no. It does not. So whatever were rights, contracts, proceedings going on before the name change, the same shall be carried forwarded. Okay, so it shall be continued in a new name. This is important because old name is not in existence now, right? So whatever contracts, agreements, litigations, whatever are going on in the old name, everywhere you have to intimate and get your name changed, because now your company is known by a new name. So wherever you're not changing the name, that particular transaction will not have any valid effect. Understood? Then what about the litigations? Litigations are carried on in the old name. Okay, everywhere we have to intimate the court. What do you have to do? Intimate the courts about the name change. Okay, so what is very important point? Whatever your proceedings are there has to be carried on in the new name. This is important. So proceedings has to be carried on in the new name. You cannot carry on in the old name. Okay, but what will happen if name is changed? Then it shall be duty of your company. So whenever name is changed, it shall be duty of company to intimate the change. But what will happen if court gives judgment in the old name? What is effect of the judgment given in old name? Can you execute such judgment? The answer is no. Okay, so it does not have legality. So it is not valid. In short, we cannot execute that. Okay, judgment cannot be executed. Why it cannot be executed? Because it is in the old name and old name is not there. Okay, so all the litigations have to be name changed. But what will happen to that judgment which court has already given? It is not incurable. Okay, what we have to do is we have to intimate the court saying that company has changed the name, so please issue judgment in the new name. That is the only way out. Okay, so company has to get the judgment in the new name, only then it can give effect to that. I hope it was very clear. Let's revise it one more time. Okay, before that I want to tell you the case name over here. This happened in Pioneer Protective Glass Fiber Private Limited versus Fiberglass Pickington Limited. Okay, in this particular case, what had happened was the litigation was going on and company had name change. So company did not inform about the change of name to the court, and court issued a decree in the old name. So now what will happen? Can they execute? The answer is no, they cannot execute. Okay, decree to be taken in the new name only. That is very important. I hope it was clear. I hope you have understood that whenever name is changed, okay, it does not give a new company. So it is not formation of a new company, it's the same company. So whatever old contracts, litigations are there, everything has to be converted into a new name. If it is not in the new name, the contracts, litigations, everything will not have any effect. So if any of the judgment is also given in the old name, that is also to be taken in the new name, otherwise we cannot execute that judgment also. Is it clear? Okay, now we are going to see the effect of the registered office clause. The registered office change. So whenever company shifting its registered office from one state to another, one ROC to another, you might have seen that we had asked for various objections. Okay, so now question here is, who can object? So what is the question? Who can object? The objection can be given by your shareholders, no problem. Objections can also be given by your creditors, no problem. The debenture holders, no problem. The employees of the company even can object. Okay, but very important, their main reason for objection should be their interest is affected. Okay, what should be the reason for objection? Their interest is prejudiced or their interest is affected. They cannot give any other reasons. Understood? They cannot give reasons like this, there will be unemployment in the state. No, we are nobody to think of all this. So if only your interest is affected, then only we can give the objections, otherwise objections will not be tenable. So now going to see who all can object and which objections are tenable, which are not tenable. We have to remember this along with the case laws. So let's go to our notes. Yeah. Now, can there be a notice for petition to be served by any state? See, whenever there is a shift of registered office from one state to another, let's understand this. From one state to another state. Okay, in this state where it is shifting, there will be a loss of revenue. Answer is yes. Okay, so loss of revenue is there in one state, there will be unemployment in that state, and on the other way, where it is going, okay, the registered office is getting shifted from Gujarat to Maharashtra. So in Maharashtra now there will be employment, also there will be profit, there will be revenue generation. Okay, so can Gujarat government file a petition and raise objection to the NCLT saying that there will be loss of revenue to us? I don't want company to go away from my state. No, this objection is not tenable. Why? Because court says that you have to see the entire picture and not just a state specific picture. So we have to see entire picture of a country. So our country's revenue is growing, yes. So state cannot file objection with NCLT saying that we will have a loss of employment in our state, we will have a loss of revenue, so we are objecting this change. This objection is not tenable. Okay, so let's underline. Where alteration is effected by changing of registered office from one state to another, the loss of revenue in one state would be accompanied by increase in revenue in the other state. In such case, the interest of particular state ought not to be considered, but it is an interest of the country as a whole and it should be considered. So, decision to shift registered office of company to another state, it is a domestic matter, hence it will be the decision of the shareholders, and company is the best judge to know how to run the company efficiently and from which place. The state does not have any right to object for loss of revenue. I hope this is clear. Okay, now in one case what had happened was an Usha Beltran case. The company was shifting from Bihar to West Bengal. So there was loss of revenue to the Bihar government because the company had taken a land on lease from the Bihar government. So when company is going from Bihar, it is definitely going to shift its operation. So now the revenue which Bihar government was getting, it will no longer be available. So despite there was loss of revenue to the Bihar government, still the contention of Bihar government saying that there will be loss of revenue was not tenable. Okay, so at that point of time it was a CLB, NCLT was not there. CLB is a company law board. The CLB held that interest free loans, sales tax, electricity would have no bearing on the shifting of the registered office. Okay, so Bihar government had given certain subsidies and electricity subsidies etc. because it had taken a land. So in spite there is a loss of revenue to Bihar, still the shifting of registered office from Bihar to West Bengal was allowed. Now, does employee has right to object? The answer is yes. And now this case laws are very important. These are asked many times. So employees have right to object only case where their interest is prejudiced. But when their interest is not prejudiced, employees don't have any right to object. So in Bharat Commerce and Industries Limited, which case is this? Bharat Commerce and Industries Limited. What had happened, I will tell you. There was a employees union, like we have a trade union, the same like that they were employees union. It had objected shifting of registered office from one state to another. The reason they gave was, I will tell you what was the reason. That there was loss of revenue, unemployment in the state, and the special resolution was invalid which was passed in the general meeting. These were the contentions of the trade union. This was not tenable. Okay, court did not hear this because if employee had to complain, they should have complained about their interest. So over here they are not telling that their interest is getting prejudiced, they are telling about the unemployment in the state, loss of revenue, and the special resolution passed is not valid. This is not correct. So employees union was a registered body and represented quite number of employees. It would have a legal standing to appear before court and oppose publication on the ground that their interests are likely to be prejudiced. But they did not say that. Hence, the objection was not tenable. Second case, Metal Box India Limited. In this case, what had happened was, the company was with the BIFR. BIFR is Board of Industrial and Financial Restructuring. Now we have a IBC, that is Insolvency Bankruptcy Code, but earlier when company was insolvent and was very important, so government used to send such companies to BIFR. BIFR used to restructure the finances, asset and liabilities, and then make the company again a solvent company if possible. So when it was with the BIFR, BIFR told the company to shift its registered office so that it would be very efficient for them to work with the company, because now the board was handled by the BIFR. So over there also the workers had objection for shift of registered office, but it was told by the court that they did not have right to object because whatever employment they were continuing, they made sure, BIFR made sure that they are given another job or they are continued in the same employment. So already you have a provision for the other employment, other job is already waiting for you, you don't have any right to object. So again it was not tenable. Then worker preferred a voluntary retirement. After that, the third one, Quality Ice Cream India Private Limited. In this case, what had happened? Again, there was a petition brought by and two employees. Okay, so over here in this Quality Ice Cream, the company was shifting from West Bengal to Delhi. So from West Bengal, it was going to Delhi. Actually, Quality Ice Cream was acquired by one of the top ice cream sellers and their registered office was at New Delhi. So they wanted Quality Ice Cream's registered office to be shifted to the New Delhi to run the management properly or run the company properly. So over here, what had happened? Two employees objected their shifting. Why? Because there was some litigation going on with the company. Okay, so litigation of employee and the company was going on. It was going on in the West Bengal only. So they thought because of this change that would hamper that litigation, or there would be some effect to that litigation. So because of this they objected. But wherever litigation was going on, court did not object the shifting of registered office. But so if it was very important, that is registered office was so important, court would have objected. But court did not object the registered office in spite there was litigation going on. Okay, so the workers or employees contention saying that if the shifting of registered office was done, that is going to affect the litigation was wrong. So court gave the judgment, okay, that is your CLB allowed the shifting of registered office, but one condition was there. What was the condition? That interest of none of the employees at registered office would be prejudiced by this retrenchment. This retrenchment or this particular change should not retrench anybody, retrenchment removal. Okay, so if employees' interests are prejudiced, then this change is not a good change. I hope it was clear. Okay, so for employees you have to remember these three case laws: Bharat Commerce, Metal Box and the Quality Ice Creams. In all these three, whatever company's contentions were there, it was correct, and employees' contentions were wrong. Okay, so this was the impact of change. I hope all of you understood about the name and the registered office. Very important from your case laws point of view. Now let's start with the next topic, that is alteration of articles of association. So like we have altered our memorandum, all the 5 clauses, right? The same way we can alter our articles also. Okay, just we have to remember a few rules. So what are the rules? We are going to proceed. Now company has a statutory right to alter the articles. So none of the articles can be unalterable. So when any company's incorporation is going on and in that articles or memorandum they have written that these articles will be unaltered, that clause itself is invalid. Okay, so right of a company, it's a statutory right of company to alter the articles and memorandum. It cannot be unalterable. Then we require a special resolution if we want to alter the articles of association. Also, when we are converting a public company into a private company or private into public, we have to alter the articles. So for that we have to pass a special resolution for such alterations. The details of this we are going to learn in chapter number 12. So as of we are not learning that. Okay. Yes. After that, whenever there is any alteration of articles, okay, it will be valid as if it was the original articles. Okay, so altered articles also have the same legality like your original articles. So right to alter, it is very important and none of the company cannot be denied. Okay, it cannot deprive itself of power to alter its articles. So as I told you, whenever we have any clause in articles or memorandum that this articles or memorandum is unalterable, that clause itself is invalid clause. Now can we alter articles absolutely without any condition? The answer is no. There are always limitations in alteration of articles of association. Now this is very important because you may be asked case laws on this. Okay, so how important is alteration of articles and what are the limitations to alteration of articles? How will they ask you questions? The articles of association of the company can be altered absolutely. The answer is wrong because there are certain limitations. So what is the first limitation? Alteration should be as per the memorandum. So alteration of articles cannot exceed the power of memorandum, because we know that memorandum is always superseding the articles. So articles are always subordinate to memorandum. So articles alteration has to be within the limits of the memorandum. Secondly, alteration of articles cannot be inconsistent with the Companies Act also, because articles have to be subordinate to the company as well as the memorandum. So articles have to be subordinate to the Companies Act 2013, along with that the memorandum. So it cannot be inconsistent, but yes, there are certain exceptions to the rule. Now how it can be inconsistent to Companies Act, we'll see an example where there was a resolution passed for expelling a member and director was authorized to register the transfer of his share without instrument of transfer. This was invalid. Why? Can we expel a member? The answer is no, we cannot expel a member. Okay. Can we register the transfer without instrument of transfer? The answer is no, we cannot do that. Okay. So this was done in Madhava Ramchandra Kamath versus Canara Banking Corporation. On the other hand, article may impose on companies certain stricter provision. This we have seen in the entrenchment. Okay, so entrenchment does not amount to inconsistency. Please remember that. After that, articles, whenever they are altered, it cannot include anything which is illegal or opposed to the public policy. It has to be as per the law only, cannot be against the public policy. Articles alteration have to be in bona fide benefit of a company as a whole. If it is for benefit of a group of shareholder, group of employee, that is an invalid alteration of articles. Okay, so articles also should not constitute fraud on the minority by a majority. So where majority of shareholder taking their position or using their position in the wrong manner, they are passing various resolution which is detrimental to the interest of the minority shareholder, such alteration of article is invalid. So let's see what happened. If alteration is not for the benefit of a company as a whole but for the majority of shareholders, then alteration would be bad. Okay, so alteration will not discriminate among the shareholder, who is big shareholder, who is small shareholder. For company, all the shareholders are one and the same, be it a majority, be it a minority. So it has to be for the benefit of company as a whole and not for benefit of any particular group of the people. So Honorable Kerala High Court held that no majority shareholders can, by altering articles retrospectively, affect prejudice of consenting owners of shares, rights already existing under the contract, nor take away right accrued. So they cannot in short take advantage of a minority shareholder by doing the retrospective change in the articles of association. What is retrospective? Backdated. Then altered articles, it cannot compel any existing member to take more number of share without their consent. So if I have 5,000 shares of Reliance, now the articles of Reliance have changed. It says that members have to compulsorily take 2,000 more shares. No, if I agree to take, then only I will take. So articles altered cannot compel existing members to take or subscribe for the more share unless they consent in writing. Okay, without which their liability cannot be increased. Okay, then whenever company has entered into any contract and just because company don't want to complete that obligation of the contract, it want to escape from that obligation, it is altering the articles. This is not correct. So this will be invalid alteration of articles. Okay. After that, articles cannot be retrospectively altered. It will be prospective. Retrospective is a backdated. So if you are altering articles today and you are saying effective from backdated, it is wrong. Alteration of articles always to be prospective from the current dated. Okay, so articles only operate from the date of the amendment. Articles cannot be inconsistent with the orders of the court under various sections of Companies Act, that is 397, 398, 404 of Companies Act 1950. It cannot be inconsistent to that. Now very important, articles can be altered in any manner and none of the clause shall be unalterable. So if you have any of the clause where you have written this clause is not alterable, that itself is invalid clause. This I have already taught you earlier. Okay. Now going to the next. What is the manner of the alteration of articles of association? There are 5 ways. The very first way to alter the article is to adopt a new set of articles. So you are replacing one article, the existing one, and the new one will be valid. So old one will be replaced by a new one. So this generally happens in case your law changes. So earlier we had 1956 Act, Companies Act 1956. When the 2013 Act came, okay, additional provisions were there in 2013. So all the companies which were existing in 2013, they were told to adopt a new set of articles. Okay, so they will be replacing the old articles and making the new one. So entirely new set of articles. After that, addition or insertion of the new clauses. In that we are not replacing the entire article, but one article is already there. Okay, in that we are inserting one clause, adding one clause, that is an insertion. Okay, or we are deleting one clause, entirely we are deleting that clause. We are not replacing it with anything, but we are deleting that. Okay. After that, you are amending a specific clause like we saw in the OPC. In OPC, the resident definition was there. So earlier it said whoever stayed in India for 182 days was a resident Indian. But now instead of 182 days, it became 120. So what you did, you altered, you changed the existing clause. So this is an amendment. Okay. And the last one is a substitution. Substitution means you replace one clause for the another. So earlier clause E was there. This clause is now replaced by F. So what is the difference between the deletion and the substitution? In deletion, we don't add any new clause, we just delete the existing one. But in substitution, we delete one and substitute the another one. Understood? Clear with this? Okay. So how do we alter the articles? Please remember, adopt a new set, or addition, or deletion, or amendment, or substitution. Whenever we are altering our articles, we have to pass a special resolution in the general meeting. So we have to always file MGT 14 within 30 days with the ROC. Is it clear? Understood? Now you will wonder, ma'am, what is this 15 days INC 27? This we are going to learn in chapter number 12. So for now you forget this. Okay. Yes. Now let's see the procedure. Procedure we have already done. We will see from our notes this time. First of all, we are going to call a board meeting. So 7 days notice with the agenda will be given for the board meeting. Shorter notice if allowed can be given. Okay, then we have to hold a board meeting. In that we have to consider, decide the alteration in the articles of association. Then proposal for alteration of article subject to approval of the shareholders. Then delegate authority to any of the director. Fix day, date, time, venue for the general meeting. Approve the draft of general meeting along with the explanatory statement. And authorize the director of CS to give a notice of the general meeting. These all are the steps we have already discussed. Then you can just ignore this minutes part because this will be learning in the company law part. After this, what you have to do is send general meeting notice. 21 clear days notice will be there. Shorter notice clause you will be learning in the Companies Act part. So shorter notice is allowed where you get the written consent of 95% of the shareholders. For now, remember, issue general meeting notice along with the explanatory statement within for 21 clear days. Then we have to hold the shareholders meeting and we have to pass a special resolution for alteration of articles. Special resolution means 3 times vote is compulsory. Okay, but where your articles are entrenched, you need a unanimous approval, 100% approval in that case. And once we pass a special resolution, we have to file MGT 14 with the ROC within 30 days of special resolution. What all attachments we are going to attach? Certified true copy of special resolution along with the explanatory statement, notice of the general meeting, certified true copy of articles of association, shorter notice in case we have taken the consent of 95% of the members and any other thing. Okay, so these are the steps for alteration of articles of association. Now very important thing, the last points for your chapter. Whenever you have an alteration, it is binding on all the people who are connected to the company, also binding on the outsider. So nobody can say that no, before alteration it was like that, I want to follow the previous articles only. No, it is binding on the company and rest all the people who are dealing with the company. Okay, once alteration is done, you have to make changes in all the copies of memorandum and articles. By mistake, if company gives the old memorandum and articles, what will happen? There will be a default and every officer who is in default will be liable for penalty for 1000 rupees for every copy. So every old copy they are issuing without the alteration, 1000 rupees for every copy will be the penalty for them. Understood? After that, whenever any section 8 company, we will be learning about section 8 company in the next chapter. So whenever any section 8 company wants to alter its article, first they need to take the CG approval. Why CG approval is compulsory? Because for starting a section 8 company, they need to first take the central government approval, take a license from them. So once license is taken, then only they can start the section 8 company. Okay, so CG approval is required whenever they alter the memorandum articles. Without CG approval, section 8 company cannot alter memorandum and articles. So whatever alterations are made, it should be notified in each and every copy. This we have discussed earlier also. So this is all for your chapter number 3 part B. Okay, I hope you have understood the entire chapter. Now we are going to learn about drafting. Okay, drafting is part of your SBEC syllabus because this is asked in your paper for 5 marks. Okay, drafting comes for 5 marks. Now what is a drafting? It is about drafting of your legal documents, making your legal documents. Drafting you will be learning in your final level as a 100 marks paper, but right now your weightage is only 5 marks, but that's very scoring, hence we are going to learn drafting of the resolutions over here. So we are going to learn how to draft a general meeting resolutions and a board meeting resolution. So let's quickly begin with the first resolution. First we are going to learn about the board resolution. So first one, draft board resolution for change of name of the company. How to change the name we have already seen, right? So we have to draft resolution for change of name of the company. The format for all the resolutions remain the same. So if you understand the format and if you write the basic format, 3 to 4 marks you can easily get it. So we have to start resolution with inverted commas, double inverted commas, and first 2 words will be in bold. So resolved that. Okay, this is a basic language we have to write. Resolve that pursuant to section 13 and Other applicable provisions. Guys, remember one thing. If you want to draft the resolution, three things we should know. Section number, applicable law, and whose approval is required to give effect to that matter. Like for change of name, we require MCA approval, central government approval, and the general meeting shareholders approval. Okay, so if we know these three things, we can draft resolutions very easily. So what have we written so far? Resolve that pursuant to section 13 and other applicable provisions under Companies Act 2013, and then we have to write whose approval, subject to approval of Ministry of Corporate Affairs and members of the company the consent of board. This is a board resolution, hence we have to write the consent of board. The consent of board be and is hereby accorded. This is a legal language, guys. Please get used to it. So consent of board be and is hereby accorded to change the name of the company. To change the name of the company from. Okay, if in your exam entire details are given from A to B, you have to write name. If it is not given, leave it blank. Don't assume the things. Okay, so from dash in bracket you can write old name to dash new name. Okay, from old name to new name, bracket closed, as approved by ROC. This we have to write because we have to make name application first. That's why we have to write as approved by ROC. This is the first paragraph. Okay. Now second paragraph will be the authorization paragraph. Okay. So we have to leave a line. Again over here, three words in capital. Resolved further that. Okay, how much ever paragraphs you are writing, we have to write like this, resolve further that. Only in the first para, resolved that. Okay, resolved further that Mr. Dash, the director of company, now we are giving authority, right? Mr. Dash, the director of the company, be and is hereby authorized on behalf of the company first of all we are going to make name reservation, right? To make application for name reservation and also to do all such things, deeds and acts, to sign forms and file with ROC in order to give effect to above resolution. This is your authority para, guys. This you have to learn it right as it is. Okay, so few things will be remaining the same. So this is your entire resolution for change of name of the company. Okay, now the next resolution we are going to do will be the shareholders resolution. So draft the shareholders resolution for change of registered office. Okay, what we are doing? Change of registered office from one state to another. From one state to another. Okay, this is the shareholders resolution. Now when it is a shareholders resolution, we have to change our registered office from one state to another. So which sections are applicable? Section numbers are 12 for registered office and 13 for memorandum, right? Whose approval we require? As it is a shareholders resolution, board approval is already taken. So we will require RD approval, regional director approval, right? So let's start with the resolution. I think I missed out one point. When we complete the resolution, make a full stop and inverted comma closed. Okay, please do that. Now, so again inverted comma begin. Resolved that pursuant to section 12, 13 and other applicable provisions under Companies Act 2013, okay, comma, whose approval subject to approval of regional director, subject to approval of regional director and any central or state government, okay, if any, the consent of shareholders of the company. You can write the members, you can write the shareholders. Be and is hereby accorded to shift the registered office of the company okay from, now we have to write the old address first. If details are given, please put it, otherwise don't put the details, okay? So this will be your old address. 2, leave the lines in bracket, new address. Okay, clear with this? Understood? Yes. Now, the second paragraph will be for altering your memorandum. Okay, so we are going to alter the memorandum. So in the second paragraph, one inverted comma, only one. And we are going to alter the second clause of memorandum. You have to write like this. Resolved further that clause 2 of memorandum, don't write shortcuts, okay? Memorandum of association be and is hereby substituted by the following. Okay, one inverted comma, second one, the registered office of the company, we write only the state, right? Yes, is situated in the state of dash, inverted comma, close, a single inverted comma. So this was the second paragraph. Why we made second paragraph? Because we had to alter the memorandum, that's why. Now the third paragraph. Resolved further that Mr. Dash the director of the company be and is hereby authorized on behalf of the company to do all such deeds, things, acts, sign and file forms with ROC in order to give effect to the above resolution. Okay, full stop and inverted comma closed. Okay, I hope you have understood how to draft this resolution. Okay, so such many kinds of resolutions are there in your module, okay, in chapter number 3 part 2. So please practice that. Out of that at least one is asked. The format remaining the same, we have to remember the section number and whose approval is required and which law is applicable. Okay, you can just go through this one more time, or if you want to take a screenshot, you can do the needful. Okay, yes, please revise all other resolutions. If you practice by writing, it will become very easy for you to revise. Okay, so let's see some of the questions of your past papers. Most of them we have already discussed in the sessions. So the first one, alteration of capital clause in memorandum is a precondition to restructuring the capital structure. We have to elaborate this statement by mentioning relevant provisions of Companies Act 2013 on types of alteration of capital clause. So what is basically asking? They are asking us various types of alteration. So how we have to start? We have to mention a section number if you remember. So section 61 of Companies Act provides various types of alteration of share capital which can be done in the general meeting of company by alteration of your memorandum of association. So we have discussed the various types of alteration. First, we can increase the authorized share capital, then consolidation or division of your share capital, converting your fully paid up shares into stock or stock into shares, subdividing the shares, and cancellation of the shares. But in point number B and D, we have to remember we cannot alter the voting rights of the members. So if existing voting rights are getting affected, in that case, we cannot go by this section 61, but we have to take the NCLT approval for that. I hope this is clear. So all above alterations, they do not require NCLT approval unless we are doing changes in the existing voting rights of the members. Okay, so these alterations require a copy of resolution to be filed with ROC within 30 days. For increasing share capital or any change in the share capital, which form do we file? I hope you are understanding it, right? It is Sept 7. Yes, we file Sept 7 for alteration of any kinds of a share capital. So that we will have to file with the ROC. So accordingly, alteration of memorandum is precursor to change the capital structure. Without alteration of memorandum, we cannot alter the capital structure. Okay, so this was your first question. After that, second one. X, an employee of BG Limited. BG Limited, it's a public limited. By name we can understand. Is aggrieved. Aggrieved means he is not happy. He feel injustice is done on him. So he is aggrieved by decision of shifting of registered office of company from Uttar Pradesh to Haryana. Okay, so the registered office of company was in Uttar Pradesh. Now it has been shifted to Haryana. So employee of BG, he is not happy with this. Okay, he has filed a public interest litigation, PIL. If any of you are doing LLB, you have understood what is PIL. When interest of so many public is affected, we can file PIL. Okay, regarding the same, considering that business of company will be severely affected by the said decision. So what he is having a stand, he is saying that if there will be shifting of registered office, the business will be severely affected. In light of decided case law, examine the strength of argument in PIL. So over here they have told us to refer to the case laws. I hope you remember the 3 case laws which we had discussed. First Bharat, okay, second one the metal one, and third one the quality ice cream, right? So over here the Bharat Commerce case would be relevant. Why? Because in Bharat Commerce case also, employees pleaded or they were not happy with the decision of change of registered office. And what was the reason? What did they plead? They pleaded that business of the company would be severely affected. There would be employment in the state. But this is not a valid ground. Why? Only if interest of employees are affected, if interest of other stakeholders are at stake, then only NCLT shall go in favor of employee or other stakeholders. Okay, so let's see the answer. The PIL of X over here, do you think it is tenable? The answer is no, because this is a company. How can a change of registered office of company is going to affect the public at large? There should not be PIL over here because public interest is not affected. Okay, so PIL of X is not tenable. Understood? Then facts are similar to which case? Bharat Commerce and Industries Limited, where it was held that employees union, which was a registered body with quite number of employees at registered office, would have a legal standing before the court and oppose application if their interest was affected. Then that would be a correct ground. But what did they plead? They pleaded that there would be loss of revenue or unemployment in the state, and hence meeting and which special resolution was passed was not valid. So long as the interest of employees are not affected, employees are not retrenched because of shifting of registered office, the argument of X is not tenable. Is it clear? Everybody understood this? Great. Now let's see some of the questions which are asked. Yes, this all you have to solve. So let's see the first one. Sweet Limited has altered its name from Bitter to Sweet. Okay, from Bitter to Sweet. However, the fact of alteration of name of company was not brought to notice of NCLT. Please advise as to CS of Sweet whether it has right to execute a decree in its own name, that is new name, and after this change. I hope you remember the effects of the name change. Okay, whenever any company is having name change, company has to intimate all the people. All the people I mean at all the offices. Also, if proceedings are pending before any court or proceedings are going on in any court of law, company has to intimate to the court of law also that our name has been changed. So please give a decree in the new name. I hope you are understanding. So in this case, Bitter name was changed to Sweet and the case was going on in the NCLT. They did not intimate NCLT and NCLT gave the decision, that is decree, in its old name, that is Bitter. So do you think they can execute the decree? The answer is no. They cannot execute the decree. Rather what they have to do, they have to request the NCLT to give or provide decree in new name. Okay, they have to provide decree in the new name. I hope it is very clear. Second one, Alteration of share capital, this we have already discussed. I had solved this for you. Third one, with approval of board, amount of 10 lakhs were spent by Alex Cinemas in producing commercial advertisement and it was not covered in its object. The advertisement was a complete flop and company lost amount of 5 lakh. Some members of company objected to such investment not covered by the object. They filed a suit making directors personally responsible and to make good the loss. Will they succeed? We have to support our answer with the reason. So basically, company entered into an ultra vires act which was not covered in the object. They not only entered into an ultra vires act, also because of that transaction, company suffered loss. Okay, company suffered loss. So when, I hope you remember, we had studied what are the effects of ultra vires transaction. First of all, they are void ab initio. Okay, members can bring action on this. So members can bring action that is valid. Action can be brought in by members. Also, directors can be held responsible in case there is loss to the company. So over here company has lost amount of 5 lakh. So member suit to make directors responsible is correct. Answer is yes, they shall succeed. This answer, where do you will find this answer? This answer you will get in effects of ultra vires transaction. Just go through the provision, you will understand. Okay. After that, doctrine of constructive notice seeks to protect the company against the outsider, and doctrine of Indo management operates to protect the outsider against the company. I had given a distinguish between these two, right? Constructive notice and the Indo management. So you have to explain that. It's a straightforward question. Okay. Then Aditya, employee of EBCL, will have right to object in case registered office gets shifted from Kochi to Indore. Comment with the case law. Over here you have to quote Bharat Commerce case law, quality ice cream case laws also. And in that you have to specifically mention employee can object in which case his interest is affected or there is retrenchment because of this shift. He cannot object on the grounds of shifting of registered office leading to loss in the business, affecting the business, unemployment. These are not the valid grounds. I hope this is very clear to all of you. Okay, so these were the questions of your second part. So let's see the questions. Now we are going to see questions of your first part. Okay, this is very important case law. Please remember this. Paid up share capital of X is 10 crores. Okay, free reserves are negative. Okay, due to huge losses in previous year, so it is negative 300 crores. To pay dues to creditor, board of directors passed a resolution, okay, for borrowing 50 crore and got funded from financial institution a medium term loan for 3 years. The entire amount was utilized to pay off the debts. Now when financial institution got information that act was ultra vires, they filed suit against the directors of the company. The plea of directors were the shareholders and directors have limited liability and doctrine of Indo management is applicable. Therefore, they are not personally liable for this. Now listen to this very carefully. What happened? The paid up share capital was 10 crore and reserves and surplus is negative 300. So I can say paid up share capital will be negative 290 CR. Is it clear? So if you have read your section 180, in that powers of board of directors, okay, restrictions are given on that. So what does it say? How much directors can borrow by passing board resolution? 100% of paid up share capital and the free reserves. If the limit is exceeding, we have to take shareholders resolution in the general meeting. So over here, directors of company borrowed 50 crore. I'm very sorry, they borrowed 50 crore. Okay, this was done by passing board resolution only. They did not pass special resolution for this. So how did they borrow 50 CR? Board meeting and board resolution. Ideally, they should have called the special resolution. That is called a general meeting and passed a special resolution. But they did not do it. Understood? So how can a public financial institution know that they have called general meeting or not? It's not possible. So now tell me, do you think the doctrine of indoor management is applicable over here? Doctrine of indoor management is protection to the company or an outsider. Doctrine of indoor management, the protection is given to the outsider. So company is invoking indoor management over here. Can company invoke indoor management against the outsider? The answer is no. We have learned this, right? Because indoor management is just for the outsider. It cannot be invoked against the outsider. Are you getting my point? Okay, now let's read the answer. Section 180, subsection 1, clause C of your Companies Act, read with 179. It provides that board resolution shall be enough, okay, by special resolution would borrow money where money to be borrowed together with money already borrowed exceeds aggregate of paid up plus free reserves plus securities premium account. But this does not include your temporary loan or ordinary course of business loan. They had taken loan from public financial institution. This is not a temporary loan. Understood? Then, now whether transaction is ultra vires can be decided on the following facts. If transaction entered falls within the objects, it is not ultra vires. If transaction is outside capacity, it is ultra vires. This we have seen. If it is in excess or abuse of company's power, it is ultra vires. Can be set aside by the shareholder. Even shareholders cannot ratify this. And when will personal liability come? Members can file a suit in case directors have done all this. Okay. So it is duty of director to ensure that corporate fund is used only for the legitimate business purpose and not for any other purpose. Okay. Yes. So now Bombay High Court has held that shareholder can maintain an action against directors to compel them to restore to company funds of company that have been employed in transaction that have no authority to enter without making company a party to the suit. So while constructive notice seeks protection against outsider, indoor management operate to protect the outsider. So it cannot be against the outsider. Hence, board has taken loan exceeding the prescribed limit. Therefore, directors will be personally liable and indoor management cannot be used against the outsider. Is it clear, guys? So straightforward answer it is, but they ask you in the twisted turn format. Understood? Great. After that, next one. Individual or minority members cannot bring a suit except when it is intended for enforcement of personal rights or prevent members from doing any ultra vires or illegal action, fraud, operation and mismanagement. Discuss with help of decided case law distinction between ultra vires or illegal acts and personal rights. So three things we have to discuss: ultra vires, illegal acts and the personal rights. See, shareholders have two forms of right. One, collective rights which it can enjoy with all the shareholder. For example, class action, class suits. and some are individual rights. Individual rights means right to notice, right to vote in the meeting, right to attend the meeting. Understood? So let's see. So there are two types of right enjoyed. One is personal, another one is copyright right. Please remember this landmark case law. In this case law, CL Joseph versus Joss and Kerala High Court observed that there are two kinds of member, as I told you. One is individual right and other is corporate right. Okay. So whenever we talk about the corporate right, these rights can be asserted only in conformity with decision of majority of shareholders, because corporate right is a collective right. If all the shareholder want to take the decision, or or majority of shareholder wants to bring an action or enforce the right, then only it is possible. Okay, if one or two shareholder wants to exercise corporate right, is it possible? The answer is no, it's not possible. So individual right is a right to maintain himself in full membership with all his rights. Okay, so right implies that individual shareholder can insist on strict compliance of their own rights, correct? And it cannot be waived by majority shareholder. So whenever any object clause or any of the clause of memorandum article is breached, even individual can bring an action and observe a strict compliance of that. So even though majority of shareholders say that, okay, if you are infringing the articles memorandum, that is fine. No, that won't be fine. Okay, because you are going against the statute. In certain circumstances, individual member may bring an action to remedy a wrong done to his company or even compel his company to conduct its affairs with constitution rules regulation. Even though no wrong has been done to him personally, even though majority of fellow members do not wish action to be brought. That's what I'm telling you, that whenever any wrong thing is done by majority, even a single individual can enforce the right, because it is his duty to protect the company. Understood? Because ultimately he is going to be the aggrieved party in that. So he can bring an action when majority of the shareholders are going against the company. Okay. So it is carefully noted that in rule of first versus Horbotle, when corporate membership involves, provided cases is not an exception to the rule of derived above example. If it is ultra vires, okay, always remember, when there is ultra vires action even done by the majority, then also that is not valid, because it is not in powers of the company. How can anybody enforce that? Okay. So 241 says that any member of company who complains that affairs are being conducted in prejudicial to the public interest or oppressive to him or any other member, okay, company can apply for NCLT relief. This is your section of operation mismanagement you will be learning in your Companies Act. So law allows intervention by individual member if wrong done to him personally or any act done by company that is illegal or ultra-vires. So moral of the story is, even a single individual can bring an action against the company when majority shareholders are in favor of the ultra-vires act. I hope this is very clear. Great. Now we are going to see certain questions. Yes, I hope we are done with this. Yeah. So we are done with the question answers of chapter number 3. Thank you so much. Please do chapter 2, 3 very thoroughly. Majority of the questions are asked from these chapters only. Do remember this. Okay. So now we are on the 4th chapter. I hope you are done with 1, 2, 3. Now after learning 2nd and 3rd, which was very lengthy chapter, I understand. Chapter 4th is very easy chapter. Okay. In this we are going to see various characteristics of the company. We are going to see what is holding subsidiary, what is a government company, what is a subsidiary, what is an associate company. So this different kinds of company we are going to see, plus the exemptions of a government company. So all this is agenda for this chapter number 4. The weightage for this particular chapter is 5 marks. Okay, so if they ask you, that's a jackpot question, because this chapter is very simple. No case laws, no more sections. Okay, no more sections, I mean obviously sections are there, but not more in comparison to section, that is chapter 2 and chapter 3. So let's begin. So we are in chapter 4. As I told you, the name of this chapter is legal status of a registered company. Okay, and the weightage, I told you, 5 marks is a weightage for this. Okay, so you have to study accordingly. 5 mark doesn't mean you are going to leave this chapter. Okay, part A, entire 40 marks, very important. Everything is important because we are giving professional exam, right? Yeah. So let's begin and understand the word company. Okay, how did this word company arrived? This basically word company has been arrived from a Latin word. Okay, there were 2 Latin words by which we got this word company. One was cum, another one was panis. Okay, so cum means bread. Okay, panis means together. So this became having meals together. Having meals together. So if you have seen various movies, I know you all don't see the Hindi movies, but movies like Mohanji Daru and all, you might get English version of that. So in that you might have seen even Bahubali, right? Bahubali you might have seen, right? So in that they have shown that our kings or the other common people, their business location is very far away from their residence. So they have to travel a lot. So they cannot come back home. They did not have cars and planes like us now we have. So they have to travel to their business place, be there for 1 year or 1 month and so, and then come back home. So when they are at the business place, they don't have opportunity to meet their family. So with whom they will have their meals or do the extracurricular activities. So it was their business friends. Okay, so when they were into business, in the morning till evening they used to do business. In the evening, that is late evening, they used to enjoy by having meals together. So this is how it came the concept of a company. During the meals they also spoke about the business opportunities that they can come together and do a business. Okay, so this is how the word has been derived. So it's a company, that is having meals together and also doing business together. Okay, I hope you understood the word company. Then the next concept we are going to go. Does company have citizenship? Does our company have citizenship? Can you call that our company, which is registered under Companies Act 2013, it is an Indian citizen? The answer is no, we can't say that, right? Because the company is not an Indian citizen. No, company does not have citizenship status. So the company does not have citizenship. Now there has to be some proof, right? Why do we say so? Because for citizenship we have act called as Indian Citizenship Act 1955, right? We have a Citizenship Act 1955. Now according to this act, who can be the citizens of India? The first one, only and only natural person. Only and only natural persons can be citizens of India. So only and only natural persons be citizen of India. And we know that our company is artificial entity. So when company is artificial entity, do you think it will be a citizen of India? The answer is no. It is not a citizen of India. So, but company is an artificial entity. Okay. Hence, it does not have citizenship. Very simple, very easy to understand. Yes. Now we are going to the next concept. Does company have residence and domicile? Does your company have residence and domicile? The answer is yes. We call our company as an Indian company. Indian company means it has a domicile, it is registered in India, right? It is incorporated under Indian Companies Act, correct? And it has a residence also. It comes under particular ROC. So wherever the registered office of the company is situated, over there the residence of the company is there. Okay, the answer to this is yes. Company has residence, also it has a domicile. Okay, so company does not have citizenship, but company has residence and a domicile. Now we are going to the next, the characteristics of the company. The characteristics of the company. Characteristics means what? The features of the company. And when we talk about the feature, the very important first feature comes into our mind is the corporate personality. Which is the first feature? The corporate personality. Now what is a corporate personality? Company is different, the members is different, right? Company is not dependent on the members. So company's identity is very different apart from its members. So what is the meaning of this? Meaning of this is company's identity is different from its members. Okay. Now this statement has been proved under one particular law. Okay, this statement has been proved under one case. Which case was that? I know everybody is answering that. It's a Salomon versus Salomon. Very, very interesting case it was. In this, the feature of corporate personality came into force. Now, what is this case about? Let's have brief of this case. There was one Mr. called as Mr. Salomon. This Salomon, he was a leather merchant. Okay, Salomon was a leather merchant. He was doing his leather merchant business through a sole proprietorship. He was doing his business through what? A sole proprietorship. Now don't ask me, ma'am, what is sole proprietorship? We have already read it, right? So he was having a healthy business, a profitable business. So he decided to form a company. Okay. So Salomon decided to form a public limited company. Now who will be shareholders of public limited? You know that we require 7 members for a public limited company. So himself, he was a first member, then his wife, then his daughter, then his 4 sons. Okay, his 4 sons. This is how he created the membership of a public limited company, and among his family only he created a company called as Salomon Limited. What was the name of a company? Salomon Limited. Now this is only a company. Company requires some business. So what he did, he transferred his leather merchant business to this company. Okay, so he sold the leather merchant business, which was a profitable business, to this Salomon Limited. Now obviously when someone is giving you something, you have to give them back. The answer is yes. So what did Salomon Limited give back? In consideration of a business, Salomon Limited gave 20,000 pounds equity shares. Okay. Then 10,000 pounds worth secured debentures. Okay. And remaining amount, that was 8782 in cash. So this was totaling to 38,782 pounds. I hope this is clear. Okay, so this must happened in the Salomon. Now what? After this, what happened? Business ran into losses. Now it was a time to wind up the Salomon. Okay, wind up the Salomon Limited. Now how to wind up a company? When you want to wind up a company, remember you have to do various formalities. Like you have to realize the assets. Okay, then pay off the liabilities. And balance, if any, that you can give it to the equity shareholders. But over here there is no point of balance because the business was running in losses. So when they realized the assets of a Salomon Limited, assets came to around 6050 pounds. Asset was 6050 pounds and the liabilities which they have to pay was 18,000 pounds. So company is an insolvent company. Now this 18,000, how was it divided? In this 18,000, we know that there was 10,000 worth of secured debentures. This was a Salomon himself, right? And other, we had 8,000 unsecured creditors. We had unsecured creditors. So now there is a priority. Whenever company goes into winding up, the most prioritized category is your employees and all. You have to pay them. After that comes your secured creditor. And secured debenture holder is a secured creditor. So when you compare secured creditor or secured debenture with the unsecured, Salomon will come first. So he will be the first priority and this unsecured creditors will be the second priority. But unsecured creditors, what did they do? They went to the House of Lords. House of Lords means court over there. Okay, so they objected. House of Lords, they objected that the amount of 6050 pounds, please pay it to us and don't pay to the Salomon, because Salomon, it is a company of Salomon. He was running the business, only his family members were involved, he has done losses. Why do we suffer for that? So please give us entire money 6050 and don't give it to the secured debenture holder who is Salomon himself. Now what do you think? Will House of Lords agree to him? The answer is no. House of Lords said the word corporate personality. Okay, so as per House of Lords, what was held? Held means whatever is written after held, that means it's a judgment. Okay, so House of Lords said that the company is different. It was held that company is different from its directors, members, promoters, etc. Okay, So you cannot combine the director and the company saying that director have done the losses, so director should not be paid. No. So ideally who wins? Your Salomon wins. So Salomon ultimately got this 10,000 pound. I mean, instead of 10,000, the 6050 goes to Mr. Salomon. He won the case, and over there we had a characteristic of a corporate personality. I hope this was very clear to all of you. I request all of you to go through the case one more time, okay, revise it, and then we will proceed to the next characteristic. I request all of you to note down the notes. This will increase your speed, okay, and if you are not able to cope up with me, with my speed, what you can do, you can pause the video and write down in your own language or words, whatever. Believe me, this is your lifesaver. Okay, whenever you will have your exams, you will not have entire book to revise, you have this notes. Got it, guys? So I hope you have understood what is a feature of a corporate personality. Now going ahead to the next type of a feature, that is the second one. It's a limited liability. Okay, I have explained you what is a limited liability in chapter number 2. So in every company, the liability of member is limited. I can't say that because there are certain unlimited liability companies also. But over here we are talking about a limited by shares company. So members' liability shall be limited. Okay, members' liability shall be limited. To what extent I have told you? To the extent of shares subscribed for, anything is unpaid, only that much is a liability of member, nothing else. Okay. After that, we'll go to the next one, which is a perpetual succession. You might have read this, heard this. Perpetual succession means what? Members may come, members may go. It does not affect the working of the company or existence of the company. So members may come or go, but it does not affect your existence of company. Why? Why it does not affect the existence of the company? Because company has a corporate personality apart from its members. If all the members die, if all the directors die, can you just close the shutter of the company? The answer is no. It is formed by the law and it will be wound up as per the law. So you cannot do just shutter down of a company merely because all the directors, all the members have died. Okay, so this is a perpetual succession. That's why we call it company is a most stable form of organization. Why it's stable? Even if all the directors or the shareholders become insolvent, it is not going to affect the company's existence. Company is going on and on and on. It's forever. So unless and until to wind up, you cannot close the company. Okay. After that, the fourth one is a separate property. Separate property. Company can hold property in its own name. What is the rule? Company can hold property in its own name. Okay, it is not like your partnership that once partnership is closed, partners can divide the assets among the partners, right? But this is not possible in case of a company. If your company is winding up, first you have to realize all the assets, then pay off the liabilities, and then you can take balance at your home. You cannot just divide the assets between the directors and the shareholder. It's not allowed at all. So company has a capacity that it can hold assets in its own name. Company will not hold assets in name of director or any member of a company. After that, the fifth one we have is a transferability of shares. transferability of shares. Now we know that a private limited, public limited company has a feature that it can transfer shares very freely. So it can transfer shares freely from one person to another. But we have learned in the private limited company there are certain restrictions to it, right? But apart from partnership or a LLP, the transferability of share is very easy in case of a company. After that, the last feature is it can sue in its own name and can be sued in its own name. Now, what is the meaning of sue or sued? It is a filing of case. So, if any person, any creditor, they have a problem with a company, they can file the case against the company in the company's name only. They need not file the case in name of director or a member of a company, then it's not a company's case. Like that only, if company has some issue with any other party, if it wants to sue, company can sue in its own name. Okay, so these are the basic characteristics of the company. This much is only for your SBC. Rest characteristics you will be learning in your Companies Act. So let's revise all of them, whatever we have done. The very first characteristic, very important, we saw was a corporate personality. Okay, that means member is different and a company is different. The second one we saw is a limited liability. The liability of members is limited. Perpetual succession, members may come, members may go, it is not going to affect the existence of company. Company can hold property in its own name. Company can sue and be sued in its own name. Then in company, the transferability of share is free as compared to other kind of entity. Now in this video, we are going to learn about a new concept called as a small company. Small company is defined under section 2, clause 85 of your Companies Act 2013. So what is a small company? Small company means any company which is a private limited company. So small company is always which kind of company? It's a private limited company. Then the paid up share capital, you can write PUSC but not in the exams, okay, remember. The paid up share capital of such company shall not exceed, okay, it cannot be exceeding 2 crores. Okay, wherever you find 50 lakh instead of this, that's a old version. Okay, 2 crore is a new version, it's an amendment. So any company whose paid up share capital is not exceeding 2 crore and whose turnover is not exceeding 20 crores. So paid up share capital 2 crores and turnover 20 crores. The conjunction between all of this is AND. So it has to be a private limited company whose paid up share capital does not exceed 2 crore, whose turnover does not exceed 20 crore. You can call such company as a small company under Companies Act 2013. Okay. Now this, okay, 2 crore and 20 crore. How do you determine this? It is as per the last audited balance sheet. As per the last audited balance sheet. So every year the status of the company may change depending upon what is the paid up share capital and what is turnover of the company. Practically speaking, every year we don't change the paid up share capital, but yes, turnover does change. Okay, so every year you have to check whether you are a small company or not on the basis of the previous last audited balance sheet. I hope this was loud and clear. Okay, great. Now, very important, I am going to write it here in a different color. Small company cannot be various kinds of company. Okay, so small company cannot be a section 8 company. Please remember, small company can never be a Section 8 company. So if Section 8 company's paid up share capital or a turnover is within the limits of a small company, then also we cannot call that Section 8 company as a small company. Okay. Okay, then your holding company or your subsidiary company cannot be a small company. So this is very, very important. I'll repeat this. Small company cannot be a Section 8 company. So even though Section 8 company's turnover, paid up share capital is within the limit, it cannot be a small company. Neither holding nor a subsidiary company can be a small company. Please remember this. Okay, so this is very important till now. Whatever we have discussed, please note it down. Please pause the video over here and understand this. If your base is very clear, the subject is very easy. Even your paper is very easy. Okay, now we are going to move ahead. Just take an example. We have a ABC Private Limited. Now it's a private limited, so possibility it may be a small company. Okay, by the way, why we want to be a small company? Because to small company various advantages are there. We are going to discuss that, but let's understand this example and then we will move ahead. So ABC Private Limited, it has a paid up share capital of 1.9 crores and a turnover of 18 crores. Now tell me, do you tell this company as a small company? The answer is yes. It is a small company. It is a small company. Now I want to give you another example. ABC Private Limited, a same company, it acquired 60% of equity shares. What they acquired? 60% of equity shares of PQR Private Limited. Okay, so it acquired 60% of equity shares of PQR Private Limited. Because of this, your ABC Private Limited, it became a holding company. It is a holding company. For now, you understand this example. In the coming videos, we are going to learn what is a holding and a subsidiary. And your PQR Private Limited became the subsidiary of your ABC Private Limited. Now, after this transaction, if paid up share capital and turnover remains the same, can you call ABC Limited as a small company now? Is ABC Private Limited a small company? Now, will your answer change? The answer is yes, our answer will change. Why? Because it has become a holding company. And what did we see earlier? Holding or a subsidiary cannot be a small company. So now ABC Private Limited is no longer a small company. I hope this concept is very, very clear. Okay, now as I told you that every year you have to check your balance sheet P&L whether you're a small company or not. So how to do that? Let's see that. I'll give you one example. We'll write financial year here. Then paid up share capital, turnover, whether you're a small company or not. Okay. After this example, your concepts will be very clear. Okay. So the first financial year, that is the balance sheet year. Okay. It was 1/4/20 to 31st of March 21. Okay, this balance sheet we are talking about. As per this balance sheet, the paid up share capital was 1 CR. 1 crore. The turnover was 15 crore. Okay. Now, for the financial year 1/4/21 to 31st March 22. Are you a small company? The answer is yes. Why? Because it is within the limits. 1 crore and 15 crores allowed. Now in the second year, what happened? In the balance sheet of 1/4/21 to 31/3/22, the paid up share capital was raised to 1.2 crore rupees. Okay, and turnover rose to 19 crores. Even though your turnover is within the limit, but do you think a paid up share capital is within the limit? No, the conjunction was and. So both the requirements have to be fulfilled. So now in this year, which year I am talking about? Financial year 1/4/22 to 31/3/23. Are you a small company? Perfect answer. The answer is no. For this financial year, you are not a small company. Going ahead to the third year. What happened on balance sheet of 1/4/22 to 31/3/23? The paid up share capital again came to 2 crore and the turnover came to 19 crores. So again within the limit. So for financial year 1/4/23 to 31/3/24, you are a small company. Clear? So 1 year, if you can check out guys, 1 year you are a small company, another year you are not a small company, again you are a small company. This happens. So as per your last audited balance sheet, you will be deciding that for the next year whether you are a small company or not. Is the concept clear now? Crystal clear, right? Very good. Now we are going to see certain advantages of your advantages of a small company. Before that, let's come to the definition, because many times students ask me, ma'am, what is this? So as I told you that it is defined under section 2 clause 85. What is a small company? Whose paid up share capital does not exceed 2 crores and whose turnover does not exceed 20 crore. Now in your module or somewhere you will be having a different amount. That means 2 crores and after that one more amount, not exceeding 50 crores. Over here not exceeding 100 crores. So ignore that amount. This is a amount 2 crores and 20 crores you have to remember for paid up share capital and turnover respectively. Got it? Great. Now very important. Yeah. A holding and a subsidiary company cannot be a small company. A section 8 company cannot be a small company, and a statutory companies which are registered under special act even cannot be a small company. So please remember. Now we are going to go for the advantages. The first advantage of a small company is filing of annual returns. Now annual return of a small company will be MGT 7A. Okay, and the certification required is either of a director or a company secretary. So any one have to sign. Okay, so either a company secretary will sign it or a director shall sign. Both of their signature is not required. Got it? Now board meeting. I have explained you board meeting in your private limited company. Same like that. For the small company, only 2 board meetings in a year is required. How many? Only 2 board meetings in a year, each in 1/2. Okay, only 2 board meetings in a year, each in 1/2. That is from 1/4 to 30th September, 1 board meeting. Another one from 1/10 to 31st of March, another board meeting. And gap between 2 board meetings should be minimum of how many days? It should be minimum of 90 days. Okay, minimum of 90 days gap is required. What is the normal rule? Normal rule is that the other companies which are not small companies should require 4 board meetings in a year, and the gap between 2 cannot exceed 120 days. So that is a normal rule, but we have to just remember the small company. The next one talks about a cash flow statement. A small company is not required to prepare a cash flow statement. It is not required. Okay. So till now, three advantages we have seen: annual returns, board meetings, cash flow statements. Going to the next one, rotation of the auditors. Rotation of auditors is not applicable to a small company. So small company can have directors continuous. That means in a normal company, which is not a small company, an individual cannot be reappointed after one term of 5 years, and firm cannot be reappointed after two terms of 5 years. So there is some cooling period required in them. But when you are a small company, okay, you are not required to comply this. So you can reappoint your auditors again and again, no problem at all. I hope it is clear, right? Now, one more provision for the small company. When there are two small companies, okay, when there are two small companies, that is A and B, these two small companies want to get merged, okay, and become AB Private Limited. So these are the two small companies, they want to get merged and form AB Private Limited. So for merger or amalgamations, we have sections under Companies Act. But when there are two small companies, our Companies Act has reduced their burden apart from the lengthy procedure. So they are not required to follow the lengthy procedures. But they can get merged by just following section number 233 of Companies Act, which is fast track merger. Okay. So you are not required to take various approvals or no need to go to NCLT. You have to do everything by yourself. That means two small companies can do everything by themselves and then at last surrender the application with the NCLT for the merger. So less provisions are there as compared to the full-fledged merger provisions. So remember, two small companies can be merged together via fast track mergers. Rest all provisions we have discussed already, like section 8 holding subsidiary and all. So please revise the small company, it's very important. You may get a short note on this or a case law on this. So let's start with our next topic, that is holding and a subsidiary company. So let's write down the section number first. For a holding company, it is defined under section 2 clause 46 of Companies Act 2013. And for subsidiary company, it is defined under section 2 clause 87 of Companies Act 2013. So I hope your list is getting ready, right? So now let's understand what is this holding and subsidiary, then we will go to our notes and read the definition of that. So let's start with the holding company. What is a holding company? Holding company means company which is holding over 50% of shareholding in a company. Okay. So what is a holding company? Company which holds, okay, over 50% of shareholding in another company. Okay, this is what is the meaning of this. Now let's understand with the help of an example. Suppose there is Mono Travels Private Limited. We have Mono Travels Private Limited. This Mono Travels Private Limited, it purchased 60% of equity shares. What did they purchase? 60% of equity shares of Tarun Travels Private Limited. Okay, so please understand this. there's a company called as Monu Travels Private Limited. It purchased 60% of which company shares? Tarun Travels Private Limited. So in short, Monu Travels is controlling 60% of shareholding in Tarun. So by this, your Monu becomes the holding company, okay, and your Tarun becomes subsidiary company. Okay, so holding company wherein it holds the control, that company is called as a subsidiary company. Okay, so this is a meaning of holding. So wherein any company holds over 50% of shareholding in another company, it becomes a holding, and the company in which it is controlling or having a shareholding is called as a subsidiary company. Okay. Now let's understand what is a subsidiary company. Subsidiary company will give you a clear idea about a holding. Okay, so more details are given in the definition of a subsidiary company. So as I told you earlier, subsidiary company is defined under section 2 clause 87 of Companies Act 2013. Clear? Okay, so now I will give you certain examples of this. Example number 1, where we have Monu Travels Private Limited. The same example we are going to take. Okay, it acquired 60% of equity shares of which company? Tarun Travels Private Limited. Okay, so Monu Travels acquired 60% of equity shares of Tarun Travels Private Limited. So by virtue of this, we have understood that it becomes holding and subsidiary. But in subsidiary company, you know what is the definition? The first one, which is very important, how can a company be a subsidiary company? It says that wherein holding company is holding at least more than half of the voting power in that company. So what is the first criteria? Company holds more than half of total voting power of the company. Now tell me one thing, which shares has voting rights? Equity shares only. Okay, so only equity shares has voting rights. So how can a company become a subsidiary? If holding company is holding equity share, that is more than half of the equity share capital in the company, then only there will be a holding subsidiary combination. If holding company is holding preference shares, it is not a holding subsidiary. I hope it is clear. Okay, so by virtue of section 287, we can say that a company becomes holding and subsidiary if it holds more than half of the total voting power in the other company. Now look at our example. In Monu Travels Private Limited, it is holding 60% of equity shares of Tarun Travels. Then in that case, Tarun Travels is a subsidiary company and your Monu Travels is a holding company. Right? So this is by the first one. Now second example I'll give you. Again the same company, Monu Travels Private Limited. Okay, it had 7 directors. How many directors they have? Monu Travels has 7 directors. And we have Tarun Travels. Tarun Travels has 3 directors on its board. Okay, now What did Monu Travels did? Monu Travels want to acquire the composition of board of directors in Tarun. So what did they did? From these 7 directors, 4 were appointed here. Okay, so out of the 7 directors, 4 directors of Monu got appointed in the Tarun Travels Private Limited. So how many directors now Tarun has? 4 of Monu plus 3 existing directors, totaling to 7. Okay, now what is the test that Monu Travels is holding the composition of board of Tarun Travels? The test is like this: if the directors of Monu can remove the majority directors of Tarun. So what is the test? If Monu Travels can remove majority directors, Monu Travels can remove majority directors of Tarun Travels, then it becomes holding and subsidiary by way of composition of board. So what is the second one? Composition of board. By control on composition of board of directors. Okay, Monu Travels has 4 directors on board of Tarun. So those 4 directors can remove the majority directors of Tarun. The answer is yes. Everybody got it? Understood? So what is the first one? Company is holding more than half of the voting rights of the subsidiary company. And second, the holding company is holding or controlling the board composition by more than half of that. Okay. Now we have a third example, the third test for this. Example number 3. This is indirect acquisition. Now listen to this very carefully. Monu Travels Private Limited. Okay, it has subsidiary called as Tarun Travels Private Limited. Okay. So Monu over here is a holding company. Okay, and Tarun is a subsidiary company. Now, what did Tarun did? Tarun incorporated one more subsidiary. Okay, its subsidiary. So this was PQR Travels Private Limited. PQR Travels Private Limited. So by this virtue, listen to this. Monu is holding 60% of shares, that is voting rights in Tarun. Tarun is holding 70% of voting rights in PQR. So when Monu is holding Tarun is holding PQR, don't you think Monu is indirectly holding the PQR? I'll repeat, when Monu is holding Tarun is holding PQR, then Monu is holding PQR indirectly. Okay. Now I'll make you understand with the help of very simple example. At your school level, you might have learned this. When A is equal to B, okay, B is equal to C. Therefore, when these two common components are there, A is also equal to C. Answer is yes. Same way, A is Monu, A is equal to B, B is equal to C, right? Therefore, Monu, that is A, is also equal to PQR. So over here, Monu is indirectly holding your PQR. Got it? Clear with this? So these are the 3 ways in which a company can be subsidiary of a holding company. So what was the first one we saw? About more than half of the total voting power. Second, more than half control of composition of board. And third, indirect holding. Okay, these are the three ways of holding and a subsidiary. Now I want all of you to read the definitions to the point. So let's go to our notes. So what is a holding company? We will straight away come to the definition. Holding company holds over 50% of shareholding, but at the same time allows fresh external investment for the balance holding. Okay. Now, as per section 2, clause 46, holding company in relation to one or more other companies means company of which such companies are subsidiary companies. Okay, and this companies also includes a body corporate can be incorporated outside India also. So they have given weird definition of holding company. It says that it is such kind of company of which other companies are the subsidiaries. So when we will learn the definition of subsidiary, the holding subsidiary part will be very clear. So now let's learn the definition under section 2 clause 87. What does your subsidiary company say? It means in relation to any other company, means a company in which holding company controls composition of board or exercise or controls more than one half of total voting power. Okay, either at its own or together with any other subsidiary. Clear with this? Now what is the test of board composition? I told you earlier also, if holding company can remove majority directors of subsidiary company, then holding company is a holding and a subsidiary. Okay, and the third one, last one, it says a subsidiary company can be holding for its subsidiary, no problem at all. And in this case, our principle A is equal to B, B is equal to C. Therefore, A is equal to C applies. Okay, I hope you have understood this. Okay, now let's go ahead. I will tell you there are two kinds of subsidiaries. Okay. Kinds of subsidiaries. First kind of subsidiary we have wherein holding company is holding more than half of the voting power but less than 100%. Where holding company holds more than 50% of voting rights but less than 100%. Okay, so company is not holding 100% of shares in this subsidiary company. Whereas other kind of subsidiary we have wherein holding company is holding 100% of share. So over here, holding company holds 100% of voting rights in subsidiary. Now, where such 100% of voting rights is held, such subsidiaries are called as a wholly owned subsidiary. What do we call them? We call them as a wholly owned subsidiary. Clear with this? Everybody understood? I will repeat this one more time. Okay, don't get confused. Where any company holds more than half of the voting rights, it is called as a normal subsidiary. Okay, and wherein holding company holds 100% of voting rights or 100% of board composition, then it is called as a wholly owned subsidiary. I hope it is clear. So these were the two kinds of subsidiaries in this. Now there are certain compliances to be done by every holding and subsidiary. Certain compliances to be done by holding company. Now, what are the compliances? We are going to see that. The very first one you will understand, it's a consolidated financial statements. What is that? Consolidated financial statement. What does it mean? Now remember our example, okay? Monu, Tarun and PQR. Okay, let's revise it. Monu is holding subsidiary, which is a subsidiary company. Tarun is a subsidiary, and we have a PQR is a fellow subsidiary. Fellow subsidiary means subsidiary is called as a fellow subsidiary company. Now listen to this very carefully. In books of Monu Travels, then books of Tarun Travels, and books of PQR. Okay, so firstly they have to make a consolidated financial statements. Which statement they have to make? Consolidated. Now what is this consolidated? In Monu Travels general meeting or board meeting, okay, various balance sheet will be merged together. So Monu Travels will present two kinds of balance sheet. One is consolidated and another one is stand alone. Okay, so consolidated over here, balance sheet of Monu plus balance sheet of Tarun plus balance sheet of PQR. All three balance sheet will be merged together. That is called as a consolidated financial statements. What about standalone? They need to submit two kinds of balance sheet. Who? Monu Travels. The holding company always have to submit two kinds of balance sheet. One will be consolidated, another one will be standalone. So in consolidated, they will merge all sister concerns, all subsidiary, everybody. Okay. So consolidated in our example, Monu is the ultimate holding company of a PQR. Also it is holding company for Tarun. That's why Monu will make balance sheet of Monu plus Tarun plus PQR. And the another set of balance sheet, let's write little down, which will be a standalone balance sheet. Standalone. So only balance sheet of Monu Travels. So before the shareholders of the company, we have to submit these two kinds of balance sheet, that is one consolidated and another one is standalone. Now is it applicable to a subsidiary company? Let's see that. Now when it comes to books of Tarun, in case of consolidated, do you think we have to make a consolidated for Tarun? The answer is yes, because even Tarun is having one subsidiary. So it will make balance sheet of Tarun plus balance sheet of PQR. So they will merge this two balance sheet. Is Tarun going to merge Monu's balance sheet over here? The answer is no. Hence, subsidiary company is not required to present a consolidated financial statements. Clear? Along with this, it has to submit its own, so balance sheet of Tarun. Now, let's go to the books of PQR. Is PQR supposed to make a consolidated balance sheet? The answer is no. No consolidated balance sheet, because PQR is not holding any company, right? Then it needs to make only and only its stand alone. I hope with the help of this table you have understood that consolidated financial statement is only and only applicable to which company? A holding company. Subsidiary company need not make the consolidated, they have to just submit the standalone balance sheet. Whereas holding company has to submit both sets of balance sheet, One is consolidated and another one is a standalone. Now let's go to the next one. Second compliance. Now second compliance says that your holding company, okay, holding company has to do various disclosures. What disclosures they need to make? They need to make disclosures about its investment, okay, investment in its subsidiaries. Now I know all of you have seen the balance sheet. Which side does this come? It's a asset side, right? So if you have invested the shares, where it will come? In the asset side, because that is your asset. So holding company has invested in the subsidiary company, so it will come in the balance sheet of a holding company, and they need to give details of that in its balance sheet. Along with that, the third one, the third provision says that now holding company also have to give certain disclosures in the P&L as well. So it has to disclose certain things in its P&L. What? Number one, what was a dividend received? Okay, dividend received from your subsidiary companies. And secondly, have you made any provision for losses for your subsidiary company? So these two disclosures holding company needs to make in its P&L. Okay, in balance sheet we have understood. I'll add word balance sheet so it will be very easy for you. And this is for the P&L. Okay, so these are the three compliances which were applicable for the holding and a subsidiary. This is only applicable for holding company. Subsidiary companies need not do any of these compliances. Is it clear? Great. Now I will make you understand one concept called as a layers of subsidiaries. Okay. Layers of subsidiaries. Now what does this mean? There are certain restrictions under Companies Act which says that a company cannot have more than 2 layers of an investment subsidiary. Okay, investment company means what? First, let's understand what is an investment company. Investment company means company whose main business is acquisition of shares and securities. What do they do? Acquisition of shares and securities. This is their main business. They don't do anything else apart from this. Okay, so let's understand these layers with the help of an example. For example, we have Billionaire Private Limited. This Billionaire Private Limited is into manufacturing. So what is the main activity, main function of Billionaire Private Limited? It's a manufacturing. Now Billionaire Private Limited, it incorporated its wholly owned subsidiary, okay, called as Shrutika Private Limited. Now this Shrutika Private Limited is an investment company whose main function is only acquisition of shares, okay. Now Shrutika Private Limited incorporated one more subsidiary called as Mandakini Private Limited. Okay, even this Mandakini Private Limited, it's an investment company. Okay, see, now Billionaire Limited is in manufacturing, but its first subsidiary company is Shrutika, which is an investment company. Its second subsidiary, I can write first over here and this is second over here. Second subsidiary is Mandakini, which is also a investment company. So this has completed its 2 layers. Now it cannot have third layer of investment subsidiary. It can have for any other sector. So Mandakini Private Limited, it can incorporate one more subsidiary, but which is not in investment, which may be in manufacturing, okay, which may be in banking, okay, no problem at all. But if the third layer is an investment subsidiary, then there is a default done by this billionaire private limited. Okay, so what is the rule? Rule says that a company cannot have more than 2 layers of investment company. Okay, this is a rule. A company cannot have more than 2 layers of investment company. Is it clear, all of you? With the help of this rule, just go through this example and you will understand it entirely, no problem. Clear? Everybody understood? Great. Now moving ahead, we are going to see various kinds of important points for your subsidiary company. Important points about subsidiary company. Okay, now what is the first point? Your first point talks about the financial year. Okay, now listen to this very carefully. There is one holding company. Okay, this holding company belongs to France. Okay, this holding company is not an Indian company, it's in France, but they have one subsidiary company in India. Where do they have? In India. Now, as far as financial year of France is concerned, it is for 1st of Jan to 31st of December. I am giving just an example. So, financial year of France is 1st of Jan to 31st of December. That means they will be closing the balance sheet P&L as on 31st of December every year. But what about India? In India, as per Companies Act 2013, it is compulsory for all types of company to follow only one financial year, that is from 1st of April to 31st of March. So we all Indian companies close the balance sheet as on 31st of March. Now, see, there is a clash between holding and subsidiaries balance sheet. Holding company has to present the consolidated balance sheet, and now holding company will have a problem. Why? Because subsidiary is closing its book as on 31st March, whereas holding company is closing its book as on 31st of December. So what can this subsidiary company do? In this case, the subsidiary company can apply to NCLT. Okay. Subsidiary company can apply to NCLT asking for the permission for following a different financial year than given in the act. Okay, so this is application to tribunal for permission to follow different financial year which is same like its holding company. Okay, and if you want approval from a NCLT, you require very strong reasons. Okay, It is not like that ki only subsidiary company should be in India and then only subsidiary can get the approval. Even though we have a holding company in India and subsidiary companies outside India, any kind of company, holding, subsidiary, associate, if they want to match up with their holding subsidiary which is outside India, which has a different financial year, it can apply to the NCLT. NCLT, if it founds correct, if strong reasons are given, then it may approve. Okay, if strong reasons are there, it may approve. Clear? Okay, so this was a very important point, first point about a subsidiary company. Now the second point, a subsidiary company, it cannot be a small company. Subsidiary company can never be a small company. Please remember this very, very carefully. After that, third one, whenever there is a government company which is a holding company of one other company. Okay, let's understand this. There is a government company, this government company is holding company and this company is a subsidiary company. But this other company is not a government company. Okay, this other company is not a government company. But because these companies, holding company is a government company, by virtue of this, your other company will also be treated as a government company. So what is the rule? Rule says a subsidiary company of a government company. So a subsidiary company of a government company shall be treated as a government company. It shall be treated as a government company. Clear? Understood the third point? Now let's go to the fourth one. All these points are given in our notes. Just to make you understand, I'm writing it over here in the form of short notes. So don't worry. If you're writing with me, that's great. But don't miss on the concepts. Okay. So keep your eyes and hand on. And also ears obviously to listen. Now we are going to the fourth one. Now there is a public holding company. Public company which is a holding company and it is holding a private limited company. Okay. So public company is a holding company and private company is a subsidiary company. So by virtue of this, this private limited company shall become deemed public company. What it shall become? It shall become a deemed public company. What does this mean? Do this private limited have to increase the number of directors as per public? No. Do they have to increase the number of shareholders? No. Then what is the difference between a normal private company and a deemed public company? The difference is that your deemed public company, which is this company, it shall not enjoy the exemptions, privileges available to the private company anymore. Why? Because the holding company is public company, that's why. Okay, so deemed public company does not enjoy exemptions and privileges of private company. Clear with this? Understood the 4 points? Okay. Next one. Fifth one. An associate company is there. Okay. Associate company, it is not a subsidiary. Now what is associate company? We are going to learn. Okay. So it is not a subsidiary company. As of now, you remember as it is. Fine. Now we are going to the sixth one. we have a subsidiary company. Okay, now subsidiary company is there. Okay, this company, it cannot hold a single share in holding company. Okay, so subsidiary company cannot hold single share in the holding company. Why so? It's a rule. So in our example, Monu Travels Private Limited was holding a Tarun Travels. So Tarun Travels cannot hold a single share of Monu Travels Private Limited. But there are certain exceptions to this rule also. There are certain exceptions to this rule. In certain situations, a subsidiary can hold shares of a holding company. But this is not in your syllabus, hence we are not going to discuss it over here. Okay. Now, the next one, the seventh one, we have is a buyback of shares. So whenever holding company wants to do buyback of the shares, it should do himself only. So buyback of the shares cannot be done through its subsidiary. So holding company cannot ask subsidiaries to purchase its shares from the open market and then transfer to the holding company. This is wrong. Okay, so if holding company wants to do buyback of the shares, it has to comply with the sections of buyback. Okay, follow the procedure and then do the buyback. It cannot tell its subsidiaries to do the buyback. So buyback of holding company cannot be done through subsidiaries. Okay. After that, now there are auditors of holding company. This auditors of holding company, can they access the accounts of the subsidiary company? The auditors of holding company, can they access accounts of subsidiary company? What do you think? The answer is yes, no. Because holding company has to make a consolidated financial statements. So auditors of holding company are allowed to access the accounts of its subsidiary but not vice versa. Okay, auditors of subsidiary company are not allowed to access the accounts of the holding company because there is no requirement of consolidated financial statements for a subsidiary company. So this was your 8th point. Now, a person can be director in how many companies? If your company law is done, you can answer this. A person can be director in 20 companies. How many companies it can be a director? It can be director in 20 companies. Now in this 20 companies, only 10, that is only in 10 public company he can be a director. Okay, so only in 10 public company he can be a director. So out of 20, only 10 public company he can be a director. Now when you are counting this 10 public companies, you have to count the deemed public also. You have to count deemed public also. So I hope you understood or you remember what is a deemed public company. Let's revise. A holding company is a public company. So public holding company, the subsidiary is a private company. So private company is a subsidiary of a holding company. It is a deemed public company. Such deemed public company is counted in this 10 public companies. So a person can be director of only 10 deemed public companies. Clear with this? Because it is not counted as a private company anymore. Now, next, 10th one. Section number 186. 186 talks about what? It talks about loans, guarantee and investment. So over here, a company will be giving loan to other company or individual. Our company will be giving guarantee to other individual or making investment in the other company. So section 186 talks about company making loan or giving guarantee or making investment. Okay, now let's see what is a provision. The limit of this, you will be learning the limit of this in your Companies Act 2013. Okay, there is some limit, and if you are exceeding the limit, you need to pass a special resolution in the general meeting. But that is not for you. You have to understand over here that when you have a holding company, okay, this holding company can give loan or guarantee. Can give loan or guarantee to its wholly owned subsidiary and without any limit. I'll repeat this. A holding company can give loan or a guarantee to its wholly owned subsidiary. So wherein it is holding 100% of voting rights. Okay, without any limit. So limit of 186 is not applicable to the holding company. So when you exceed the limit, you don't have to convene a general meeting, no need to pass a special resolution in that. Got it? Clear with this? This was a 10th point. Now let's go to the 11th one on the same lines but little different. Again, your section 186 limit will not be applicable in the following case. In which case the limit of 186 will not be applicable? Whenever subsidiary company, okay, subsidiary company taken a loan from bank. Now here we are only talking about a subsidiary, mind it is not a wholly owned subsidiary. So when subsidiary company is taking loan from a bank, and what does bank require? Bank requires a guarantee. Bank requires a guarantee. So this guarantee is given by holding company. Okay, let's understand the transaction. Subsidiary company has taken loan from a bank and holding company is giving guarantee for the subsidiary. What do we mean by guarantee? If subsidiary will default on the due date, holding company shall pay money to the bank. This is called as a guarantee. So for giving guarantee also 186 limit is there, which is not applicable in case loan is taken from a bank by a subsidiary company. Clear with this? Now you'll say, ma'am, what is the difference between point number 10 and point number 11? If you're smart enough, you can find a difference. In 10th point, we are talking about loans and guarantee, both of them, that too to a wholly owned subsidiary. Okay, and in the 11th one, we are only talking about a subsidiary company, that too giving the guarantee. So in the next point, that is 11th point, holding company is giving guarantee only. And the 10th point, holding company can give loan and guarantee, both of that without any limit to its wholly owned subsidiary. I hope this was clear. Okay, so let's move on to the next one, 12th. 12th point talks about your public companies. Okay, it is not relating to holding or a subsidiary, but can public company help any company to purchase the shares? That means, can Mukesh Ambani come to me and say, madam, please purchase our 10,000 share, this is the money. So what the company is doing, company is paying me money to purchase its own shares? This cannot be happen. So public company cannot assist anyone financially, okay, cannot assist anyone financially to acquire its shares, to acquire its shares. But one exception is there. What is the exception? Exception says that when the public company has issued ESOP, when company has issued ESOP, ESOP is employee stock option. Okay, for subscribing to this ESOP, your employee don't have money. So your company is giving loan to its employee. Company is giving loan to its employees for subscribing to the ESOP. It is allowed. But how much is allowed? There is a limit to it. The limit is not more than employee's 6 months salary. What is the limit? Not more than employee's 6 months salary. Clear with this? Understood? So these were the important points about the holding and a subsidiary. We saw the definition, we saw the concept, what are the compliances of holding company. Along with that, very important points of subsidiary, very important from your case law point of view. Now we are going to start with the associate company. Associate company is defined under section 2, clause 6 of your Companies Act 2013. Now what do we mean by associate company? Associate company means wherein one company holds significant influence in other company. Okay, wherein one company holds significant influence in other company. Okay, so this company which is holding a significant influence in the other company will be called as a holding company, and this will be a subsidiary. You can't call it as a subsidiary company because it's an associate company. Now what is the difference between them? Now what is the meaning of the significant influence? Earlier we did not have any measurement for this, but now law has given us measurement which says that significant control means what? Wherein company is holding at least 20% of voting power. Where company is holding 20% of voting power or controlling 20% of board composition. Okay, or it controls the business decision. What is the requirement? It controls business decision. So even though this 20% is not fulfilled, then also it's okay. But what is called as a significant influence? When any company is controlling the business decisions of the other company. So that company which has a control is a holding company. In which it has control, it's called as its associate company. I'll give a simple example. Reliance Industry purchased 20% of stake in the Big Bazaar. So Big Bazaar became the associate company and your Reliance Industries became the holding company. Clear with this? So what is basically a rule? Associate company means a company wherein holding company is holding at least 20% but less than 50%. So what is important? It should be less than 50%. Because if it is more than 50%, it will become a subsidiary company and not an associate company. And we have learned that a associate company is not a subsidiary company. I hope you understood. So associate company means a company is holding at least 20%, that is having significant influence but less than 50%. Then it will be called as an associate company. So let's go and underline in our notes. What is an associate company? In relation to another company means a company in which that other company has a significant influence, okay, but which is not its subsidiary company. It is not its subsidiary company, and companies having influence, it also includes your joint venture. Joint venture we are going to learn in chapter 10. Don't rush now. So what is the meaning of this significant influence? Where control is at least of 20% of voting power but less than 50%, and control of business decisions under an agreement. I hope this is clear. Now this line I want all of you to underline, very important. It is important from the case law point of view. Okay, the control of business decisions under agreement, it has a controversy or a debate. So if it has a condition that a company will be associate even if there is no 20% of the control. So if you are controlling the other business of that other company, you need not require that 20% logo also. Okay, so if you are controlling the business decision, you are a holding company, and in which you are controlling is your associate company. Now we are going to see various compliances which is required to be done by a holding company. Compliances by holding or associate company. Both of them have to do the compliances. Now what are they? The very first compliance, associate company. Okay, listen to this very carefully. This is regarding your section number 188. 188 of your Companies Act talks about a related party transaction. Okay, so whenever there is a contract or a transaction between holding company and a associate company. So there is a transaction between a holding company and associate company. This contract, okay, this contract will be called as a related party transaction. What it will be called as? It is a related party transaction. Clear? I'll repeat. Whenever there is a contract between a holding company and its associate, it's a related party transaction. They have to comply section 188. Okay. Now the second one. Now holding company, when it is making two sets of balance sheet, that is, one is consolidated financial statements and another one is standalone. In its consolidated financial statement, it needs to merge its own balance sheet, that is holding company's balance sheet, plus subsidiary company's balance sheet, and also it will merge associate company's balance sheet. So does associate company require to make any such CFS? The answer is no. CFS is only applicable to holding company and not associate or a subsidiary company. Associate company will be only framing the standalone balance sheet. After that, third one, it talks about a non-cash transaction. Non-cash transaction. What is a non-cash transaction? Non-cash transaction means wherein the money is not involved, where cash is not involved. We call it as a non-cash transaction. Let's understand this with the help of an example. Associate company had borrowed, associate company, it had borrowed rupees 5 lakhs from its holding company. Associate company had borrowed 5 lakh rupees from its holding company. Okay, now the maturity was 1 year. Okay, now this holding company, what did they do? They purchased a set. Okay, they purchased a set from whom? The associate company. Holding company purchased the asset from the associate company. So associate company gave a set. So holding company should have paid cash, right? But what did holding company say? You had borrowed 5 lakh rupees from us, no? So in lieu of this asset, we are taking over that loan. So we will assume this 5 lakh as repaid. So ideally the cash should have transferred from holding to associate, and associate should have repaid that 5 lakh rupees, but this does not happen. For one transaction they settled the other transaction. It's a non-cash transaction. I'll repeat this one more time. Associate company had taken a loan from a holding company of rupees 5 lakh and the maturity was 1 year. Suppose holding company purchases a set from a associate company, then holding company should have paid them. But holding company said your 5 lakh rupees loan we are assuming to be repaid now. Understood? Clear with this? It's a non-cash transaction. Cash did not transfer, right? Now, whenever associate company is doing such non-cash transaction, it needs to do certain formality in its general meeting. So, whenever associate company carries on non-cash transaction, with whom? With its holding company. What it needs to do? In the general meeting, associate company has to hold general meeting. General meeting is that of the members, and it has to pass a ordinary resolution in that. Which resolution needs to be passed? Ordinary resolution in that. I hope you understood this. This were the compliances of your associate company. Now we are going to start with our next topic, that is an inactive company or a dormant company. Now your inactive or a dormant company is defined under section 455 of your Companies Act 2013. So inactive company is under section 455 of Companies Act 2013. Now what is an inactive company? Okay, what is the meaning of inactive company? We are going to understand this first. Inactive company means a company which is not doing any business. Okay, not carrying on any business. Okay, the first one. Second, or. The conjunction is or. It does not have significant accounting transaction. Does not have significant accounting transaction. Or the third one, it is not filing or not filed balance sheet and P&L. Okay, so a company is called as inactive if it is not carrying on any business or not doing any significant accounting transaction or has not filed its balance sheet P&L for 2 years. For 2 consecutive years. So this is important. So a company's business is stopped for 2 years. It's not doing anything. No business. It's an inactive company. It is not having any significant accounting transaction. We are going to learn what is significant accounting transaction. For 2 years, it's an inactive company. And it has not filed balance sheet P&L with the ROC for previous 2 years. It's an inactive company. So what will happen to such inactive company? Such inactive company may be striked off. May be striked off by ROC. Now what is all this? I will understand you. Listen to this very carefully. ROC, that is Registrar of Company, it has a list, that is Register of Companies. Okay, what is this? It's a Register of Companies. So whenever, who has this register of companies? It is with your ROC. So whenever ROC issues certificate of incorporation to any company, it inserts the name over here. So Monu Travels Private Limited Incorporated. So Monu Travels name will be there in the register of companies. Okay, but if Monu Travels is not doing business for 2 years, not doing significant accounting transaction for 2 years, or not file balance sheet P&L with the ROC for 2 years, this name which is included over here, this may be striked off. So when the name is striked off means what? Striking off name, what does this mean? It is temporary closure of company. Striked off means temporary closure of the company. So your bank account will get sealed, and once your company is striked off, you cannot remove anything, you cannot do anything. You have to go to NCLT for reviving the company. Okay, so what does ROC say? In case you have become inactive company, please convert your status into a dormant company if you don't want us to strike off your name. So if company don't want to get itself strike off, what it has to do? It has to convert this kind of company into a dormant company. What is advantage of converting it into dormant company? You will be sleeping for certain years. So even if you're not doing any business, that's okay if you're a dormant company. If you're not doing any significant accounting transaction, nobody will ask you if you're a dormant company. If you're not filing balance sheet P&L, that's okay if you're a dormant company. Understood? So inactive company has to compulsorily convert itself into a dormant company if it is not doing 1, 2 or 3, or is a conjunction. Or is a conjunction. Okay, if it does not, ROC may strike off the company and then it has to pay heavy penalties for that. Okay, so what is our rule? An inactive company may convert itself. It may convert itself into a dormant company. So when you are a dormant company, that is okay, no problem. If you don't convert yourself into a dormant company, ROC may strike off your name. I hope this concept is clear. So till now we have understood what is an inactive company and what we have to do in case we are becoming an inactive company. Okay, now we will understand this with the help of an example. There is one company called as Oberoi Realty Private Limited. Okay, so this Oberoi Realty, it deals into the real estate construction. Okay, real estate construction. So now the company was incorporated by the promoters. Okay, promoters acquired a land. On this land, they are going to make 5 towers of 30 floors each. Okay, this is their plan. So, you know this, whenever any of the company is doing any construction business, okay, the plan, okay, plan is required to be passed by authority called as RERA. Under the RERA Act, you have to pass your plans. So when this promoter send the plan, send the proposal, okay, what happened over there? So the authority rejected the plan. What did authority said? It said the plan is rejected. Okay, it may be passed later on, but for now this plan is not working. Company is there, the land is there. Land is there in the name of company. Now what to do? Oberoi Realty does not have any business, no significant accounting transaction. So it is which kind of company now? Tell me. It is an inactive company. Okay, it became inactive company. Now this inactive company, if they keep it like that only for more than 2 years, ROC may strike off. ROC may strike off. So it's better to convert such an active company into a dormant company. So when you are a dormant company, ROC will not touch your company because you have taken the permission. I don't have a business, so I want to be dormant. This helps dormant company to hold the assets also. Okay, it helps the dormant company to hold the assets. Now let's learn what is significant accounting transaction. What is significant accounting transaction? You can call it as CA is SAT, significant accounting transaction. So if you don't have SAT for 2 years, your company will be an active company. That's why we are learning definition of SAT, significant accounting transaction. So over here, the reverse definition is given. So what does it say? Except of the following. Except of the following, all are significant accounting transaction. So list which they have given, that is not significant accounting transaction. So what is the first one in that? The first one talks about payment of ROC fees. So when you are paying the ROC fees, it's not a significant accounting transaction, right? Even though business is not there, you have to do the company law compliances, right? Yeah. Then fulfillment of any other legal compliance or legal requirement. So if you are fulfilling any other legal requirement, that is not a significant accounting transaction. If you are doing allotment of shares to the shareholders, even that does not amount to significant accounting transaction. And lastly, for maintenance of office records, you are paying fees for that. So these four are not a significant accounting transaction. Apart from this, all others are significant accounting transactions. So I hope this definition is clear. Okay, so now let's go to our notes. Let's underline certain important things. So I have told you what is a inactive company. Please underline the definition. We have done with the SAT as well, significant accounting transaction as well. Now before going to the procedure for conversion, let's go to the important points of the dormant company. Okay, now dormant company, how many directors are required in case of a dormant company? There is no change at all. Just because it is a dormant company, it will not get any privilege for appointment of directors. If OPC is there, then 1 director, private company 2 directors, and public company 3 directors. So this is a director requirement of your dormant companies. Now rotation of auditors is not applicable to a dormant company. Same like your small company? The answer is yes. Now in the financial statements, when the company is a dormant company, we are not going to make a cash flow statement. Now, how many board meetings are required to be done by the dormant company? Now this should be very clear to you now. Only 2 board meetings in a year, right? Each in 1 half. This is a first half, this is a second half. And the gap between these 2 board meetings, minimum of 90 days. Correct? This we have read so many times. After that, if you are not obtaining a dormant company status, then what will happen? ROC may strike off your name as per section 248. Guys, this chapter you are going to learn in part C also, that too in detail. Okay, so as of now we have understood what are the important points relating to a dormant company, what is a dormant company, what is an inactive company. Okay, yeah. So now we are going to the procedure. Procedure for conversion of active company to dormant company. Now remember one thing, very important. Whenever a company is incorporated, do you think ROC will incorporate a dormant company? ROC will tell you, madam, if you know your company does not have any business or is not going to have business, why are you incorporating a company? Understood? So a company cannot be incorporated as a dormant company. Your company is always incorporated as an active company. Which type of company is there? Always it is an active company. But this active company can be converted into a dormant company because of some conditions. Jaise, for example, COVID situation came. Breakdown of industry, breakdown of machinery, no business, what to do? Understood? So a company cannot be incorporated as a dormant company. It is always an active company. But for certain situation, if your business stops, you have not filed your annual written financial statements, if you're not doing SAT, please convert yourself into an dormant company. Now how are we going to do that? We are going to learn. The very first step, I hope you are making the form list as well along with the section list. Okay, so the very first step is application to ROC for conversion of active to dormant. Now we want to convert. So when you want to convert, you have to give an application. In which form? We have MSC1. MSC stands for miscellaneous 1. Okay. So MSC1. This is the form number. And in this MSC1, you have to give the reasons why are you converting. So this was the first step. Now second, if ROC is satisfied, okay, if ROC is satisfied, then it shall issue you a certificate for that. What it will give you? It shall give you a certificate. This certificate will be in form MSC2. The certificate will be in MSC2. So from that day, you are a dormant company. Okay, you need not do many things. You need not file the balance sheet P&L. Okay, instead of balance sheet P&L, we have a written. So third one, when the company is a dormant company, it needs to file written of dormant company. Written of dormant company, it needs to file. Now this written of dormant company, it needs to file with the ROC every year. Okay, so instead of P&L balance sheet, they have to file a written of dormant company. This will be in form MSC3. Form MSC3, and it needs to be certified by a chartered accountant. Okay, practicing chartered accountant or your statutory auditor, it can also certify this. In this form, what are you going to give? You're going to give the details, what all things you have done throughout the year. Okay, and this you need to file. The time limit is on or before, or else you can write like this, within 30 days. Within 30 days of closure of financial year. Okay, so first one we applied in MSc 1, in second ROC gave us MSc 2 certificate, and third we are filing a return of a dormant company. It's compulsory to file this. If you are not keeping up with the compliances, when you will apply for the conversion from dormant to inactive company, ROC may not accept it. Okay, now the next one, fourth. Now your business is on again, so you have to convert first into active company, then only you can start a business. In dormancy you cannot do any kind of a business. Okay, so the fourth one, application for conversion from, now we are getting converted from dormant to active. Okay, so this we need to file in form MSc 4. Okay, you have to file in MSc 4. You have to tell them that we have started our business. And last one, if ROC is satisfied, this we are going to do with the ROC only, no other authority is there. If ROC is satisfied, it shall give you a certificate for that. That means when this certificate is issued, you have been converted into an active company now. Okay, so now you are no longer a dormant company. So these are the 5 steps. This certificate will be in form MSc 5. It's very easy to remember these form numbers because they are in sequence only. 1. Application. 2. Certificate from ROC. 3. Return of dormant company. 4. Dormant to active application. And 5. Certificate in MSc 5. Simple? Yeah. Now we are going to the last step. Okay, last point under this. For how many years a company can be a dormant company? So when a company is converted into dormant, can it be in a dormant stage for years and years? The answer is no. A company can be a dormant company only for 5 consecutive years. Only for 5 consecutive years. So before expiration of this 5 consecutive years, what company has to do? Before expiration of this 5 consecutive years, it needs to convert itself into active company. So before expiry of 5 years, what company has to do? Convert into a active company. Okay. But if company defaults on that, if the company does not convert itself into a active company within that 5 years and 5 years are over, so in case of a default, what will happen? ROC may strike off your name, because as per ROC, if you are dormant for 5 years, more than 5 years, when are you going to do business? And ROC don't like companies which are inactive or dormant for more than 5 years. ROC means law does not like. Okay, so ROC may strike off. Clear with this? I repeat this point one more time, very important. A company can be a dormant company only for 5 years. So with an expiration of 5 years, company has to apply for the active status. If it has defaulted in that, then what will happen? ROC may strike off its name. So that's all with the dormant company for this chapter number 4. Detail of dormant company you'll be learning in the part C. Okay. Now we are going to learn what is a government company. Okay. Government company means where your central government or a state government or both of them together, they are holding at least 51% of paid up share capital of a company. Now let's understand this with the help of an example. What is a government company? We have company called as Zoni Private Limited. Now in this Zoni Private Limited, how this can be a government company? If your central government, it holds 51% of paid up share capital of Zoni, or your state government holds, or both together, okay, how much they are holding? At least 51% of paid up share capital of Zoni. Okay, so when your central government or a state government or central and state both, they are holding at least 51% of paid up share capital of any company, it will be called as what? A government company. So your Zoni Private Limited has become a government company. Now listen to this very carefully. Zoni Private Limited, okay, Zoni Private Limited, which is a government company, okay, it acquired 70% of shares in VRS Private Limited. Okay, by virtue of this, your Zoni Private Limited became the holding company and your VRS Private Limited became your subsidiary company. And what we have learned in the subsidiary important points, that whenever holding company is a government company, the subsidiary shall also be treated as a government company, right? So over here, the VRS Private Limited, this shall also be treated as government company. Is it clear? I'll repeat this one more time. Whenever there is a holding company which is a government company, so a subsidiary of a government company is also treated as a government company. So over here, when Zoni Private Limited acquired 70% of shares in the VRS Private Limited, Zoni Private Limited being a government company, VRS Private Limited also became a government company. It was clear? The definition of government company is clear. Please understand and memorize definition as it is. If you write over here instead of paid up share capital, you write equity capital, your definition will be wrong. So use exact words what is given. Okay, now I want to make you understand one more point. Something called as differential voting rights. Now, what is this differential voting rights? Basically, what is the rule in a company? When one share you are holding, you will get one vote. This is a normal route. Okay, but when company has issued equity shares with DVR, what they have issued? Equity shares with DVR means equity shares with differential voting rights. So there is a difference as to dividend and voting rights. So how is it different? If you are holding one share, how many shares you are holding? One share, which is a differential voting right. If you are a promoter, tell me what you will want. You will crave for dividend or voting rights? Obviously a voting rights. So when you are a promoter, Okay, you want more of voting rights, less of dividend. So for one share you will ask for 0.50%, that is 0.5% of dividend. What about the voting right? You want more voting right, so you will ask 1.5% of voting rights. Understood? The same time, when you are an investor, we just crave for dividend. We don't want to do any business or voting right. We are not interested. So we will crave for more dividend. So when we have one share, we will ask for 1.25 or 1.50% of the dividend. Okay. And voting rights will be reduced. Okay, this is your DVR concept. Elaborately you will be learning in your company law. So I hope you have understood what is a DVR. So whenever, now going back to our concept. Suppose Zoni Private Limited had issued equity shares with DVR. What Zoni Private Limited has issued? Equity shares instead of DVR. Equity shares with DVR. In this case, the definition for the government company will be where central government or state government or both of them together holding at least 51% of voting rights in the company. Okay, so when there is no DVR, then 51% of paid up share capital. When there is DVR, 51% of voting rights in the company. This is how your definition will change. Please remember this. Please understand this very carefully. I hope it was clear. Okay, if you're not clear with this, you can watch this video again. You can just rewind it and watch it again. Clear? Now we'll go to our notes. So what is a government company? Yeah, I forgot about this section. Let's write the section number for this. Okay, it is defined under section 2, clause 45 of the Companies Act 2013. So now as per this, what is the definition? A government company means any company in which not less than 51% of paid up share capital is held by central government or state government or partly by central government and partly by one or more state government. It also includes a company which is subsidiary of a government company. Now in case equity shares are with DVR, what is the definition? Instead of 51% of paid up share capital, we will have 51% of voting power. Is it clear now? Okay. Now, some of you think that a government company can only be a public limited company. Nothing like that. It can be private limited also. It can be public limited also. No problem at all. But not a OPC. Okay, not OPC. Now we are going to learn certain exemptions which are available to the government company. We have read for the private. We have read for the OPC. We have read for the Nidhi company. Now we are going to learn for the government company. Now as far as name of the government company, name of the company shall end with word limited if it is a public limited and private limited if it is a private limited. No problem at all. So for private limited and public limited also, you can just write word limited, that's it. No need to write private limited for that. Got it? Then we can use word state, because now we are a government company and government is holding in our company. So we can use word state. After that, second is transfer of shares. In company law, you might have learned as per section 56, some provisions are not applicable to government company. Whenever a company wants to do transfer of physical share, company or the transferor and transferee, they have to execute a transfer instrument which is in SH4. Okay, there is a share transfer instrument. Transferor and transferee has to execute this. pay stamp duty on this, sign that and give it to the company for the registration. But this is not required if shares are held by nominees of the government. If shares are held by nominees of the government and they want to transfer it, no requirement of transferring SH4, no requirement of executing SH4, just intimate the company, transfer will happen automatic. Okay, so SH4 is not required. After that, for transfer of bonds also, bond is nothing but a debt instrument. For transfer of bond also, no SH4 is required. Okay, so instrument of transfer is not required. Only intimation is to be given about the details of the bond. It is going to get transferred from what person to what person. Okay, so SH4 not required in case of the securities, also not required for the bonds. After that, section 8990 talks about significant beneficial ownership rules. 8990 is not applicable to the government company. Please remember this. So they need not declare who is a beneficial owner. They need not do any of the investigation. Nothing is applicable. Talking about annual general meeting of the company. In case of a government company, AGM can be held during the business hours, same like the normal companies, from 9 a.m. to 6 p.m. It cannot be on the national holidays. And where it can be held? For normal companies, it can be held only at the registered office of the company or within the jurisdiction of the registered office. It's compulsory. But for government company, if it is not in registered office, it is outside the jurisdiction of registered office, that is okay. If that place is approved by your central government. So if central government has told the company which is registered in Delhi, they will have its first annual general meeting in Maharashtra. That is okay because central government has said that. Understood? After that, section 123 talks about declaration of dividend. What is a dividend? It's a share in part of a profit of a company which we pay to our shareholders of the company. Okay. Now, whenever dividends are declared out of accumulated profits, okay, so this provision, we have to do various compliances in that. When you're withdrawing amount from your general reserve or a free reserve, you have to maintain some balance in that. You have to do certain compliances which are not applicable to a government company. Then 123 subsection 4, government company need not submit or need not transfer the entire dividend amount within 5 days of declaration. Generally, when company declares the dividend, it has to transfer the dividend amount which is to be paid to the shareholders to a dividend, that is new account, escrow account, within 5 days of declaration. This provision, government company need not be doing it. Okay. Then accounting standard 17, there is certain exemption given under this. The companies which are into the defense, okay, they are into the defense production, they need not do various disclosure. Then there are certain exemptions from the disclosure requirement also. 134 talks about your director's report. Okay. In that director's report, you need not disclose certain things. What are those things? You need not disclose the company's nomination and remuneration policy. Now, what is all these things? See, there are various committees in a company. Audit committee who takes care of the auditors, their appointment qualification. NRC committee, which is nomination and remuneration committee, who takes care of the directors, their remuneration, their role, responsibility, etc. So, this NRC committee will be formed by government company, but the policy by which the directors are appointed, their pay, remuneration need not be disclosed in the director's report. That is okay. Then appointment of more than 15 directors. I had taught you that company can have maximum 15 directors. If you want to exceed 15, you have to convene a general meeting and pass special resolution. So when government company wants to exceed this number beyond 15, it need not pass a special resolution. This is exemption given to the government company. After that, for appointment of independent director, we have section 149 subsection 6 clause A, which tells you the definition of a independent director. Who can be independent director? So in that first points come is board thinks expert. That means whoever your board of director thinks he is expert to become an independent director will be the independent director. Now we are going to talk about a government company. So instead of that board, we are going to replace the word particular department of central government or any of the administrative authority or state government, whoever is taking care of that. So your board will not be ruling, but your government will be ruling. So any person who is fit for a ID, that is independent director by your government, he can be an independent director. After that, whenever we appoint a director, we require consent, yes. Okay, but when government, that means the central government, okay, appointment is done by central government or a state government, company is no longer required to submit the consent form with the ROC. Normally, we file the consent form with the ROC within 30 days of appointment, but when directors are appointed by central government or state government, we need not file the consent form. That is okay. Then right of person other than retiring director to stand for the candidature does not apply to the government company, neither to its subsidiaries also. Why? Because government will appoint, no, nobody else has right to stand for directorship. After that, appointment of directors individually. See, all the directors in the company, say for example, we have Mr. A, B, C. These three are going to be the proposed directors. And for that, the resolution is in motion. Okay, so for these three, how many resolutions you will make? Ideally, you should make 3 resolutions. So, more than one director cannot be appointed via single resolution. Why? Because I like Mr. A, but I don't like Mr. B and C. So, if all these 3 are put under one resolution, how am I going to choose? It's difficult, right? So, in other companies, apart from government companies, we cannot appoint more than one director via single resolution. So each director will be appointed only by single resolution. Clear with this? Understood? But for government company, this section is not applicable. So it is not applicable to government company, also its subsidiaries. Along with that, the proportional representation is also not applicable. What is proportional representation? It is one type of method of appointment of directors. This you will be learning in your Companies Act. After that, we have disqualifications of directors. I will show you this point here. This is regarding your disqualification. Disqualification of director means what? A person is not eligible to be director of a company, that is disqualification. It is given under section 164 of Companies Act. So entire 164 is not exempted. Only 164 subsection 2 is exempted. Okay, for a government company. Now what is the subsection 2? I will tell you that. Now, there is any company which has not filed its balance sheet or annual return with ROC. Okay, for how many years? For 2 years, 2 consecutive years. Okay, so when any company has not filed balance sheet P&L with ROC for 2 consecutive years, so whoever are directors of this company, okay, directors of this company, they shall be disqualified. Okay, disqualified for appointment in any other company. Appointment in any other company and disqualified for reappointment in defaulting company. Clear with this? I'll repeat this one more time. Whenever any company has not filed its balance sheet P&L with ROC for 2 consecutive years, the directors of that company are disqualified from appointment in any other company. They cannot be appointed in any other company because they are defaulting directors. Also, they cannot be reappointed when the term gets over. They cannot be reappointed in the defaulting company also. Clear with this? And this disqualification goes on for a period of 5 years. Okay. So this is one subsection 2. Now this particular rule entirely is exempted for a government company. So government company need not comply this. So even if government company has not filed its balance sheet P&L, the directors will not become disqualified. I hope it was clear. Okay. Now, next one. Your government company need not keep the register of directors or KMPs, also their shareholding. And government company need not keep it for the inspection also, because all these are not applicable to the government company, but they are applicable to the subsidiary of a government company. After that, there are certain committees, as I told you, audit committee and an NRC committee. Okay, this committee government company has to make. Okay, but certain rules of this company is not applicable. So when we talk about the audit committee, what all things are not applicable? Now these sections are there. I know you will get confused, so I'll write the points over here which are not applicable to government company. Government company has to make audit committee, they have to make the NRC committee, but audit committee and NRC committee need not do these things, they are exempted. Okay. So audit committee need not frame policy for appointment and remuneration of auditors. Why? Because the auditors of government company are appointed by Comptroller and Auditor General of India. Okay. After that, the NRC committee. NRC committee also, they need not make the policy. Need not make policy for appointment and remuneration of directors of the company. No required to make. Then no evaluation of director is compulsory. Directors evaluation, they need not do it. It is not compulsory for the government company. And lastly, the remuneration of directors, they need not be disclosed. So no disclosure is required. Generally we disclose the remuneration of directors in the director's report, but for government company we will not be disclosing the remuneration of a directors. Clear with this? Okay. Now there is section called as loans to directors. Okay, that is section number 185. 185 is relaxed for the government company. So if government company fulfills certain condition, it can give loans to its directors, no problem. Okay. After that, we have section 186. 186 talks about company giving loan to other company, company doing investment in other company, company giving guarantee to other company. Now there is limit for that. I told you there is a limit. The limit is 60% of paid up share capital plus free reserves plus securities premium account, or 100% of free reserves and securities premium account. This you will be learning in your company law. But for now you remember this much. If you exceed the limit, if within the limit, board meeting and board resolution is enough. for doing any loan or guarantee or investment. But when company is exceeding the limit, in case of exceeding of limit, you need to convene a general meeting and pass a special resolution. But when you are a government company, you need not pass a special resolution in general meeting even though you are exceeding the limit. So no need to pass a special resolution. Clear? Then going to the next, related party transaction. I will explain this in our notes because diagrams makes very easy to understand, right? Yeah. Now this is section number 188. How much is applicable, I'll tell you. The first transaction, listen to this very carefully. Whenever there is a contract between two government company, there are two government company and there is a contract, and these two government company are related parties. Now what is related parties? This all details you will be learning in your company law. For now you understand, when there are two government companies which are related parties entering into contract, then this transaction, ideally it becomes a related party transaction. So which transaction it is? It's a related party transaction. So when it is a related party transaction, generally we need to convene general meeting and pass special resolution for that. But just because these two are government company, no need to pass special resolution in general meeting. This is a first exemption. Okay. So when two government companies are related parties, even though they enter into a contract, they need not pass a special resolution in the general meeting. This is the first exemption. Now, what does the second exemption say? When an unlisted government company enters into a transaction with other company. Other company means it is not a government company. Okay, so when unlisted government company enters into a transaction with the other company, and these two parties are related parties. Okay, so it becomes what? By virtue of that, it becomes related party transaction. The transaction between unlisted government company and other companies are related party transaction. So ideally they should convene general meeting and pass special resolution. Yes. So what is the rule? Convene GM and pass SR. Now this GM and SR will not be required. GM and SR will not be required if central government approves the contract. If central government approves the contract, no need of general meeting, no need of passing SR. I'll repeat both this one more time. The first exemption says that when there are two government companies which are related parties and they enter into transaction, even though it's a related party transaction, but still no need of passing special resolution in general meeting because they both are government company, that's why. But in the second point, whenever any unlisted government company, mark my words, unlisted, when company is a listed government company, you will not get this privilege. Okay, so when it's an unlisted government company, it is entering into transaction with other company which is not a government company, and when these two parties are related parties, it becomes a RPT. When it's RPT, GMSR is required. GMSR will not be required if your central government approves that contract. Clear? Understood? So these were the few exemptions of the government company. We have other exemptions as well, but that we will continue in the next part. So now we are going to start with exemptions of government company only. In last video we seen certain exemptions and now we will continue with that. Okay, now government company has certain exemption as far as your managerial personnel appointment. Now who all are the managerial personnel? Who all are your managerial personnel? Managerial personnel, I mean your managing director, your manager and a whole time director. Only these three are your managerial personnel. Okay, so what are the exemptions under section 196? We are going to see that. The first exemption says that a government company is exempted from the term of your managerial personnel. Okay, so term of MD, manager, WTD can be more than 5 years in a government company, no problem. So need not comply with the requirement of term of not exceeding 5 years at a time. Clear? The first requirement. Now the second requirement says that they don't require the board resolution or the members resolution if you don't have the adequate profits in the company. Okay, so whenever your appointment of managerial personnel is not as per schedule 5, you have to take the board meeting, board resolution, general meeting, special resolution. This requirement is not applicable for the government company if central government or state government appoints the managerial personnel. After that, for appointment of managerial personnel, company has to give details of managerial personnel in the notice of the general meeting and the board meeting. So this details is given in schedule number 5. You will be learning that in your Companies Act. But this notice requirement is not applicable to the government company. Then once company appoints any of the managerial personnel, it needs to file form MR1 within 60 days of their appointment. So government company is not required to file this form as well. Okay. Now suppose government company already had a MD, WTD manager and their term is exceeding and their term is getting over in the annual general meeting, wherein their proposal is there to reappoint them. Okay, suppose I was MD of a government company and my term is getting over in this AGM, but government company proposes me to reappoint again. But unfortunately, I did not get appointed. So managerial personnel did not get appointed in that AGM. So this will not nullify all the acts which I have done before the appointment, because at that point of time my act or my term was valid term. So where MD WTD manager is not approved by the company at general meeting, any act done by him before such approval shall not be deemed to be invalid. So whatever acts I have done will be very much valid. So this was section 196 exemption. Now we are going to section 203 exemptions. Now 203 talks about your KMP, key managerial personnel. Now what is a key managerial personnel? Key managerial personnel list is here. They includes MD, WTD, manager, CFO and a CS. Please remember this list. MP includes only 3. MD, manager, WTD. And KMP includes 5. MD, WTD, manager, CFO and a CS. Okay. So as per section 203, all the listed company and all the public companies whose paid up share capital is more than 10 crore, they have to appoint a KMP. So now when your government company is having this threshold, when your government company is a public company and the paid up share capital is more than 10 crore rupees, even they have to appoint a KMP, the answer is yes. But as a KMP, they are not required to appoint MD, WTD or a manager. So provisions of 203 shall not apply to MD or CFO or manager. Okay, also to the WTD. So now only 2 people are left in the KMP. your CFO and a CS, right? So their appointment, if they are crossing the threshold, the appointment is compulsory, and all the rules of 203 will be applicable to CS and CFO only. Okay, clear? Yeah. Now we are going to the auditor's appointment. We'll be learning through our notes. Appointment of auditor in government company. Okay, first of all, we'll talk about the first auditors of the company. The first auditors of the company will be appointed by the Comptroller and Auditor General of India. Who will appoint? Comptroller and Auditor General of India. Okay, we can write it as C and AG also. Please remember this. So first auditors of your government company will be appointed by whom? CNAG, that is Comptroller and Auditor General of India. They have to appoint them. The first auditors are to be appointed by them within 60 days. Within 60 days of incorporation. Okay. Now suppose they fail. In case of failure, CNAG was not able to appoint the first director within 60 days. Now what? Then next opportunity goes to board of directors. So next your board of directors can appoint your first auditors of company. Okay, and they have to appoint them within next 30 days. Okay, so this is how your first auditors of the company are appointed. Okay, now what is that tenure? Tenure of first auditors. Tenure of first auditors is till conclusion of first annual general meeting. Okay, till conclusion of first annual general meeting of the company. So once your AGM ends, your term of auditor also ends. Now in the AGM we have to appoint a subsequent auditor. Second one talks about appointment of subsequent auditor. Now your subsequent auditor is also appointed by CNAG every year. Okay, who appoints? CNAG only appoints. And what is the time limit? The time limit is within 180 days from commencement of financial year. Within 180 days from commencement of financial year. So our financial year commences by 1/4. So within 180 days of 1/4 they have to appoint a subsequent auditors. Now what about the tenure of such auditor? The tenure of such auditor shall be conclusion of the next AGM. Till conclusion of next annual general meeting. Okay, so this was about your appointment of auditors. Now we are going ahead to the role of auditors. These auditors who are appointed, what shall they do? They shall check the affairs of the company, check the balance sheet, check the P&L, check the records, everything. Okay, and then they will have to make a audit report, or you can also say auditor's report. What do they make? Auditors will make a audit report and then submit this. They have to submit this auditor's report to your CNAG, the Comptroller and Auditor General of India. Now, Comptroller and Auditor General of India, what they will do, it will verify. Okay, I'm writing in the next page. Once verification is done, if it thinks some fishy transaction is there, okay, something which is not included, some scam is there, it may order a supplementary audit. Okay. After verification, in case of some doubt, CNAG may order a supplementary audit. Supplementary audit. Now, what is supplementary audit? The first audit which was done by auditors of the company, this supplementary audit will be in detail done by whom? This audit can be done by officers appointed by CNAG, okay, or the statutory auditors of the company. Whatever CNAG will decide, you have to do that. Okay. Okay. See, what did we do till now? Let's revise it. Auditors will make the auditor report. It will submit to the CNAG. CNAG shall verify, and if they think there is some doubt, fishy transaction, scam, it may order for a supplementary audit. Now, supplementary audit once done, okay, these auditors who are doing the supplementary audit, the report will be sent to whom? The CNAG again. Okay. Now, in annual general meeting of the company, in front of shareholders, what all things should come? Okay. In front of shareholders, these many things should come. First of all, auditor's report, original one. Okay. Second one, supplementary audit report is required to be given. So, supplementary audit report. And third one, CNAG, whatever reasons they gave while declaring the or ordering the supplementary audit, you have to give that as well. Okay. So, comments of CNAG. So, all these things we need to put before the shareholders in the annual general meeting of the company. Okay. After that, now the last part talks about the annual return. Annual return of government company. Now it is responsibility of every government company to file annual report, that is annual return, with whom? With two houses of parliament, in case your company is held by central government, or state legislature, in case your company is governed by state government, or in third case, both of them, if both of them holds control in you. So annual return should be submitted. Now when? What is the time limit for submitting this? For submitting this annual return, it is within 3 months of annual general meeting. Within 3 months of annual general meeting. Okay. So annual return of a government company has to be submitted before both the houses of parliament, that is Lok Sabha, Rajya Sabha, or state legislature, or both of them, within 3 months of conclusion of annual general meeting of the company. Okay guys, with this we complete all the exemptions, all the privileges of government company, and also we complete the chapter. Now let's see some of the case laws. Okay. So the very first one, this was asked in the paper, little it is twisted but not so difficult. Paid up capital of PKA India Private Limited is 20 crore. Okay, consisting of 150 lakh fully paid up equity of 10 each. That means the equity is 1500 lakhs, right? And 50 lakh fully paid up cumulative preference shares of 10 each. So 50 lakh is into 10, 500 lakhs totaling to 20 crores. I hope everybody got this. Now, PK India Capital Private Limited and PK India Teleservices Private Limited. These both are holding 55 lakhs and 25 lakh equity shares each in PK India Private Limited. So how much they are holding equity? They are holding 55 lakhs. 55 lakhs equity means 550 plus 25 lakhs means 250. Coming around 0, 10, 8, right? 800 lakhs. So out of 1500 lakhs, 800 lakhs is held by whom? PK India Capital Private Limited and PK India Teleservices Limited. Is it clear? Great. Now, PK India Capital Private Limited and Teleservices Private Limited, these are the subsidiaries of Lord Krishna. Okay. Referring to provisions of Companies Act, examine whether PK India is subsidiary of Lord Krishna. So, first question, whether PK India is subsidiary of Lord Krishna. Directly it's not subsidiary, but it's an indirect subsidiary. I hope you remember I had taught you if A is equal to B, B is equal to C, therefore A is also equal to C. So when PK India Capital and PK India Teleservices are holding PK India, then PK India and Capital and Teleservices are subsidiaries of Lord Krishna. I will show you this connection over here. Don't get confused. See, PKA India Capital, okay, plus PKA India Teleservices, okay. These two are the subsidiaries of PKA India. I'm very sorry. These are subsidiaries of Lord Krishna Private Limited. Right? Yes. So, both of these are also holding in PKA India Private Limited. How much they are holding? So first we have to decide whether these two are holding company of PK India. If these two are holding, then PK India shall become indirect subsidiary. It shall become indirect subsidiary of Lord Krishna Private Limited. So PK India is holding 550 lakhs and Teleservices is holding 250 lakhs. So how you have to do the cross multiplication? Listen, for counting holding and subsidiary, only voting rights are important. We have read in the definition of the subsidiary, right? More than half of the voting right, then only it is holding and subsidiary. So we are not going to take your preference share capital into consideration. So we have to only count equity. So what is the total equity? Total paid up equity is 1500 lakhs. Out of 1500 lakhs, 800 lakhs is held by PK India Capital and TV Services. So if 1500 lakhs is 100%, how much is 800 lakhs? Simple cross multiplication. So I will just check how much it is coming. It is 800 into 100, right? Divided by 1500. Okay, it's coming to around 53.33%. Okay, so 53.33 is more than half of the voting rights. Yes, so answer is yes. These two are the holding company of PKA India. Okay, so when these two are holding company, indirectly Lord Krishna is also holding PK India Private Limited. So the first question, examining whether PK India is subsidiary of Lord Krishna, the answer to this is yes. Okay, now the second one, would your answer be different if Lord Krishna have total of 5 out of 7 directors of Board of Directors of PK India? So first, they are holding more than half of voting rights, and in the second question they are holding by board composition. So both of the cases Lord Krishna is holding PK India Private Limited. Okay, now how to write answer? You have to write the definition first of all. So definition of your subsidiary company, where it controls composition of board more than one half of the total voting rights. Okay, so for counting total voting rights, look at the calculation, only 1500 lakhs, correct? So total 800 lakhs is there. So what is the first one? Lord Krishna exercise controls more than half of PK India Private Limited together with its subsidiary. So PK India becomes indirect subsidiary of Lord Krishna, the first. Second answer, even if Lord Krishna would have right to appoint 5 directors out of 7, answer would remain the same. However, under this circumstance, PK India becomes direct subsidiary of Lord Krishna. So in the second case, PK India has become the direct subsidiary of Lord Krishna. I hope you understood this. Okay, and if you want, you can refer the calculation one more time. You can take the screenshots, no problem. So I hope you have understood this. Let's go to the next question. ABC was incorporated on 11 December 2018 as a government company with the main object to provide examination services to public sector undertakings where employees are recruited through advertisement. Okay, so ABC was incorporated on 11 December 18 as a government company, and what is the main object? For the advertisement purposes, for the recruitment of employees. Secretary Education informed MD that there are recent changes with respect to active company tagging identities and verification. Okay, so comment about applicability of active company with respect to ABC Limited. Now listen to the answer very carefully. What does your 25A of your incorporation rule says? Every company incorporated on or before 31st December 2017, it was compulsory for them to file particulars from active company. Understood? When they had to file? On or before 15 June 2019. But following companies were exempted from filing active form. Which companies? Companies which was struck off, under process of striking off, under liquidation, which was amalgamated or dissolved. Okay. Also, any company who has not filed financial statements or annual return, okay, they cannot file this form unless they complete their financial statements. But our company was incorporated after December 31, 2017. So such government company is not required to file active form. Is it clear? Now the previous question you are saying this was an additional compliance was only for 1 year. That's why this is not in your syllabus, but in case it is asked, we have discussed. Okay. Now, PQR was incorporated as government company. The authorized share capital of company is 15 crore. Okay. Paid up share capital is 3 crore. So, what are the provisions of section 203 of Companies Act are applicable to government company with respect to the KMPs? So, looking at the authorized share capital and the paid up share capital, we have to decide whether 203 shall be done by government company or it is exempted. What does it say? It is compulsory for all the companies to appoint a whole time KMP. Okay, and it also becomes compulsory for listed company and every other public company who has paid up share capital of 10 crores or more to appoint a full-time KMP. Who can be a full-time KMP? MD, CEO, manager, company secretary or CFO. Okay, but our paid up share capital is only 3 crore. Is it compulsory for a government company to appoint a full-time KMP? The answer is no. Also, government company has various exemptions, even that we have to write. Okay? Yes. It is not required to appoint a KMP. Is it clear, guys? Yeah. Now we will see various questions. Yes. Now, the first one we have already discussed. Okay, so we'll directly go to the second one. 43% of paid up share capital of Pinky is held by central government. 8% is held by LIC and UTI. Okay, so 43% is held by central government and 8% by LIC and UTI. Analyze definition of government company and whether LIC is government company or not. Over here it's Pinky Limited and not LIC. Okay, don't get confused. Yeah, so 43% is held by CG. And don't you think LIC and UTI both are indirectly held by the central government? Yes. Okay, so even this indirect holding will be called as a government company. As in the constitution, you have read the definition that wherever your central government or state government is holding, even that becomes a government. Understood? So for this case, Pinky Limited is a government company. It is a government company. Understood? Next. This is very interesting case. Alpha holds 75% of equity capital of Delta and control composition of board of directors of Delta. Okay, so there is a company called as Alpha. It is holding 75% of Delta. So I can say Alpha is a holding and Delta is a subsidiary. Then Alpha goes for public issue for raising further capital. Board of directors of Alpha allot 10% of issue to Delta. So, Alpha is giving 10% to Delta. Can subsidiary company hold even a 1 share of holding? Answer is no. So, this 10% is not valid. Okay, whatever allotment is done by board, it is not valid. Then, referring to provision of Companies Act, examine the validity of board decision to allot 10% of shares to Delta. Okay, Delta, so the first answer is no, it is not valid. Now second, Delta holds certain number of share as legal representative of deceased member of Alpha. okay, and has right to vote in general meeting of alpha in respect of such shareholding. I have given you certain exemptions where subsidiary is allowed to hold shares of holding. So one of the exemption is subsidiary can hold shares of holding as a legal representative of deceased member of the holding company. Understood? And because of that holding, Delta has right to vote in the general meeting of Alpha. It is valid. Okay. So will this right be affected by issue of 10% of shares by Delta? Answer is no. If Alpha is giving 10%, it is not valid only. How it is going to affect the right? I hope this is very clear. Yeah. Third, Cupcake Private Limited has its paid up share capital of 45 lakhs and turnover is 10 crore as per last audited balance sheet. Examine provisions of a small company and we have to decide whether it is small company or not. The answer is yes, it is small company. What do you think? It is small company or not? Go to the definitions. Definition says that the paid up share capital has to be within 2 crores and turnover 20 crores. So both the conditions are satisfied. It is a small company. Okay. Then Mello is interested in obtaining status of dormant company as they have not been carrying on operation past 2 years. Explain enabling condition to be fulfilled for applying for the dormant company. So you have to tell them what all things you have to do, like we have to file all our past financial statements. So all these conditions will be there. Also remember, this will be learning in detail in chapter number 19. So over there conditions are there. So right now you don't bother about it. Okay. Then ABC is a company incorporated under Companies Act. Paid up share capital is held as under Government of India 20, Andhra 20, Tamil Nadu 10, Maharashtra 10. Explain the provisions of Companies Act and state whether said company will be government company. Also state whether employees of government company can claim their salaries from Government of India. So what is the first question? Whether ABC Limited is government company or not. See 20 plus 20 40 plus 10 50 plus 10 60. And what is the definition of government company? As per section 2 clause 45, central government or state government or both of them together, right? So over here CG plus other state government are holding together 60% of paid up share capital, hence it is a government company. Clear? First question. Second, it says that employees of government company can claim their salaries from Government of India. The answer is no. Because government company is not a public sector undertaking. Okay, hence, please remember, employees of government company shall not be employees of government. Okay, employees of government company are not employees of government, hence they cannot claim salaries from Government of India. Is it clear? Understood? So this was your chapter number 4. Okay, so I hope you are done with chapter number 4. You have solved the case studies as well. Now let's begin with our chapter number 5. Okay, so chapter number 5, basically the name of our chapter is Formation of Limited Liability Partnership. So in this chapter we are going to learn about what is LLP. Okay, in chapter number 1 we have already discussed the basics of LLP. Also we had seen the difference between the partnership and LLP. I hope all of you remember that. Okay, so before beginning this chapter, let's understand what is the weightage of this. From your exam point of view, the weightage is 5 marks. Okay, how much is the weightage? Weightage is 5 marks. Okay, this is very easy chapter, and I don't think so any one of you may find difficult to understand this, because basics of this we have already studied. You may also study in your college level. Okay, so in this chapter, what are we going to learn? We are going to learn what is an LLP, the characteristics of LLP, how to form LLP, and how your LLP is registered under LLP Act 2008. Okay, and if you want to alter the LLP agreement, how to alter the LLP agreement. So this all things we are going to learn in this chapter. Before that, let's learn basic of LLP one more time. Okay, so what is basically an LLP? LLP is your limited liability partnership. What is an LLP? It's a limited liability partnership. Now, which act governs this? This is governed by the LLP, that is Limited Liability Partnership Act 2008. So, is your Partnership Act 1932 applicable to the LLP? The answer is no, it's not applicable. So, which act is applicable? It's LLP Act 2008. Okay. So, what is basically an LLP? Let's understand that. What is a feature of your partnership? In partnership, two or more persons were required for doing a business, right? Okay, but the liability over here was unlimited liability. Okay, so the partner's liability was unlimited liability. In partnership also there was sharing of profits and losses, right? So your LLP is based on the partnership. Okay, your LLP is based on the partnership. The main disadvantage of partnership was unlimited liability. Okay, this unlimited liability was the main disadvantage of your LLP. So what they have done is, LLP is equal to your partnership only. Few concepts or few features of partnership are taken, plus few features of your company are taken. Both put together is a LLP. So which feature of partnership is taken? In partnership, we require two or more partners. The answer is yes. Over here also we require two or more partners. Over here the owners and managers are the same concept. Owners and managers are the same. They will manage their own fund. They will be the owner of the business. Okay, they will be sharing profit and losses. Same concept. Okay, so same like partnership only, but what is different? They have taken a feature of corporate status from the company. Okay, so company has which feature? It has a corporate status, a distinct entity apart from its partners. So LLP has its own status. Its existence is not dependent on any partner. Okay, so even though all the partners die, all the partners turn insolvent, unlike partnership, we cannot shut down the shutter of our partnership. We cannot do that. What we need to do, we need to legally close down the LLP, only then it can be wound up. So it is formed by the law and it will be wound up by the law. Okay, so it has a corporate status. Also very important, we discussed the disadvantage of partnership was unlimited liability, because of which many foreign parties, many people from the foreign country, they want to do direct investment in India, but they hesitated. Why? Because they did not want it unlimited liability. But now LLP has opened doors for them by giving a feature of a limited liability. I have very well explained you what is the meaning of this limited liability. Even though LLP faces huge losses, partner's liability will be restricted to the amount of contribution which he has agreed to pay to the LLP. Once he has paid his part of contribution, he is not supposed to give a penny to the LLP. So this is your limited liability concept. Okay, and now I hope you have understood the difference between the LLP and a partnership. Still one more time we'll be writing the difference. Okay, so let's write the distinguish between the partnership and your LLP. Okay, the first point of difference between the two is the applicable law. So for partnership we have Indian Partnership Act 1932, and for LLP Indian Partnership Act is not applicable, but we have Limited Liability Partnership Act 2008. Don't write shortcuts in your exam, please. After that, who is a nodal officer? The regulatory officer. For partnership, we have registrar of firm, and for LLP, we have ROC, that is registrar of companies. Okay. After that, talking about the liability of the partners. Over here, members are not there, so obviously liability is that of a partner. So in partnership, they have unlimited liability, whereas in LLP they have limited liability. Okay. After that, the acts of the partner. This is a unique point, very much important. See, in partnership, all the partners are liable for acts of each other. So if there are three partners, A, B and C, A has done some act, he'll be binding B and C by his act. Okay, but in LLP it does not happen like that. Limited liability partnership has its own status. So over here, partners will bind the LLP by his act and not the remaining partners. So for act of Mr. A, who is a partner of a LLP, B and C, the other partners, are not responsible, but LLP itself is responsible. I hope you understood the difference between the two. So in partnership, one partner binds another partner by his act. Okay, but what about the LLP? In LLP, partner binds LLP by his act and not its partners. Clear with this? Understood? Now there is one exception to the rule as far as your limited liability is concerned, very important. We have seen that the liability of partners is limited as far as LLP is concerned, but there is an exception to the rule. Okay, what do I mean by exception? In this cases, the liability will not be limited, but it will be unlimited liability. So in which cases partners liability is unlimited in case of LLP? It will be when your LLP is incorporated to defraud the creditors. Okay, what is the main intention? To defraud the creditors, your LLP is incorporated. So the main purpose of LLP is not legal, because defrauding someone itself is not legal. So in this case, the liability of all the partners will be unlimited. Okay, so in above case, liability of partners shall be unlimited. I hope this is clear. This was exception to point number 3. Now the next point, the existence. Okay, existence of partnership is dependent upon its partners. Okay, so existence is dependent on its partners. So it does not have a feature of a perpetual succession, whereas LLP has a feature of perpetual succession. Now what do I mean by this? Partners may come, partners may go. Okay, it does not affect the LLP. LLP is formed by the law and LLP will be wound up by the law. Clear? Got it? So this was a main difference between the two, that is your LLP and the partnership. Now let's begin with the characteristics of LLP. What are the characteristics of your LLP? The very first characteristic of LLP is it has a separate legal status apart from its partners. This we have already discussed many times, right? So LLP has separate legal entity, just like your company. Okay, just like a company, even LLP has a separate legal entity apart from its partners. Second, as it has a separate legal entity, it can hold property in its own name. So LLP can hold property in its own name. No need to purchase a property in name of a partner. It's not required. What happens in the partnership? Even though a property belongs to the partnership, but still they are in the name of the members or your partners. So when the partnership is wound up, what happens? Partners divide the asset among themselves. But this is not the case in case of LLP. Why? Because in LLP, asset belong to the LLP. So when LLP is wound up, the assets will be sold and then it will be realized. Liabilities will be paid off and balance money will be paid to the partners. It is not like on the winding up of LLP, all the partners can divide the asset of LLP. No, it does not happen like that. I hope it is clear. Now the third one, the liability is limited. Liability of partners is limited. But I have told you one exception. What is the exception? Whenever the intention of LLP, that means incorporation of LLP, was just to defraud the creditors, in that case liability of all the partners will be unlimited. Yeah. Now fourth one, minimum and maximum number of partners. Minimum and maximum number of partners. Everybody knows for formation of LLP, minimum partners required are 2. So LLP cannot be formed by one person. That's true. We require at least 2 people to form an LLP. What about the maximum members? Please listen to this very carefully, little different concept. As far as your maximum numbers or maximum partners, okay, your LLP is silent. LLP Act does not talk anything about the maximum number of partners for LLP can have, but your company law is not silent. Okay, so as per Section 464 of your Companies Act 2013. Okay, Section 464, read with the Incorporation Rules of Companies Act 2013. It says that any association of person, what does it say? Any association of person. It can be partnership also, it can be LLP also. Okay? Cannot have more than 50 partners. Okay? So any association of person cannot have more than 50 partners. If there are partners exceeding 50, okay, there are partners exceeding 50, such organization, such LLP or such partnership will be called as what? It will be illegal association. It will be illegal association. So it says that more than 50% cannot be there in any association of person except of company. Okay. Exception to this is company. I'll repeat this section one more time. Whenever any association of person is there and number of members exceed 50, it has to be compulsorily registered as a company. It has to be compulsorily registered as a company. If it is not a company, such organization, such association of person shall be illegal association. That's why it is concluded that maximum number of partners which LLP can have cannot exceed 50. Clear? Understood this point? Great. Fifth one. Now there is a new concept. Okay. For formation of LLP, we require someone called as a designated partners. Whom do we require? We require someone called as designated partners. In partnership, we had only partners, right? But over here, LLP concept is just like a company. So company has a board of directors, yes. So LLP in the same case has designated partners. Now who are these designated partners? These designated partners are nothing but these people will be managers of LLP. This partner shall be responsible for the management of LLP. So in LLP, two kind of parties shall be there. Designated partners and only partners. Designated partners and only partners. Clear? Understood? So designated partners shall be managing the LLP and normal partners shall have only stake in the LLP. Clear with this? But designated partners shall be managers as well as the owners of the LLP. But for formation of LLP, we require minimum 2 designated partners. Okay? How many designated partners? Minimum 2 designated partners are required. Designated partner, we will write it as DPs, designated partners. Out of this two, one should be resident Indian. Okay? Out of this two, one should be resident Indian. To sum up, for formation of LLP, we require minimum 2 designated partners. Out of that, at least one should be the resident Indian. Clear with this? Understood? So this was a new concept as far as your LLP is concerned. Now the next point about the LLP agreement. You might have heard about the partnership deed, right? The same concept, the LLP agreement. LLP agreement is like a charter document of LLP. Like we have memorandum articles in case of a company, we have LLP agreement in case of an LLP. So LLP agreement is a charter document of LLP. In this, everything is written. The limit of LLP, limit of partners, rights, duties, responsibilities of partners, authorization, everything will be there. Now, how do we draft this LLP agreement? This LLP agreement we don't draft during incorporation, but we draft after incorporation. So it shall be drafted after the incorporation of LLP. Okay, understood? So within 30 days of incorporation of LLP, we have to draft and also file this with the ROC. That we will discuss later. Now, how is it drafted? It is drafted on the non-judicial stamp paper. How it is drafted? It is drafted on the non-judicial stamp paper. Now, what do we mean by non-judicial stamp paper? Now, non-judicial stamp paper means what? The fees over here does not go to the court. Okay? So, this fees goes to your government. Judicial stamp paper means fees goes to the court. Non-judicial means fees goes to the government. Okay? So, LLP agreement will be paying the stamp duty and that stamp duty fees will go to the government. Right? That's why it is called as a non-judicial stamp paper. Okay? So, it is drafted on the non-judicial stamp paper. After that, it shall be signed by all the parties. All partners, designated partner or normal partners who are not the operating partners, everybody will sign that. It will be witnessed by 2 witnesses. So it will be verified by 2 witnesses and after that it will be notarized. Notary is done at last. Okay. Now this fee is nothing but a stamp duty which we need to pay. And the stamp duty is a state subject. So for every state, different stamp duties are there and its stamp duty depends on the contribution. Okay, how much is the contribution of LLP? On that your stamp duty is dependent. I hope LLP agreement is clear. After that, 7th one, how do we write the name of LLP? In the name of LLP, we have to add a suffix LLP. Like in private limited, we used to add private limited. For public limited, we used to write only limited. For OPC, we used to put OPC in bracket. Likewise, we have to add suffix as LLP at the end of the name. Okay, for example, if the name of LLP is Yukon, then how do we write it? We will write it as Yukon LLP. Okay, after that, LLPs have to maintain books of accounts. What they have to do? They have to maintain books of accounts, also file various returns with the ROC. What they have to do? File various returns with the ROC just like the company. Okay, so in your books you might read that registrar of LLP is there. Till now there is no authority called as registrar of LLP. Okay, in your module they might have written, because ideally by now government should have created a registrar of LLP, but till now it's not created. So your ROC, that is registrar of company, will be the regulatory authority for the company as well as your LLP. I hope it is clear. Okay, moving on to next. Whenever central government thinks fit, and if it thinks that some fishy transaction is going on, some fraud is going on in the LLP, it may order inquiry and investigation, or it can order inquiry and investigations. Okay, and certain sections of Companies Act may be applicable to the LLP. This totally depends on the central government. If central government tells that by this order Companies Act, this section is applicable to the LLP, it is possible. Okay, so I hope you have understood this. Next point talks about the conversion of LLP. Can LLP be converted? The answer is yes. Like a private company can be converted into public, public into private. Likewise, your firm, that is a partnership firm, or your private limited company, okay, or unlisted public company, okay, partnership firm, private company or unlisted public company may be converted into LLP. Okay, so a listed public company obviously cannot be converted into LLP, but your partnership firm, private limited company or unlisted public company can be converted into LLP. How to convert that, this we are going to learn in chapter number 12. Okay, after that the 11th one, winding up of LLP. How to do the winding up? As I told you, we cannot close the shutter of a shop of LLP, but it has to be legally wound up. Okay, so where, see, there are two ways. Okay, where any LLP does not have any creditors, no creditors at all, they can go for voluntary winding up. How they can do? Voluntary winding up. Over here, NCLT interference is a list. What is NCLT? National Company Law Tribunal. So NCLT interference is least. But where you have creditors, LLP have creditors, in that case you have to do by NCLT route only. Sometimes NCLT also orders, NCLT may order mandatory winding up. So compulsorily LLP has to shut down. Okay, so winding up can happen either voluntarily or mandatorily as per the orders of the NCLT. Okay, I hope this is very clear. We have learned all the characteristics till now. If you want, you can rewind the video, pause the video, take down the notes. Okay, all these notes are also available in our JKSI book. Okay, now let's start with the advantages of the LLP and then we'll go to the disadvantages. So till now we have understood the nature, characteristics of LLP. On that basis also we can write our own points for advantages of LLP, but let's check out what is given in the notes. So first of all, LLP is very easy to form. When you compare a company and a LLP is very easy to form as compared to the company. Why is it? Because the documentation required are less. Okay, so forming process of LLP is an easy process. It is less complicated, it is less time consuming as compared to the company. After that, the liability of partners are also limited, even that is a point of an advantage. Okay, so partners don't incur debts on behalf of the LLP, but it is LLP who incur debts of its own because it has a separate status. It also has a feature of a perpetual succession. So LLP's existence is not dependent on any of its partners or the designated partners. It has its own identity. Okay. So the life of LLP is not affected by death, insolvency of any partners. Okay. So life of LLP is not affected by anybody's death. So winding up will be as per the law only. It cannot be wound up by the partner just because partners have become insolvent. After that, what about the management of LLP? Management of LLP is done by the designated partners. So partners will be the managers as well as owners, both of them. Okay, so partners will be managers as well as the owners. But what happens in case of a company? Shareholder may or may not be the managers because they may or may not be the directors. So they lend their money to some other person and some other person will be doing the business. So there is segregation of ownership and management. But in LLP, both are one and the same. Okay, so you are managing your own money, so that makes a lot of difference. So in company, directors and shareholders may be different. Now, as far as transferability of ownership, in a private limited company, we have certain restrictions, right? As far as transferability of shares. So you cannot transfer shares to the public at large. You cannot issue shares to the public at large. It will be within the relatives and friends, etc. because it's a closely held company. This is not applicable to the LLP. So LLP can give the stake in itself to any person. So any partner with consent of existing partner, they can sell their stake to anybody. So there is no restriction upon joining and leaving of LLP. The only thing is their consent of all other partners should be taken. Okay. After that, taxation. Whatever profits goes in the hands of partner, on that dividend distribution tax is not applicable because the profits of LLP is not a dividend. Okay, so distributed profits is not taxable and DDT is also not applicable to the partners, and your LLP is at par with the other partnership firm. Also LLP who has a profit of more than 1 CR, they don't have to pay surcharge and cess. This all you will be learning in your tax. After that, audit. In company, audit is compulsory. I'll teach you this point over here. As far as company is concerned, okay, every year audit is compulsory. Now this company can be OPC, private, public, does not matter at all. But when you talk about an LLP, audit is not compulsory to all LLPs. Okay, so audit is not compulsory to all LLPs. It is only compulsory on crossing the threshold. Okay, so audit is compulsory if the contribution of LLP, okay, whatever is the LLP contribution, it exceeds 25 lakhs, okay, or the turnover of LLP. The turnover of LLP exceeds 40 lakhs. The conjunction used is or. So anyone exceeding the limit, audit is applicable to you. So if any LLP's contribution is 30 lakh, even though turnover is less than 40 lakhs, the audit is compulsory because the conjunction we are using is or. So please remember this point. So all LLPs don't have to do audit. Only those LLP who have turnover exceeding 40 or contribution exceeding 25 have to do audit. Does that mean the other LLP whose threshold is not exceeding limit, they don't have to prepare a balance sheet P&L? They have to. It is just what is meaning of audit. Will be appointing a statutory auditor. He will be checking our accounts. He will be making auditor's certificate and giving it to us. That is an audit. So making of balance sheet, filing of return is compulsory for all the business organizations. But for LLP, audit is to be done in case of exceeding threshold. If any LLP wants to do voluntary audit, then it is fine, you can do it. But it will be compulsory only for, please remember the threshold, 25 lakhs or 40 lakhs. Okay. So every business has to appoint an auditor, but in case of LLP, audit is not mandatory. It will be mandatory only in case of turnover of LLP exceeds 40 lakhs, okay, or contribution exceeds 25 lakhs. Now next, if you compare company and LLP, company has a long list of compliances. Every year they have to do it. Okay, but LLP has a fever means less compliances as compared to the company. So LLP has a less compliances in comparison to the company. Now the LLP's agreement is very flexible. It is not as rigid as your memorandum. If you want to change your memorandum, we've already seen, call board meeting, call general meeting, you have to bear such cost, right? But if you want to change the LLP agreement, only you require partners' consent, that's it. So there is a flexibility in changing the LLP agreement. So if you compare memorandum and LLP agreement is much easier to be altered. So partners can draft agreement as per their discretion. Also alteration can be done as per their discretion. Whatever rights, duties are there, they can put. Because LLP agreement, there is no format given like a memorandum. So they can put any clauses, but clauses should be legal enough. Then LLP is very easy to wind up. As we discussed earlier, when LLP don't have any creditors, they don't have to go to the NCLT also. They can do the voluntary winding up of LLP. So when you compare a company or a LLP is much easier to wind up in comparison to the company. I hope you have understood all the advantages. Now let's go to the disadvantages. The disadvantages means what? Always there are two sides of one coin, right? So where there are disadvantages, there will be advantages and the vice versa. So we've already seen the advantages. Now let's begin with our disadvantages. The very first point is restricted access to the capital market. Why LLP cannot list? Because LLP don't have a equity structure. In LLP, equity structure is missing. You don't have share capital. So if you don't have share capital, what are you going to list? So LLP cannot access the capital markets. Neither they can issue the debt instruments. So no equity, no debt. So there is no scope of listing of the LLP contribution. So small businesses, if they want to raise funds, they have only options available with them is relative, family, taking loan from banks, etc. But they cannot raise funds from the public at large. After that, rights of the partner. This I will teach you over here. Let's understand this very interesting point. Rights of the partner. See, when you compare a company and LLP, in company, what is a right of a shareholder? If he has one share, he will get one vote. This is a normal rule, right? One share is equal to one vote. But this does not happen in LLP. Okay. If you are holding 10% in LLP, then also only one vote. Right? If you are holding 30% in LLP, then also only one vote. If you are holding 90% in the LLP, then also one vote. Okay. So partners who are holding more, they don't have advantage of higher voting rights, which they have in a company. Understood? Okay, so in LLP there is no fixed sharing rights among the partners. This is only possible in case of a company. Then public distribution of LLP information. We have to file various balance sheet, P&L returns with the ROC. In partnership, we don't have to file balance sheet, P&L, so nobody comes to know about our numbers. But LLP, we have to disclose everything to the ROC, and once you upload on the ROC portal, it becomes a public document. So everybody can access. Who all are the partners, what all you things are doing, how many alterations you have done, everything can be accessed. So nothing can be kept secret. Okay, so LLP has to file returns, financial statements, and this all become your public document, and they can be easily inspected by the general public at large. Due to this, secrecy is not possible. Okay, after that, there are certain limitations in formations of LLP. Now, what are the limitations? Whenever any of the foreign entity they want to invest in any LLP in India, the main disadvantage for them is, we have learned this, that at least one resident Indian designated partner is required. So they cannot form LLP with two foreign residents as in designated partners. Okay, so at least one designated partner has to be resident Indian. This is the disadvantages for the foreign entities. Also, 100% FDI route is less available in case of LLP. What is this 100% FDI route and all, will be learning in the upcoming chapters. So whenever any foreign contribution comes to India, over there one act is there called as FEMA, Foreign Exchange Management Act, that is applicable. So in FEMA, whenever foreigner invest in India, it is called as a foreign direct investment. Okay, so there are only few sectors where 100% FDI is required. Otherwise, most of things we have to take approval of RBI every time whenever we have any investment in India, especially in LLPs. This is also one of the disadvantage. After that, offenses, penalties are huge. Okay, if you don't file any form after the due date of the form, per day 100 rupees penalty is there. Per day 100 rupees penalty. So if you default for 6 months, approximately 180 days, so 18,000 penalty for you. Got it? This 100 rupees is for 300 days. And after 300 days, this will go in compounding. You have to go to the ROC or NCLT. There they will make an order. You have to pay additional fees, or they can also order imprisonment. Okay, so offenses, penalties are huge. After that, if any partner want to exit, it's not easy. Why? Any partner want to shut down the LLP, first they have to file all the returns with the ROC. So if you want to file the returns with the ROC, you have to pay the fees. Yes, so when you want to close the LLP, it's not easy. You have to complete all the filings which are pending. After that, you can exit. Okay, so if LLP wishes to wind up, such LLP has to settle all its previous filing obligation and pay the late fees. I told you what is the late fee, right? 100 rupees per day. After that, there is also limitations as far as ECBs are concerned. What is an ECB? Let's understand. EC means external commercial bonds. Okay, now let's understand. External means funds are coming from the foreign party. Okay, so Indian LLP taking commercial loan. What is Indian LLP doing? Taking commercial loan from any of the foreign entity or bank. Okay, Indian LLP taking loan, commercial loan means for their business, okay, from foreign entity or a bank. This is prohibited. Okay, so Indian LLP cannot issue ECB, so they cannot take the foreign bonds. Got it? Now let's understand over here. LLPs are not allowed to raise ECB. ECB is just like your debt instrument. So LLP will issue the debt instrument and your foreign entity will give the commercial loan. This is not allowed. So LLP cannot avail commercial loan from its foreign partners, FIIs, foreign banks, or any of the financial institutions situated outside India. I hope this was very clear. Now let's start with the incorporation of LLP. We will learn how to register LLP under LLP Act 2008. As I told you, our nodal officer is ROC. Okay, so ROC, we have to file all the forms with them. Okay, same like the company, but the documents will be different, the forms will be different. So let's begin with the procedure how to incorporate LLP. The very first thing we have to do is we have to obtain DSE. What is DSE? A digital signature. Because as we know, all the documents will be signed on e-forms, right? So hence on the e-forms we will require a digital signature. So we have to obtain DSE for all the designated partners. So obtain DSE for all the designated partners. Even for becoming a designated partner in an LLP, they require a DIN. Okay, so second step, obtain DIN for all the designated partners. DSE and DIN for all the designated partners. Okay, after that, the third one, same like company, we have to reserve the name of LLP. So we have to abide by all the instructions whatever we have learned in the Companies Act. So when LLP name has to be approved first, reserved first by your ROC. So reservation of name, how we will do, we have two options. First option, you can file LLP form run. Okay, like we have in a company run application, right? The same we have application run for LLP also. So you can apply name differently by filing a run application. In run application we can give two options. The second option available to the company or the LLP is apply in form Philip. Which form is there? Form Philip. This is the incorporation form of LLP. Like we have Spice Plus for company, we have Philip for LLP. Okay, how do we write? Please see to it very carefully. F capital, I small, double L capital, I small and P capital. So only two I's will be small, rest all letters will be in capital. So this is a consolidated form, okay, where we can get the name application approval also and incorporation of LLP approval also, but this will be too risky. Okay, because if ROC rejects our name, our entire documentation, everything will go waste. So when you're very sure about the name of the LLP, then you can directly file application in Philip. Or when you're not sure, we can first file the LLP run application, get the name approved from ROC, and then we can proceed with the next. Okay, so form Philip, there we make name application. Along with that, we also file incorporation documents. Okay, after that, the fourth point, assuming we have done run application. Okay, so once ROC approves name, The validity I have taught you, it is basically valid for 20 days. And this can be extended. This we have already learned in the company law, right? Yes. So after that, fifth one, we have to start preparing our incorporation documents. Okay. Preparation of LLP incorporation documents. So what are documents we are going to write? First of all, documents for the registered office of LLP. Even it is compulsory for LLP to have a registered office. Okay, so we have to give details of registered office for LLP. So your registered office may be owned or it may be rented. Okay, so when it is owned, you have to give the ownership proof. When it is rented, you have to give rent agreement. When it is rented, you have to also attach NOC, that is no objection certificate from owner. That owner of the property does not have any problem if LLP uses this as its registered office. So in case of a rental, we have to attach additional document of NOC. Along with this, both of them have to attach a utility bills. Utility bills can be your electricity bill, telephone bill, bank statement, but these bills cannot be older than 2 months. Okay, bills cannot be older than 2 months. So these are the basic documents as far as your registered office is concerned. After that, the second, we require documents from the designated partners. Okay, so what all things we require from the designated partners? First of all, we will require ID proof and address proof. Along with that, they have to also submit a PAN card. Okay, also we require consent of all designated partners. Like we submit the director's consent, on the same lines, consent of designated partners. Clear? Understood? After that, third document shall be subscribers list or subscriber sheet. In this, all the partners shall sign. So not only your designated partners, but all the partners who are holding stake shall sign. This is a subscriber sheet. All partners shall sign, and what will be written in that? Which partner is giving how much contribution, and this will be signed by all the partners that they agree to take up this stake in the partnership. Clear with this? Understood? After that, the fourth one, list of entities we have to attach where your designated partners are interested. Okay, list of entities where your designated partners are interested. What does this mean? A designated partner may be some company shareholder, he may be director somewhere. Okay, this is called as an interest. So we have to attach the list of entity where our designated partners are interested, only designated partners. Okay, so this we saw the documentation. Now let's go to the sixth step. We will be filing the incorporation form. File incorporation form of LLP. Now which form is there? I told you it's a Philip, right? We write Philip like this, and we have to attach all these documents to the incorporation form. After that, if your ROC is satisfied, it shall issue a certificate of incorporation. What it shall issue? Certificate of incorporation. Okay, so same procedure like company, only documents are different. In the incorporation certificate they will mention something called as LLPIN. Now what is this? It's a limited liability partnership identification number. Like companies have SIN, corporate identification number, LLPs have LLP identification number. Okay, now after this, the 8th point, once we receive our certificate of incorporation, then we have to draft an LLP agreement. So our next step will be draft LLP agreement. Now how are we going to draft this? We have seen on the non-judicial stamp paper, all partners shall sign, 2 witnesses will be there and notary will be done. Okay, so once we draft the LLP agreement, this agreement need to be filed with ROC. We have to file this document with ROC. If we don't do this step, our incorporation of LLP procedure is incomplete. Okay, so we have to file agreement with ROC in form, very important, remember, LLP 3. Okay, it's form LLP 3. You can say form 3, you can say form LLP 3. Clear with this? So what are we going to attach to this form LLP 3? We are going to attach the LLP agreement, very essential. And when you have to do it, we have to do it within 30 days of incorporation. So within 30 days of incorporation, we have to file LLP 3 with the ROC. If we don't file, then after 30 days, everybody knows the meter of 100 rupees will start. Okay. Yes. So this was your incorporation procedure. Okay, I hope all of you have understood this. Now let's understand what is an LLP agreement. Okay. LLP agreement, basically it's a charter of LLP. Okay, what is it? It's a charter of LLP. In the last video we have seen the incorporation of LLP. In that, the last step was drafting of an LLP agreement. If LLP agreement is not drafted, then LLP will not be able to do any business, because authority has to be given from an LLP agreement. Like memorandum states the main object of the company, LLP also states what is the business of the LLP. Okay, so agreement is very, very important. So what is an LLP agreement? As per the section 2 of LLP Act, LLP agreement means any written agreement between the parties. Okay, it is any written agreement between the parties or between LLP and its partners which determines mutual rights, duties of the partners, rights, duties in relation to that of an LLP. So like we have seen, the main important things, that is members and the company, both are connected. Likewise, your LLP and partners are also connected because of this agreement. Anybody apart from partners and LLP shall be a stranger. So there are certain rights and duties of partner towards LLP, and LLP also have to protect rights and duties of the LLP. Okay, so LLP must be executed within 30 days of incorporation of LLP. It will be on the non-judicial stamp paper. Okay, and it will be dependent on the state of incorporation. I have told you the stamp duty depends upon the state of incorporation and the amount of capital contribution. So 5 lakh rupees is amount of contribution, for example. On that, some percentage will be the stamp duty, and it depends on state to state basis. Now, how to draft a LLP agreement? First, you have to do discussion with the partners. All the partners will sit together, do discussion. Okay, whatever terms everyone agrees should be inserted in the agreement. So it will define the roles, responsibilities, rights, powers of partners to LLP and each other. It will create a foundation for smooth function. It will also have a rules and regulations. It will be drafted on the stamp paper, that's a non-judicial stamp paper. Please remember, I have explained you what is a non-judicial stamp paper now. All partners will be signing the agreement at bottom of all the pages, and there will be two witnesses who will sign the agreement at the end of the document. All these things we have already seen. Now, what are the essential clauses in the agreement? Okay, you can just read this point once, no need to by heart it, it's not required. It's not required to remember each and every section number of this LLP. Okay, so first will be the definition, that is what is the basis of entire LLP agreement. Then will come the details of the designated partners. After that, the name of LLP, and also you have to put a clause, you can change the name of LLP as and when required. After that, where is the registered office of LLP situated, you have to write that as well. What is the business of LLP? How much is the capital contribution of all the partners? What is the profit sharing ratio? You may not have a loss sharing ratio because it's not compulsory to share the losses, but it's compulsory to share the profit. Rights, duties of partners and designated partners. Admission of partner, retirement, resignation, expulsion, the provisions relating to the same. Also you have to write remuneration and interest paid, because see, designated partners are working for the LLP, so along with the profit they also should be paid some fixed remuneration, right? So remuneration and interest paid to the partners who will operate the bank account, how many meetings should be there. See, LLP Act is silent on the number of meeting. It's not compulsory to conduct so much of meeting like your board meeting, okay? But whenever meetings are conducted, how to conduct the meeting, you can put this clause. Then indemnity clause. Indemnity is during indemnifying. That means if any of the partners have incurred losses because of the LLP, or LLP has incurred losses because of the partner, the duty of a partner to indemnify the LLP. Understood? Then dispute resolution is must. If there is a dispute among the partners, where they can go? Generally, arbitration clause is inserted because arbitration is an alternate dispute mechanism. This you will read in your JIGL. Then about maintaining of books of accounts, what will be the accounting year of the LLP? Term of LLP, if it is fixed you have to write, if it is not fixed then it can be with the discretion, and how to wind up, and other general provisions if any. So these are the main things required to be inserted in your LLP agreement. They may ask you a short note on this. Okay, so please read 2 to 3 times, that's it. Don't spend a lot of time on this. Now let's begin with our next topic, that is alteration of your LLP agreement. Now under this LLP agreement, various alterations we can do. Now first let's understand why are we going to alter the LLP agreement. We are going to alter the LLP agreement in case, first one, there is change in your designated partner. Okay, so when you are changing your designated partner, or one partner is going out, another one is coming in. Okay, so we are removing somebody, we are expelling somebody, somebody is coming inside, somebody is taking resignation. In that case, we are going to change the designated partner. So for that case also we have to alter the entire LLP agreement, yes, because the profit sharing ratio, the name of the partners, everything will be shuffled, right? So whenever we change our designated partners, we have to alter the agreement. After that, when we are going to change the name of LLP, so whenever we change the name of the LLP, we have to alter the LLP agreement. After that, third one, when we are changing registered office of the company, when we are changing registered office of the LLP, what we have to do? We have to alter the agreement. Why? Because in agreement we have written where our registered office of LLP is situated. These three are the basic changes. Okay, apart from that, when you are changing any other clause, in that case also you have to alter the agreement, because that is your basic of LLP, everything we have written in that. So when you are altering that, any of the clauses written in LLP, we have to alter the LLP agreement, simple. Okay, so over here we are going to do two kinds of procedure. How many procedure we are going to do over here? Two procedure. Why two procedure? Because whenever we are going to change the designated partner, okay, you are making any changes in them, changes in the designated partner, what you have to do? The first procedure you have to do is change in DP, and the second procedure, which is compulsory, you have to alter the agreement. Okay, so two procedure we are going to carry out. So first let's understand very basic procedure how to alter the agreement. So what is the first one? Procedure to alter LLP agreement. So this procedure will be very common in all the cases. So what is the procedure to alter the LLP agreement? Let's begin with the procedure. So first of all, as we know that we are going to do everything in the designated partners meeting, right? So we have to call meeting of partners. Along with the designated partners, you may also call other partners, because over here we are altering the main agreement of LLP. So you may call all the partners, no problem. After that, the second one, we have to pass the resolution. Okay, of partners. So passing resolution means what? Ensure taking consent of the partners. In company we have special resolution, ordinary resolution. In partnership, in LLP, nothing is there. Okay, whatever will be written in your agreement, like it says that if you want to change the LLP agreement, you have to take 3 times the vote. That means you need 75% of consent. So you have to abide by your agreement. Okay, so you have to pass the resolution of partners. After that, we have to draft a new agreement, right? How are we going to draft a new agreement? See, original agreement will be as it is. Okay, original agreement is a basis of LLP. This you will never ever dispose. So whenever you are doing alteration, you have to add one more agreement, and that altered agreement will be called as a supplementary agreement. What do you call it? Supplementary agreement. So your original agreement with which you have done the incorporation, it will be as it is. Whenever you are doing alteration, the original will be same. After that, you have to attach the new one. So the original plus the supplement agreement. I hope you have understood. So we are not going to anytime dispose of your original agreement. Okay. So on this supplementary agreement, are we again going to pay the stamp duty? The answer is yes. Okay, so this supplementary agreement, again it should be on the non-judicial stamp paper. Okay, but over here we don't have to pay on the contribution, but the stamp duty is ₹100. Okay, it's a basic stamp duty for all the alteration. You have to do it on the ₹100 stamp paper. Again, it will be signed by all the parties. 2 witnesses shall sign at the end of the agreement. Notary shall be done. Everything as it is. Okay. After that, The fourth point, we have to file the new agreement, that is this altered agreement with whom? With ROC. Now in which form we are going to file this? This filing will be done in form LLP3, right? Always agreement filing will be doing in LLP3. Okay. So whenever we are doing change in designation, change in name, the respective forms will be there. Along with that respective form, this LLP3 will be always there. How? I will tell you that. So we have to file LLP3 with ROC within 30 days of alteration. Within 30 days of alteration. Now what all things we have to attach to this form 3? To LLP3 we have to attach original agreement plus your supplementary. Both of them you have to attach. Okay, supplementary is nothing but your altered agreement, right? If you attach only altered agreement, ROC will not approve your form. Okay, so in LLP3 we have to attach both the agreements together. I hope this is clear. Okay, yeah. So this was a procedure for alteration of LLP agreement. Okay, now we are going to see the next one, change in designation. Procedure to change designated partners. Now how are we going to change your designated partners? See, these changes can be in various ways. First, you are admitting a person. So admission of a new partner. Even this is a change, the answer is yes. So when we are admitting a new partner, what document we require? We will require consent of that. Consent of a new partner. Right? Or suppose any partner is resigning or you are removing any of the partner or somebody has died, death of the partner. Even this is one partner is going out. So resigning, removal or a death. So in case of a resignation, we will require a resignation letter because this all documents will have to file with the ROC. That's why. Okay. For removal, we will require partner's resolution. Okay. And for death, we will require a death certificate. So these documents are important. After that, third way is change in designation. Third way is change in designation. What do I mean by change in designation? The person who is designated partner, now he does not want to manage the LLP's business, but he wants to be a partner in LLP. So he requests all the designated partner that now he wants to be a partner. Just a partner, not a designated partner. So change of designation from DP to only partner. That is, he is converting himself from DP to only a partner. So he is becoming a silent partner now. Or any of the partner changing to designated partner. So you are changing the designation. So for this change of designation also we will require a document. What document we will require for this? We will require partner's resolution. Along with that, when any partner becomes a designated partner, then consent of such designated partner. Okay, so these are the various ways in which we are going to change the designated partners. Okay, so now let's begin with our steps. The very first step we need to take is call meeting of partners. Second one, we are going to pass a resolution. Okay, and in that we have to obtain various documents. So I have already written what all documents we require in case of, okay, so we have already seen what all documents we need to collect if any of the designated partners death has occurred. Then we need to take a death certificate. If anybody is being removed, you have to insert the partner's resolution. If somebody is coming in, you have to take consent. And if there is change of any of the designation from DP to partner or partner to DP, in that case we have to obtain a partner's resolution for that, because these documents are relevant. We need to file with the ROC. So after that, next step, we have to file form LLP4. Which form is there? LLP4 we have to file with the ROC. So for change in designation, we have to file form LLP4 with the ROC within 30 days of change. Okay, as I told you, whenever we are going to alter the designation, that means change in designation whenever happens, we also have to alter our LLP agreement. So along with form LLP4, form LLP3 shall also be filed. Okay, both of these forms, these are the linked forms. What do you call them? Both the forms are the linked forms. So you cannot file only LLP4. You have to attach LLP3 to that. Okay, clear with this? So how to attach and what to attach, what these things we have already seen in the previous. So both shall be filed together only. Previously we have understood how to alter the agreement. We need to make a supplementary agreement. So in LLP4, what all attachments will be there? Your admission, in case of an admission, the consent or the death certificate, whatever. And in LLP3, we are going to attach original agreement plus supplementary agreement. Both of them we have to submit to the ROC, and ROC shall make changes accordingly. That's it. We don't require any other body's approval. Okay, so this was for change of your designated partner. I hope you have understood this. Now in this video we are going to learn how to change the name of LLP. Okay, for changing the name of company we had taken a central government approval, but now for change of LLP we don't require any central government approval. Okay, so let's start with the procedure. Very simple. First of all, we have to choose a name, select a name for LLP. Okay, this will be done in the partners meeting. So what we have to do, call meeting of your designated partners. Okay, after calling meeting of designated partners, in the meeting of the partners we have to pass a resolution for name approval or change of the name. Okay, now the third step, we have to reserve the name with the ROC. So we have to apply for the reservation of name. So which form are we going to file? We have to file form LLP run with ROC. In LLP run, you know that we get two options. Now once our name is approved, so once our name is approved by the ROC, it is valid for how many days? 20 days. It will be valid for 20 days. Why only 20 days? Because we don't need any central government approval over here. So only within 20 days we have to complete all the filing requirements. Okay, so once our name is approved, Then we have to file a form for name change with the ROC. So we have to file form LLP5. So form LLP5 is for intimation to ROC in case of change of name of the LLP. So along with form LLP5, we know that we also have to alter the LLP agreement, and in which form we have to file this altered agreement in form LLP3. So again over here also both of this form are the linked forms. Okay, both of these are the linked forms. We cannot file LLP5 alone. Always we have to file LLP3 with that. Okay, so this both forms will be filed with the ROC within 30 days of name change. So once ROC approves your name within 30 days of that, you can adopt that and also file the written of change of name with the ROC. This is it with your change of name. So very important thing you have to remember in LLP is a form number. Okay, LLP3 is for alteration of agreement. Okay, LLP4 is for filing of intimation to ROC for change of designation of partners, that is designated partners, and LLP5 is for intimation of change of name of LLP. Now we are going to start with procedure to change the registered office of LLP. We have seen huge procedure to change the registered office of the company, right? So huge procedure is not there. It is very simple as far as your LLP is concerned. Okay, so the first change under this is change of registered office within the state and within same ROC. Okay, so we are not changing the state, we are not changing the ROC also. So what is the procedure for that? We are going to see. Second one is from one ROC to another. Okay, from one ROC to another ROC. Now this is possible, and that too within the state. So we are not changing the state, but we are going from one ROC to another. This we all know that it is only possible in two states. One is your Maharashtra, because in Maharashtra we have two ROC, and another one is in Tamil Nadu. In Tamil Nadu we have two ROC, right? Then the third shift is from one state to another. From one state to another state. So these are the three shift of registered office. The procedure for first two is one and the same, and procedure for third is little different. Okay, so first two will be learning from your notes, and the third one I'll be teaching you in the writing. Okay, because it is very easy. So whenever any company, whenever any LLP wants to shift within the same state and within the same ROC, what all documents they require? They require basic documents. That is, consent of all the partners is required. So they will be calling a meeting of the partners, and that they will be taking consent of all the partners. It is compulsory. Okay. Do we require consent of secured creditors? No, we are not taking consent of secured creditors. Consent of secured creditors is obtained only in case of shift from one state to another. Okay, and which form we have to file with the ROC? When we are changing the registered office of LLP, we have to intimate the change in form LLP 15 within 30 days of the change. Okay. Do we require public notice? The answer is no, we don't require public notice also. And what is the time limit for filing the form? Within 30 days of the resolution. Is it clear? It's over. Okay, let's go to the next one. The same thing, shifting of ROC from one ROC to another, but within the same state, only possible in Maharashtra and Tamil Nadu. So again the same documentation, we will require consent from all the partners. We will not require consent from the secured creditors because we are within the state. After that, the same firm will be filing form number 15 along with LLP 3. Both of them is required, right? Because we are altering the LLP agreement also. In memorandum, what happens? We only write the state. But in LLP agreement, we write entire address. Okay, so in entire address, if we are shifting from one house to another house, just a nearby shop we are changing. So from number 4, our shop number has changed to 5. Then also you have to change the LLP agreement. Understood? So LLP agreement will change. Public notice is not required. And what is the time limit for filing form number 15? It is 30 days. So clear with this too. Now we'll go to the third one. We'll learn that in writing. So we are going to see steps to change from one state to another. The very first thing we need to do is call the partners meeting. So call meeting of the partners. Okay. In the second one, we have to pass a resolution of partners for shift of registered office. So pass resolution and obtain consent of all the partners. Okay, so over here unanimous approval is required. After that, also we have to obtain consent of all secured creditors. Okay, we need to obtain consent from all the secured creditors. After that, we have to publish an advertisement in the newspaper. Okay, this will be published in 2 newspapers. One will be in English language, another one will be in the vernacular language. Wherever your registered office is situated, in that state, in that particular region, whatever language is famous, you have to give advertisement in that newspaper. Okay, in this, what advertisement we are going to give? The notice regarding shift of registered office. Okay, it will be the notice regarding shift of the registered office of the company. Now, when we have to give this advertisement, what is the time limit? We have to give this advertisement before 21 days of filing application with ROC. In this, we are not going to take ROC approval. We are just going to file an intimation to ROC. Okay, so this needs to be filed before 21 days of filing form 15 with ROC. Clear? Because in form 15 we have to attach that advertisement as well. This advertisement is called as a public notice. So public notice was not required in the other 2 cases which we learned. It is only required from one state to another state. After that, what are we going to do? E. We are going to file form LLP 15. Along with this form, we all know that there is an attached form called as LLP 3. Along with that, okay, this both forms are the link forms filed together with ROC within 30 days of advertisement. Okay, when we have to file this form within 30 days of advertisement this time. Clear with this? And then F point, we have to make necessary changes. That's it with all this procedure. Okay, alteration of LLP agreement will be same for all, that is for changing designation, name and also the registered office. Everywhere will be adopting the same procedure. LLP 3 comes in all the steps. I hope it is very clear. Now we are going to start the last part, that is the annual compliance of LLP. We have learned that as compared to the company, LLP has fewer legal compliances. But when we compare LLP with the partnership, we have more compliances because our regulatory authority is ROC, and ROC wants LLP to file at least few forms annually with them. So along with the ROC compliance, we also have an income tax compliance. So what are the compliances which LLP has to follow? See, listen students, there are basically two types of compliances. Okay, two kinds of compliances are there. First compliance is your annual compliances. These annual compliances are very repetitive in nature. Why I call it as repetitive? Because it will recur every year. That's why it is repetitive. The another kind of compliances we have is a event based. Event based compliances does not recur every year, but it comes at certain event. That means if you are changing the name of LLP, then you have to do the procedure. If you are altering any of the clauses of the LLP, then you have to alter the article. Okay, so this is how you have to do the event based. So over here we are not going to learn about the event based compliances because they does not occur every time, but we are going to learn about the annual compliances because they occur every year. Okay, so the very first annual compliances every LLP has to do is file form of annual return of LLP. And annual return of LLP is there in form 11. Which form is there? Form number 11. So what will be written in this annual return of LLP? All the compliances, legal compliances part. That means how many partners came in, how many went out, did you change the business of LLP, did you increase the contribution. So all this managerial part, what I can say, managerial changes in a year, whatever you have done, you have to give that intimation to the ROC. In which form are we going to give intimation? We are going to give intimation in form 11. Now, is it compulsory for all the LLPs? Yes. So, let's write every LLP has to file form 11, which is annual return of LLP with ROC. Okay, with whom they have to file? With ROC on or before 30th May every year. Okay, so basically you have to file this form 11. So what is the time limit? It is within 60 days from closure of financial year. Okay, so our financial year closes by 31st of March, correct? So on or before 30th May, each and every LLP has to file form 11 with the ROC. What all things it will write in form 11? All the managerial related changes which happened during the year and the basic information of the LLP. If you don't file, what will happen? Penalty per day ₹100. This is your penalty, and ₹100 up to how many days? 300 days. After that, extra fine, extra imprisonment. Now, who will certify this form 11? Certification of form 11. Okay. Basically, it is certified by a director. But in some circumstances, certification of a PCS is a compulsory. Okay, in certain things, it is compulsory to get certification by a PCS, that is practicing company secretary, and exclusive rights are given to PCS. So it is only practicing company secretary who can certify this Form 11. Now, in what circumstances this requires certification? LLPs will have to get PCS certification in case if first your contribution, okay, it exceeds rupees 50 lakhs. So whenever your contribution exceeds 50 lakhs, we require PCS certification in Form 11. Or the turnover exceeds rupees 5 crore. Okay. So in case your contribution exceeds 50 lakhs or your turnover exceeds 5 crore rupees, the conjunction used is or. So any one, it will trigger the certification by a PCS. So any one trigger, and if you are not doing PCS certification, you cannot file form only. Understood? ROC will not accept. The system is fixed. Okay, understood? So Form 11, please remember, it's annual return of LLP to be filed within 60 days of closure of financial year, which comes to on or before 30th May. Certification of PCS is compulsory in case of a contribution exceeds 5 lakh or turnover exceeds 5 crore. Very simple. Okay, now let's go to the next one. The second compliance is about Form 8. Form 8 of LLP. Now what is Form 8 of LLP? This is a form where we will be filing our balance sheet P&L. Okay. So in this form we will be filing statement of accounts, also statement of solvency of LLP. Clear? Understood? Now what is the due date of filing this form, or what is the time limit of filing this form? This form is to be filed on or before 30th of October every year. So on or before 30th of October every year we have to file Form 8. In this Form 8 we will be attaching balance sheet P&L, statement of solvency. Okay, now over here, very important, I had taught you when is audit compulsory. So wherever you have your contribution exceeding 25 lakhs or you have a turnover exceeding 40 lakhs. In any of the circumstances, the audit is triggered and you have to file audited balance sheet and P&L. Okay, and if you don't do that, that will be a penalty, contravention. So what is the penalty if you don't file this form? Rupees 100 per day penalty is there. Okay, so what is Form 8? Filing of statement of account, solvency. Audit is required wherever you exceed the threshold, and it has to be filed on or before 30th of October every year. So these are the two compliances which we do with the ROC. Now the third compliance is to the income tax department. So the third one we have tax compliances. Okay, every LLP has to file something called as income tax return, right? So first, wherever if audit is not required. So there are LLP where audit will not be required. In which circumstances? Contribution less than or not exceeding 25 lakhs and turnover not exceeding 40 lakhs where audit is not required. So will file income tax return on or before 31st of July of your assessment year. Okay, so wherever audit is not required, you have to file return on or before 31st of July of your assessment year. But where audit is required, or audit is compulsory, in that scenario, you have to file income tax return on or before 30th of September of your assessment year. Okay, 30th of September of your assessment year. After that, as per section 92E, LLP have to make a special report, or they have to make a special report as per section 92E. So wherever it is applicable, this you will be learning in your Income Tax Act, that is your tax. Okay, so they will require some extra number of days. That's why wherever section 92 report is applicable to any LLP, they have to file the return with the report on or before 30th of November of your assessment year. Clear? So these are your tax compliances, and I hope it is very clear. So only 3 compliances for LLP: Form 11, Form 8 with the ROC, and income tax return with the Income Tax Department. Okay, that's it. With this, we also complete your chapter number 5. So let's discuss the case laws which are asked. The financial statements of LLP are not mandatorily required to be audited by the chartered accountant. Don't you think the statement is incorrect? Because the LLP whose contribution is exceeding 25 lakhs and turnover is exceeding 40 lakhs, for such LLP it would be mandatory to get the accounts audited by the chartered accountant. So audit has to be done. So the statement which says that financial statements are not to be audited by chartered accountant is not correct. Okay. Let's discuss the questions behind your book. As a practicing CS, advise your client Mr. Akash regarding annual compliances to be done by LLP. Right now, before this video we have discussed only 4 compliances: Form 8, Form 11 and income tax returns. That's it to be done by LLP. The 4th one I said for the event based compliance, but this is only annual compliance they are asking. So only Form 8, Form 11 and income tax returns. Clear? Apart from that, Saturn and Jupiter seek your advice to the circumstances which would require their accounts to be audited. Okay. Also advise whether FDI is allowed in LLP. Also, can they avail the ECBs? So 3 questions. First question is accounts to be audited. What you have to remember, when contribution is exceeding 25 lakhs, turnover exceeding 40 lakhs, audit becomes compulsory. Is FDI allowed? The answer is yes, FDI is allowed. ECBs, no. LLPs are prohibited from accepting ECBs. They cannot issue the ECBs. Okay. Next, LLP, that is Kittle's LLP, have turnover 45 lakhs, contribution exceeding 30 lakhs. Now, it seeks your advice in the following matters. First, is LLP subject to audit? Answer is yes, because you have to give reason, that is the contribution is exceeding 25 lakhs and turnover is exceeding 40 lakhs. Second, is LLP eligible to raise loan from XYZ, a foreign bank? The answer is no, because LLPs cannot issue ECBs. They cannot accept commercial loans from foreign bank. Please remember. Offenses, penalties for non-filing of financial statements, 100 rupees per day. Okay. So such straightforward questions are asked in the LLP. So now we are going to start with chapter number 6. Chapter number 6 talks about different forms of business organization and their registration. So let's talk about the weightage first. The weightage of this chapter is around 5 to 8 marks. Okay, and in this particular chapter we are going to learn about 4 forms of business organization. Okay, so the first one is a sole proprietorship. The second one, we have a partnership. First two are very basic. Third one, we have HUF, that is Hindu Undivided Family. And the fourth one, we have Multi-State Cooperative Society. So these are the 4 forms of organization which we are going to learn in this chapter. Okay, sole proprietorship and partnership are very straightforward, hence we will be doing that from our JKS notes itself, and wherever required I will be teaching you the difficult concepts. So let's begin. Now, whenever any entrepreneur want to choose a business organization, okay, it will consider various aspects. So what all aspect it is going to consider, we have seen that in chapter number 1. So along with that, there are certain additional aspects which entrepreneur will look into. What are those? About his vision. He want to make what size of a business? He want to be a large scale, medium scale or a small scale. If he wants to go for a large scale, definitely he has to opt for a company. Medium scale, definitely LLP or a partnership, and very small scale for him, sole proprietor or OPC is the best one, right? After that, what is the level of control he desires he should have in a business? If he wants the entire control, sole proprietorship is better. If he does not want any control but want to scale up business like anything, then company is the best. After that, how structure he wishes. Is structure to be very complex because his business is very complex, then we should always have a company. If you want a very simple structure, then go for a sole proprietor. Also, you have to check whether your business is vulnerable to the litigation. If it is vulnerable to the litigation, we should always opt for a separate status entity, that is LLP or a company, because if we opt for a sole proprietor or a partnership, the person's liability will be unlimited. After that, we also have to consider what are the tax implications in our business. As per that, you can choose the entity where you get more advantages. Then what are your expected profit and losses in the business? Then can you do the reinvestment, okay, in that particular area, or what are the cash flow and how is the system to withdraw that? Okay, so these are the aspects which any entrepreneur will consider when he wants to choose an entity. Now going on to the next one, as I told you, we are going to learn 4 types of entity over here: sole proprietor, partnership, HUF and multi-state cooperative society. So now we are going to start with the sole proprietor. What is a sole proprietor? A single person doing business. Okay, you will be the single person doing business, entire control will be that of a single entrepreneur, will be called as an proprietor. Okay, so he will not take help of any other person, but he will put in the capital, he will manage everything, He will employ least employees. Why? Because he has to save his capital for his business. Okay. So whenever anybody wants to open a cafe or any saloon or any of the shop, the first thing they start in India is a sole proprietor. So majority of business in India starts in the form of a sole proprietor, where it is managed, controlled, owned by an individual, single person. Okay, so he alone arranges for all the capital and he will be responsible for business alone only. Nobody is going to be responsible along with him. So when he is responsible for the business, he will get all the profits and also have to bear all the losses. So does the sole proprietor have a different pan from its business? The answer is no. In the eyes of law, the business and sole proprietor are one and the same. Okay, so sole proprietor and business are considered to be same, hence no separate pan is given. Also, it is very easy to form. Why it is very easy to form? Because no legal formalities at all. No agreement entered. Because can an individual enter into agreement with himself? The answer is no. In partnership, we have an agreement. In LLP, we have an agreement. But in sole proprietor, we don't have any agreement. Clear? Understood? Now, let's quickly go to the advantages of the sole proprietorship. The very first advantage is very easy to form. No much legal formalities, because single person is there. He cannot enter into contract with himself. Hence, no much legal formalities. But definitely our business has to be legal. It has to be lawful. Along with that, we have to comply with our local rules and regulations also. Like we are doing business in Maharashtra, so whatever are the rules applicable in Maharashtra, you have to follow those rules and take those registrations. Details of this will be learning in part B. Okay. After that, single person is there, so all the decision will be taken by single person. Individual need not ask anybody about it. He can change the fortune of his business overnight because he does not have to ask anybody. Entire control is that of an individual, right? So he will get all the profits in hand. So whatever efforts he put into, everything in his pocket, right? So profit belongs to only and only one person. No sharing of profit will be done in sole proprietor. Then there are various benefits also for MSME. MSME is micro, small, medium enterprises. So whenever there is a sole proprietor who is either micro, small, medium registered with the government, we'll be learning this. How to do registration under this? Under Udyam registration. So once you are recognized micro entity or a small entity or a medium entity, you get various benefits of that. Along with that, when your business is very, very small, you can take help from your family members also. Okay, so along with the government giving you various subsidies on electricity, water, family members also help you in that. Like you would have seen, no, mithai wala shop, okay, sweet shop. Whenever we have Diwali or Holi, all the family members of mithai wala shop comes and helps him. Why? Because there is shortage of employees. So it's better that family members help instead of paying to the employees as a whole, right? After that, the management is also very inexpensive because sole proprietor don't want any experts. He is himself expert in his business, so he need not hire any of the expert, and thereby he can save the expenses and put that in the business. So these are the merits of the sole proprietor. Now there are certain limitations as well. Now what are the limitations of a sole proprietor? First of all, management skills. Okay, they lack management skills, because if I am good in the baking of cakes, and if somebody comes with the proposal saying that can you open a restaurant along with baking of the cakes, but I am not efficient enough to do so because I know only one particular field. So in partnership, two partners can come of different field, and there you can have different things in one particular partnership firm, but in sole proprietor it's not possible. So there is least expertise available, hence cannot manage business efficiently because of lack of managerial skills. After that, there are limitations of resources as well. Why? Because single person, how much funds he can put into? Can he do the listing of a share? No, equity structure is not there. Can he get loans from the bank? Banks do provide loan, but sole proprietor being an unstable form of organization, even banks don't prefer. If they will give, they will always give a secured loan. Okay, hence there may be difficulty in raising the capital. Also, the liability of proprietor is unlimited. So if assets of the firm, so if assets of the business or the sole proprietor is not enough, okay, proprietor himself has to sell off his personal asset and pay off. So the liability is unlimited. Over here, there is lack of continuity. As I told you earlier, sole proprietor is most unstable form of organization. Why? Because if something happens to the proprietor overnight, he is not available, then what will happen? His shop will be closed. Understood? So that's why bank don't like such unstable form of organization and they don't prefer. Okay, clear with this? So this were the merits, demerits of the sole proprietor. Now how to form? Formation is so simple as discussed earlier. No agreement, no contract required. Just require a shop, open that shop, that's it, put all your materials. But yes, very important thing, you have to abide by local rules. Okay, so there are various rules applicable to the concerned state. If you are doing business in Delhi, if you are doing business in Maharashtra, if you are doing business in Tamil Nadu, as per state government rules and as per central government rules, you have to take various registration and licenses. So sole proprietor has to take PAN, TAN, GST if applicable. All this will be learning in chapter 13. Okay, so Shop Establishment Act, this is applicable if you are doing business in Delhi. Okay, then we have professional tax, it is applicable in Maharashtra. So likewise, as per state, you have to take various registration and licenses. Also, you want to avail benefit under MSME Act, so you have to take a Udyam registration and then only government can give you various subsidies. GST registration, as I told you, and if you have some intellectual property right, like for example, you are doing business with the help of a brand name and you don't want that brand name to be misutilized. So what you do, you take registration under intellectual property rights called as trademark. So you have to take that registration as well. Okay, so these are the basic rules, regulations applicable to the sole proprietor. But there is no specific law which is applicable to the sole proprietor. I hope it was clear. So we are done with the sole proprietor. So let's start with the partnership. I hope you have understood what is a sole proprietorship. Now in this video we are going to learn about what is a partnership and what are the types of partnership, what are the types of partners, also how to register a partnership and whether partnership registration is compulsory or not. Okay, I understand many of you might be answering that registration of partnership is compulsory in Maharashtra and not compulsory in India. Okay, but if you want to go to the court of law, it is mandatory, you have to register your partnership. So for non-registration of partnership, there are certain side effects. So basically, registration of partnership is optional. Okay, but yes, obviously there are certain side effects to that. We are going to learn all these things. So let's quickly start with the partnership. So what is a partnership? We have understood that two or more people come together, they bringing the resources. Resources means what? One person, one partner might have a capital, another partner may have a brand or a expertise. Okay, so two strong entities come together, they form a partnership with intention to earn profit out of it. Okay, so in partnership, minimum number of people required are two. So that's why we call partnership as association of persons, okay, who agree to combine their financial resources and managerial abilities to run the business and share the profits as per the ratio. It's not mandatory to share the losses because partnership act is silent on that, but it's mandatory to share the profits. In case of a sole proprietor, as I told you, in India, most of the businesses start as a sole proprietor. But as and when they require more funds or more expertise, what they do, they convert themselves into a partnership. How? They will find a prospective partner for them. So what kind of partner he will be? That partner shall be a very strong partner. So whatever there is a weakness in one partner, the other partner will be a very good at it. So it will be a strength to the firm. So both of these partners, when they meet or when they come together under an agreement, they can make a successful business. So whenever sole proprietor is in requirement of more capital, better supervision, control, proper division of work, and also sharing of the risk, he will go for the partnership by finding a partner. So now let's see, what does your section 4 of Indian Partnership Act 1932 say? For partnership, Indian Partnership Act is applicable. LLP Act is applicable to the LLPs only. Please understand this. Now, as per section 4, what is a partnership? Partnership is relationship between person who have agreed to share the profits. As I mentioned earlier, over here loss word is not written. So they have only written people who agree to share the profits of business all alone or any one of them acting for all. So in partnership, there is a principal and agent relationship. Now what do we mean by that? It means that one partner binds all other partners by his act. Okay? I hope you remember in LLP we have done this. Whenever any designated partner does any act in the LLP, does he bind the other partners? The answer is no. He binds the LLP, that is a firm. But in case of a partnership, your partnership does not have a distinct legal entity apart from its partners. So whenever any partner does any act on behalf of partnership, he is going to bind the other partners. So there is a relationship of a principal and agent. So all acts of the partners will be binding on each other. After that, person who come together to form a partnership, individually they are called as partners and collectively they will be called as a firm. So how many people are required to form a partnership? I told you minimum of 2. For maximum, even your partnership act is silent, but your company's incorporation rules in section 464 of Companies Act says that whenever there is any association of person wherein number of member exceeds 50, you have to compulsorily register it as a company. So a partnership cannot have more than 50 partners. Up to 50 it is okay, but not more than 50. Okay. Now there are various types of partnership. Okay. The first type of partnership is a partnership at will. Now what is the meaning of a will? Over here, will means the discretion of partners. What is a will? The discretion of the partners. So whenever partners want to close down the partnership, they may close down by giving a notice. Okay, so in the partnership agreement it will be written, this partnership is at will. What does that mean? It is a sole discretion of all the partners. Whenever they want to shut down the partnership, they may shut down. Okay, so that is a partnership by will. But the other type of LLP, but the other type of a partnership is partnership, or you can say a fixed partnership. So in fixed partnership, what happens? The term is fixed. So when term is fixed in a partnership agreement, it is written like this: this partnership shall continue up to 5 years from the date of the agreement. So the term is 5 years. So once 5 years are over, you have to close down your partnership. Okay. And the last type, you have a particular partnership. Particular partnership means what? It is for a specific project. Very simple example I can give you. Whenever your builders are there, constructions, okay, construction companies, they have different projects. So for each and every project, they enter into new partnership. So when that project get over, the partnership is over. That is called as a specific partnership. So they are creating a partnership for a particular project. Once that project ends, the partnership also ends. These are the various types of partnership. As of now, we have learned 3 types. First, partnership at will, partnership that is fixed partnership, and third one was partnership that is a particular partnership. Now, section 39 talks about the dissolution. Okay, now what is this dissolution? Dissolution is nothing but winding up or closing down. Now there are 2 kinds of dissolution. One is dissolution of partners, that is partnership, and another one is a dissolution of firm. Okay, dissolution of partnership and dissolution of firm. Now what is the difference? Are they one and the same? The answer is no, they are not one and the same. Whenever there are 4 partners, example, in any firm there are 4 partners. Out of this 4 partner, one is retiring. So when one is retiring, don't you think the entire partnership will get shuffled? Yes, because earlier the ratio was 25%, 25%, 25%, 25%. Okay, so each person was holding 25. But out of them, when one is going out, don't you think the ratio is going to shuffle? The answer is yes. So what is happening? Your partnership is getting dissolved. Okay, but does it mean you're dissolving the firm? The answer is no. Okay, so when any partners, when there are more than 2 partners, anyone comes in or retires, there's a dissolution of a partnership. Okay, but whenever there are 2 partners, okay, out of them one decides to close the partnership because he is going out. Okay, so when one goes out, can one person continue as a partnership? The answer is no. So now there is a dissolution of a firm. I hope you understood the difference between the two: dissolution of partnership and dissolution of the firm. Going ahead, insolvency bankruptcy code right now it's not applicable to you, so you can leave that part. Okay, now let's understand the concept of partnership by holding out. Okay, partnership by holding out. We will understand this concept with the help of an example so that you will understand it correctly. Now, there is one firm called as Vandita and XYZ company. Okay, Vandita and XYZ company. Now, they have a brand name. Okay, brand name is Sweet Shop. There is a partnership firm between Vandita Doshi and Mr. XYZ, and they are running a sweet shop. So there is a sweet shop, they are selling the sweets. Okay, now they have a friend whose name is Mr. Mithaiwala. Mithaiwala, even he is having his business, same sweet shop, but he is a huge businessman. He has a huge brand. So Vandita and XYZ has opened a shop recently. Okay, so they are doing a break-even business. But what happened later on? Due to Corona, their business got a big hit and it is about to close. Okay, the shop is about to close. One day, Mr. Mithaiwala came to visit the shop as well as meet their friends, and he understood everything about the business, that we are going to close down the shop and we are having huge losses. So Mithaiwala proposed something. They proposed that you use my name and then see what happens, because Mithaiwala is a brand name. Okay, so he is allowing us to use his name without changing the agreement. So he is not a partner, but he is telling the whole world that I am their partner. Okay, so what Mithaiwala is doing, he is holding out to be a partner in front of everybody, and partners are giving consent. Understood? Because they want to save their business. So proposal was there to use Mithaiwala. Okay, now tell me one thing, is this Mithaiwala your partner? Is Mr. Mithaiwala a partner of Vandita Doshi? Is he a partner? The answer is no. Then who is he? He is partner by holding out. Okay, he is partner by holding out. So without changing the agreement, without becoming a partner, he is telling the whole world, I am partner of this sweetie shop. Please take the product, please trust. Okay, picture is not yet over. Listen to me very carefully. Now what will happen when in that sweetie sweet shop, instead of sweetie sweet shop, they change the name to Mithaiwala? What will happen? The business began to run. The shop began to run. So when shop began to run, okay, customers used to purchase the product because of which name? Mithaiwala. So customers trusted which name? Mithaiwala. Okay, so don't you think if anything happens to the customer, something goes wrong, Mithaiwala would be responsible for that? The answer is yes. So when any person enters into a contract by merely hearing that this person is partner of this shop, then it will be a responsibility of partner by holding out to pay off that liability. So in case something happens to the customer, Mithaiwala will be responsible for all the liabilities he has to pay. Very clear with this? Understood? Okay, so who is partner by holding out? Partner by holding out means a person who is lending his name or telling all the world that he is a partner of this particular firm without actually being a partner. Okay, and when customers or the people trust him or enters into contract by his name, he is responsible for that. He means who? Partner by holding out. But there is one exception to this rule. Exception to rule of liability of partner by holding out. Okay, we have seen that partner or by holding out is responsible. Okay, but there is one exception. What is an exception? If partner by holding out dies. Okay, if partner by holding out dies, would his legal representative be responsible for that? The answer is no. So if partner by holding out dies and Vandita Doshi continues using the name Mithaiwala, legal representative of Mithaiwala will not be responsible. Okay, so legal representative of Mithaiwala shall not be liable for any act. Clear? Because they have not given consent. Who has given consent? Mr. Mithaiwala, and he died. Simple. I hope you understood this. Okay? Yeah. So these two paragraphs I have taught you. This is an exception which I was talking about. This paragraph is an exception. Okay, let's read that. Where after partner's death, business continued in old firm name. Okay, the continued use of that name or deceased partner name shall not itself make his legal representative or his estate liable for any act of the firm done after his death. Clear? Understood? So let's start with the features of the partnership now. What is a partnership? Partnership is in existence because of an agreement. So for formation of a partnership, there has to be a partnership agreement. In sole proprietorship, it did not require any agreement, but in partnership, definitely we require an agreement. So two or more people will enter into an agreement in the partnership. Okay, and it will be only on the basis of operation of the law. Okay, so partnership deed will be prepared by all the partners. And how to prepare a deed? Same, it will be on the non-judicial stamp paper. All the partners shall sign. It shall be witnessed by 2 witnesses and notary should be there. Same like your LLP. Then they have to engage themselves into a business. Okay, and that business has to be legal business, otherwise partnership cannot be legal one. And in partnership, it is compulsory to share the profits. Okay. After that, there is a agency relationship. Now, what is the agency relationship? We have explained you earlier also. One partner shall bind all other partners by his act. That is called as a mutual agency concept. But is this mutual agency concept available in the LLP? The answer is no. Okay, so partnership business will be carried on by all or any one of them acting for all. So all the partner is principal and can act on behalf of others as their agent. So they bind the partners. Also, the liability in partnership is an unlimited liability. So sometimes when the assets of the partnership are not enough, then partners have to sell their personal asset and pay off their creditors. Then there is a common management. Common management means what? The owners are only the managers. Plus consent of all the partners will be required to do any particular task. So consent of all partners is required for taking the important decisions in the partnership business. There is also certain restriction as to transfer of the shares in partnership. If all the partners do not consent in transferring any of partner's share, then that partner cannot transfer the share, but he has to sell the shares to the existing partner only. So partners can transfer his shares to any other partner only with consent of all the existing partner. Registration is compulsory or not? Now let's understand this. Is registration of partnership compulsory or not. Okay. Actually, registration of partnership is optional. So it is optional. Hence, registration of partnership is not compulsory, but there are certain side effects to that. Okay. So, if partnership is not registered, okay, partnership is not registered, then what will happen? Number one, very important, partners, okay, all the partners, if there is any dispute between the partners, so one partner cannot sue the other partner. That means they cannot go in the court of law for that dispute. So partners cannot sue other partner. This is the first side effect. Okay, they have to solve themselves. So because if they go to the court of law will ask them, there is a partnership deed which is registered. You will say your partnership is not registered, court will not entertain your dispute. Okay, the second side effect says that if any of the partner or the firm, they have any dispute with the outsider means a person who is not a partner, it may be a creditor, your customer, anybody, they cannot take them to the court of law. Okay, so partners cannot sue outsiders, but outsiders can sue the partners. Understood? But outsiders can sue the partners as well as the firm also. Okay, understood? So this was the first side effect, partners cannot sue the other partners. Second side effect, outsiders can sue the partners but partners cannot sue the outsiders. And now the third one, the third side effect talks about set off. Okay, so set off is not allowed when you have a unregistered partnership. What is a set off? Suppose Vandita Doshi have to pay you 5,000 and you have to pay me 10,000 rupees. Are we going to do the transaction like this? I will pay you 5,000, then you are going to pay me 10,000. No. What we will do? You will pay me 5,000 rupees. So what we did? Set off. Right? So in partnership also what happens? And any partner have to give some amount to the partnership, and when their partnership is winding up, okay, the balance whatever is there will be divided among the partners. So when that balance has to be paid to any of the partner, in that case set off is possible if you go to the court of law and when you are a registered partnership. But when you are not registered, partner will have to pay off the loan of partnership and then partnership will pay off the balance to them. So set off is not possible in case your firm is not registered. So only three side effects. What are this? Effects of non-registration of partnership. Effects of non-registration of the partnership. Very clear with this? Everybody understood this? That's great. Okay, so now anybody will ask you whether registration of partnership is compulsory or not. You have to say it's optional, but if we don't register the partnership, these are the three side effects. After that, duration of partnership. Now it depends upon the agreement. If your agreement say the partnership as will, so then it will go on as per the discretion of the partners. If it is by particular time, then once time is over, your partnership is over. If it is for particular project, then once project is over, your partnership is over. Okay, so basically your firm will come to an end when there are only two partners, one of them dies or resigns or removed. So then your term will be ended, but basically it will be on the discretion of the parties. So these were the features of the partnership. Okay, and now we are going to see the various types of partnership. I have already explained you this. What are the various types of partnership? First one, partnership at will. Partnership at will means what? It is a total discretion of the partners in this, and partner can end such partnership by giving a notice. Second one talks about a particular partnership. Now it is for a particular project. I gave you the example of construction business, right? So they are doing it for the particular business or a venture. So once that venture is over, your partnership is over. And third one is by fixed duration. So 5 years, 10 years, 15 years, this will be mentioned in the partnership itself. So once that period is over, your partnership is over. Now let's go to the types of the partners. There are 4 types of partner. The first one is active. This person shall participate in your business very actively. He will be responsible for day-to-day activities. He will be doing everything. So he is an active partner. Sleeping partner means what? Is very sleepy? No. Okay, he is not active in the business. He is having sharing profit, losses, name, everything is there, but he is not actively participating in the business. So that is a sleeping partner. So he do not take active part in day-to-day matters of the firm. After that, nominal partners. You remember Mithaiwala? Mithaiwala was a holding out partner. Let's say for example, Vandita Doshi XYZ had entered into a partnership agreement with Mithaiwala, then what will happen? Mithaiwala is giving name to us because he is having a brand name. Tomorrow Mukesh Ambani comes to your house and say, don't do all this CS and all, I'm giving you my brand name, you start your own business. So he's lending you your name because he is having that brand name, people know him. So nominal partner means you enter into agreement just for the name, because by name your business is going to grow. They may share profit or losses, they may contribute, but it depends on them. Mostly they don't participate into the business. Okay, so such partners lend their name, no capital contribution, also do not take part in the management, but yes, definitely they shall be liable to the third party. Is very important. Third, the next one, partner by holding out. I've already explained you what is partner by holding out. Okay, now the next question, can minor be admitted in the partnership? The answer is yes, minor can be admitted in the partnership, but only for the profits, not for any of the liability, not for any of the losses. So he may be admitted for only benefits of existing partnership. You cannot create partnership with a minor. Suppose me and my child, we both are there. I say, let's create a partnership. It's not possible because two person has to be a major adult person. So in the existing partnership, you can bring in your son as a minor. That is okay, but only for the benefits of the partnership, not for any liability. So I hope you have understood what is the partnership. Now let's start with the merits of the partnership. So what are the benefits of forming a partnership? Whenever partnership is formed, obviously entrepreneurs will look into the benefits. After that only they will be forming a partnership. So one of the very important benefit is the formation is very easy, because we have seen that registration is optional. Hence, in formation only we need to make is an agreement, and for agreement we have to pay the stamp duty, and stamp duty is as on the contribution of each and every partner. So it is not that high, and even though we do the registration of a partnership, the basic charges we have to pay. Okay, so no more charges are there. Hence, formation of partnership is very easy if we compare that with the LLP or a company. After that, partnership helps in pooling of the resources. This we have discussed earlier as well. Okay, whenever any partnership is formed, there will be two partners. So those two partners will be very competing to each other. Like if I am a company secretary and if I want to open a consultancy firm, definitely I would find one chartered accountant. So what will happen? I have a secretarial expertise, the chartered accountant has a financial expertise. So both of us together can form a very strong firm. Hence this will be pooling of the expertise, pooling of the resources, pooling of other tech, whatever is required for a partnership. Okay, so work among the partners shall be divided as per their specialization, and then they can coordinate their work. After that, there is a balanced business decision. Why there is a balanced business decision over here? The reason is that when there are two partners, okay, just imagine one sole proprietor. Sole proprietor takes all his business on his own, okay, but when there are two partners, both the partners will have different thinking. So when they have different thinking, they can take decisions more efficiently, because one person will think in only one direction, other person might think in other direction as well. So there might be a balanced decision making happening because of difference in the opinions and the views, plus there will be discussions. So when you discuss, you come up with so many things, right? Then sharing of the risk also happens over here. Okay, we'll be sharing the risk also. In sole proprietor, entire risk goes to the sole person, but in partnership, we'll be sharing our risk and losses. So these are the merits. So wherever merits are there, definitely the demerits come. So there are certain limitations as to partnership. The very first limitation is a uncertainty. It's a unstable form of organization. In case of death of any party or any partner, and there is only one remaining, so there are basically two partners in the firm, one dies, what will happen to the firm? The firm has to be closed down. Why? We cannot have a firm with a single partner. Got it? After that, implied authority. There is a concept of mutual agency in the partnership. Oh, if I do some fraud, the others are also responsible for that. If I make loss to the partnership firms, are responsible for that. So this is an implied authority. So partners are not liable for their own acts, but also they are liable for the acts of the other partners. After that, there is a risk of disharmony. Wherever there are human beings, the disputes are there. Disputes may be for any reason, the ego, okay, somebody is putting more efforts, you're not putting more efforts. So there is a distrust. When there is a distrust, there is no harmony. And when there is no harmony, there is no trust at all. So where there is no trust, can you do business together? The answer is no. So most of the partnership decisions are to be taken unanimously, but where the views do not reconcile, over there the problems come up. Okay, so some partners are very rigid and they will lead to lack of harmony. Over here, the withdrawal difficulty is also there. Why? Because you need consent of all the partners and then only firm can be withdrawn. Otherwise, we cannot withdraw the firm. So you have to go out by taking your share. But for withdrawal of firm, we require consent of all the partners. Then institutions don't have confidence of partnership. Which institutions? Foreign institutional investors, or you have domestic institutional investors, financial institutions. These people, if they partnership goes to ask for a loan, they don't have much confidence. Why? Because it's an unstable form of organization. That's why the liability of partner is unlimited, even that is the reason. Okay, so partnership always face difficulty in raising the capital, same like your sole proprietor. Okay, then there's difficulty in expansion also. Why? Because so many negative points are there, so many limitations are there. If we wrote down, first of all, it's an unstable form of organization. You don't know when your partner will move out. If he move out, your firm is closed. Then after that, there is no equity element in it, so difficulty in raising fund also. So raising fund is a big question in front of all the partnership, because financial institution will not trust a partnership. Okay, so their raising fund limitation is very less. After that, the third one about the expertise. They cannot bring in more and more expert because they have to increase the number of partners then. Board of director is a body where different expertise are there, but in case of a partnership, the expertise is very less. This all will lead to incapability of firm to raise fund and also barrier in expanding the business of the partnership. So this was your merits and demerits of the partnership. I hope you have understood. Now let's start with procedure to form a partnership. How are we going to form a partnership? What is requirement of forming a partnership? we require a partnership agreement. Okay, for partnership agreement, we will require 2 or more partners. Okay, and this is how your partnership agreement will be made. It will be on the non-judicial stamp paper signed by all the partners, 2 witnesses, notary, that's it. If you don't register your firm, what will happen? See, making agreement is different and registration is very different. Okay, now let's understand over here. What is the requirement of formation of partnership and partnership agreement? Okay, now how do you make the partnership agreement? We are going to make this agreement on non-judicial stamp paper. Okay, on that you have to pay the stamp duty. All partners shall sign. We require 2 witnesses and then a notary. Okay, so this is your partnership form ready. Once this is done, your partnership is formed. So formation is done. Now let's go to the registration of the partnership form. Registration of partnership form. How to register a partnership form? See, basically registrations are in 2 categories. One, registration with the income tax department, and another registration is with the registrar of firm. Now who is this registrar of firm? Like we have registrar of companies, who is a regulating body for company and LLP. We have registrar of firm for the partnership. So registrar of firm, this is a regulatory body, regulating authority you can also call that. So over here 2 kinds of registration are there, out of which your registration with the income tax department becomes mandatory. It is compulsory to register your partnership deed with the income tax department. If you don't register your deed with the income tax department, your partnership will not get a PAN. If you don't have a PAN, you cannot open a bank account. If you cannot open a bank account, are you going to do business in black? Answer is no. Okay, so why do we register? For the PAN. Because after getting PAN, we can open our bank account. Okay, so this registration is compulsory. But what about this registration? Registration with firm. This becomes optional. Okay, but if we don't register, we have seen the 3 side effects of non-registration. First, partners cannot sue other partners. Second, partners cannot sue the outsider, but outsider can sue the partner. And third one, the last, set off is not possible when you are not registered firm. I hope you understood. Now we are going to see the procedure to register your firm with registrar of firm. So which registration are we going to see now? We are going to see this registration as of now. Okay, so let's begin. Procedure to register partnership firm with ROF, that is your registrar of firms. Okay, first one, this procedure is 2 routes. Okay, first is the online and second one is offline. So online way and offline way, both we have to do. So for the very first step, we have to visit website of registrar of firms, and we have to download form 1. Which form we have to download? Form 1 is for registration of the partnership. After downloading, fill in the details in form 1. Now what all things will be asked in the form 1? You will have to write what is the name of the firm, okay, and this will be having in 2 languages. Like you are in Maharashtra, so the main language of Maharashtra is Marathi, so you will have to fill in details in English and Marathi. So on and so forth for the other states also. Okay, so you have to fill in the details. What is the name of the firm? What is the business? Who all are the partners? They are partners since when? Okay, so all the details you have to fill in. After that, third one, we have to submit form 1, okay, by attaching following documents. You have to attach the following documents. After that, you can submit form 1. Now, what all documents we are going to attach in form number 1? First one will be attaching affidavit, okay, by partners that whatever information they are giving is true and correct. Then we will require a partnership agreement. This partnership agreement shall be in 2 languages, okay, one in English and second vernacular language of your state, okay. After that, third one, we need stamp paper. It depends on state to state. In Maharashtra, we require 100 rupee stamp paper, okay. Depends on state. Then we require a demand draft. Demand draft, why do we require? It is for the fees of registration. We have to pay the registration fees, right? So we have to attach a demand draft. And then also we have to attach proof of registered office of partnership. Registered office of your partnership. All these documents we have to scan and we have to attach in form number 1. So once we attach all these documents, the 4th step, we have to submit form. So once we submit form, acknowledgement shall be generated. What shall be generated? Acknowledgement shall be generated. So once acknowledgement is generated, now we have to start procedure for the offline mode, okay. So we have to take print of form 1, we have filled that one, and the acknowledgement also which we have received, okay. Now on these 2 things, that is on form and acknowledgement, both of it we have to do notary on that, okay. What we have to do? We have to take a notary. Notary is done by the officer of the court of law, okay. So we have to do notary. After that, 6th step, we have to visit office of ROF, that is registrar of firm. Every state has registrar of firm, okay, like every state has ROC, every state has ROF also. So we have to visit office of ROF, submit physical documents with ROF in 2 copies. How many copies? We have to take 2 copies, okay. Why 2 copies? One will be original and second one will be duplicate. Okay, understood? So he shall give us the acknowledgement, one copy shall be retained, the one shall be given back to us. After that, seventh step, ROF shall vet means check. Okay, vet is a legal word for the check. Vet all the documents and if they found correct, okay, so if ROF finds it correct, what it shall issue? It shall give an acknowledgement. On original and retain duplicate copy with them. Okay, so over here our work is over. He has given us, now he will start his own investigation, and if he founds correct, it will give us certificate of registration. We cannot write certificate of incorporation over here, but what we have to write, once ROF is satisfied, it shall issue certificate of registration. What it shall issue? A certificate of registration. I hope this is clear. This is a process to register a partnership. If you are registering partnership in Maharashtra, it takes a long time. Almost it takes 1.5 to 2 years to register a partnership. Okay, yes, it really happens. Okay, these things we have done practically, that's why we know that. Okay, so I hope you have understood the entire process, how to register your partnership, right? Now, also we have discussed how to register partnership with the income tax department, and it is mandatory. With ROF, it is optional. Now let's start with the Hindu Succession Act. Okay, we have learned sole proprietor, we have learned with the partnership, and now we are going to learn about HUF, that is Hindu Undivided Family. Okay, now your Hindu Undivided Family, first we'll see it is governed by which act? It is governed by Hindu Succession Act, along with that the Income Tax Act. So it is governed by Hindu Succession Act and Income Tax Act. Okay, so these are the two acts which governs your HUF. Now what is basically an HUF? Let's understand this with an example. HUF is an Hindu Undivided Family. Now there is one wealthy businessman. Okay, he is a wealthy businessman. His name is Mr. King. Okay, now Mr. King has ancestral properties. Ancestral properties means what? Properties which we receive from our forefathers, those are the ancestral properties. So he is doing ancestral business, so they have business since ages now. So this ancestral property, they have two big hotels. Okay, like Taj, so he has two Taj. Now he receives handsome income from that. Okay, also along with the properties he has family also. In family he has wife, along with wife he has 4 sons. How many sons he has? He has 4 sons. Now these 4 sons, son 1, son 2, son 3 and son 4. These all 4 are married. Okay, so son 1, wife and 2 kids. Same, son 2, wife and 2 kids. Same for son 3 and same for son 4 as well. Okay, now this Mr. King makes a HUF. What Mr. King does? Mr. King creates HUF. Okay, he himself will be the main karta. So Mr. King will be the main person who manages the business. So main person who manages the business in HUF is called as a karta. So he will be managing the business. That's why he will be called as a karta. And other family members. They all shall be co-partners. Okay, co-partners means the members of HUF will be called as a co-partners. So King, his wife, 4 sons, their wives and children all can be the member of HUF. This all became the member of HUF. Now what that HUF does? HUF holds that ancestral property in its name. Okay, so this is an example of HUF. Now why do we form an HUF? What is the requirement? King would have done business in his own name. Okay, why HUF? Now let's understand why HUF. Why HUF? See, King has his own business. So he has income from this business, right? Along with that, King also has ancestral property. So out of this ancestral property also he receives income. So both this income goes into the king's name and it is taxable. Right? For example, his own business is a wealthy man. We won't be able to do such calculations, so I am keeping it simple. So from his own income, he is having 10 lakhs as a profit, and ancestral property is having 20 lakhs as a property. So total 30 lakhs. So his taxable income is 30 lakh rupees. The answer is yes. Okay, but just imagine now King has created an HUF. So King is different and King HUF is different. And this ancestral property he has passed on to this HUF. So King's income 10 lakh rupees taxable and HUF's income 20 lakh rupees taxable. As we know, there are certain slabs. Okay, every individual has a slab as per Income Tax Act. So for HUF also, individual slabs are applicable. So up to 2.5 lakhs we get the exemption. Over here also he got 2.5 lakhs exemption. Don't you think he's saving lot of income? Yes or no? Yes. Okay, so in order to save the taxes, in order to reduce the taxable income, we can incorporate HUF if we have a family and if we have ancestral property. I hope this is clear. Okay, so let's revise. What is an HUF? HUF is an arrangement between the family members. So a lineal descendants can make an HUF. So over here the example was King, his wife, 4 sons, their wives and their children. One HUF was there. The main person was Mr. King, so he was Karta and he had transferred his ancestral property to that HUF. So the main business of HUF was to do the business under that property. So entire income of that ancestral property goes into the hands of King HUF and not King. This is how he saved the taxes. Understood? So one of the example of the HUF. Now let's understand few more things about it. HUF is separate entity. Okay, in the eyes of law, HUF is a separate entity, so its income will not be clubbed with the income of the members. Okay, the eldest member of family, okay, this person can be a karta. Karta means the head of HUF who shall be managing the business of the HUF, and other members shall be called as what? These are the co-partners. Okay. After that, this co-partners, there is an amendment in 2009. Okay. In 2009, Supreme Court gave a verdict saying that even females can be a co-partners now. Okay. Even females and daughters can be co-partners. I'll tell you the difference. Earlier, before the Supreme Court verdict, females and daughters were not the co-partners. They were just a member of HUF. So what is the difference between member and a co-partner? Member cannot ask for partition. Co-partner can ask for partition. Understood? So now female has got the same right which males have. So even females can be the co-partner. This is a landmark judgment by the Supreme Court of India. Okay, so this verdict came. Now, membership in this HUF, it is by birth. Okay, so when it is by birth, even minor can be member of HUF. Obviously, minor can be member of an HUF. Understood? So, by birth or by marriage. If X, a female, gets married to a Mr. King who is having an HUF, so she automatically becomes member of that HUF. Understood? So, membership is derived by birth or by marriage. Now, let's understand some history of HUF. How this HUF came. In the olden days, there were two schools. Okay, in the olden days, there were two schools. Okay, now the name of first school was Daya Bhaga and the other school was Mitakshara. Okay, two schools, one was Daya Bhaga, another one was Mitakshara. These are the two old Hindu schools. As per the Daya Bhaga, the learnings of Daya Bhaga means son does not have right to property by birth. So, son does not have right to property by birth. Okay, but he acquires that right. He acquires right on death of his father. So this was the thinking of Daya Bhaga school. Son does not have right to property by birth, but he gets right on death of his father. This thinking was not liked by most of the people. Okay. Now let's see what does Mitakshara says. Mitakshara says, son gets all rights of his father by birth. Now this was liked by most of them, okay, and this was carried forward, and on this basis only we have a concept of an HUF. Okay, so by birth, by marriage, we can become member of HUF. HUF is a separate entity. We create HUF to save the taxes if we have ancestral properties. Okay, now this Daya Bhaga was prevalent in Assam, and Bengal, and Mitakshara was in other parts of India. I hope this is very, very clear, right? Okay, so now let's move ahead. I have told you about the tax exemption. Still we will see the tax benefits under this HUF. What are the benefits under HUF? Why should we create a HUF? HUF is a separate entity, right? What is an HUF? HUF is a separate entity apart from its karta and co-partners. Apart from its karta and co-partners. Hence, the income of HUF will not be clubbed in income of karta and co-partners. Okay. Hence, income of HUF is taxable in hands of HUF itself. Okay, it will be taxable in the hands of HUF itself. I hope you are writing down the points and understanding as well. After that, it also enjoys various benefits. It enjoys various other exemptions and benefits under tax. Like one example they have in case of a gifts. HUF can receive gifts up to 50,000 in one particular year tax free. Okay, so in any particular year up to 50,000 rupees, this is exempted, totally exempted. So above 50 lakhs it will be taxable. So one more benefit under HUF. Now after that, which property we can transfer to HUF? This is very important. Which property can be transferred to HUF? Can you transfer any property to HUF? No. Only and only ancestral property can be transferred to HUF. We cannot transfer any property to HUF. So if I have purchased a property, I cannot transfer it to HUF because even though I transfer, the income received from that property will be taxable in my hands only. Understood? So which property can be transferred? Only and only ancestral property can be transferred to HUF. So we have only benefit in case of ancestral property only. What is the difference between the personal and ancestral property? The one which I buy with my money is personal property, and one which I receive from my fathers and forefathers is an ancestral property. Okay, so if any member of HUF, okay, he transfers his personal property, okay, is transferring personal property to HUF. What will happen? There is no use of this because whatever income will be earned in that property, it will not be taxable in hands of HUF, but it will be taxable in hands of the member. Okay, or rather we can write like this: the income received shall be taxable in hands of that member. That means the owner. Understood? Clear with this? Okay, so only ancestral property can be transferred. Now very important thing, very important. What is essential for HUF? Why do we create HUF? What is essential for HUF? We have two options. A, is family an essential requirement for HUF, or you have an ancestral property? So what is the essential requirement of HUF? Is it a family or an ancestral property? The correct answer is family. Family is the most important requirement for HUF. So any person is single, he is not married, okay, he does not have any children, nothing, but he has ancestral property. Can he create HUF? No, because essential requirement is a family and not an HUF, okay, and not an ancestral property. So if any person is married and he does not have ancestral property, can he create HUF? Why not? Definitely he can create HUF. I hope it is clear. Okay, yeah, please remember this very carefully. After that, who can create HUF? Those who are considered as Hindu can only create a HUF. That is Hindus, then Buddhist, Jains and Sikhs. Only this 4 category of people can create HUF, because to them only Hindu Succession Act is applicable. For other religion it's not applicable. Okay, clear with this? Yeah, so this was our important concepts as far as your HUF is concerned. Let's go to our notes. Most of the things I have explained you. So HUF is very peculiar form of business in India. It is by operation of the law, so we don't require any contract agreements. It's definitely HUF should be in writing. Okay, so no separate legal entity. That means even though it is taxable in the hands of HUF, but still it's not a separate legal entity like your company and a LLP. So it is governed by Hindu Succession Act and the Income Tax Act. It is controlled by your Hindu law. We get membership of HUF by birth or marriage to male member obviously. The one who controls the business, the head, is called as a Karta. So his decision will be final and binding on all other members. So liability of Karta is unlimited because he is managing the business, and liability of other members will be restricted up to the stake in the business. That means there are 4 sons, each son is holding 25%, so his liability will be restricted up to 25%, okay, but liability of that of a Karta will be unlimited. After that, I have told you about the 2 schools, the Bhaga and the Mitakshara. Now let's quickly go to the characteristics of the HUF. HUF is governed by Hindu law, this we have seen. It is managed by a person called as a Karta, mostly he is the eldest member of the family. Yes. After that, the membership we get by birth, we don't require anybody's consent or agreement is not required. The liability of Karta is unlimited and others will be limited. How much? Up to the stake they are holding in the business. This is permanent existence, okay. So till the time you have family members there and family members decide to wind up the HUF, then only you can wind up. So death, insolvency of any member is not going to affect the existence of your HUF. There is an implied authority for the Karta. So Karta can only bind all other people by their acts. So co-partners cannot act anything. Can minor be a member of HUF? Yes, the minor can be a member of HUF because by birth only you derive the membership. What about the dissolution? Dissolution can be done only with consent of all the members. Single member cannot dissolve the HUF. Now let's see the benefits of the HUF. It's very easy to start because lot of legal formalities are not there. At times family members avoid the agreement and contract, but we should always have agreement, contract in writing because it's ultimately a business, right? You cannot trust even your family members. As it's a family arrangement, most of the family avoid the agreement, okay. Then efficiently managed. Why? Because it is centralized, all the decision making power is with the Karta and he is having that expertise, so he will be managing very nicely. Information can be kept very secret because it's not duty of Karta to disclose everything to all the members of HUF. It's not required, so secrecy will be at highest. Decision making is very prompt because Karta is a single person taking the decision, so he will be taking the very quick decisions. Karta will be handling business very economically, because it's his family affair, his own money involved. So obviously he'll be doing it very economically. He can get a very good credit facilities from the market. He can get loan by keeping his security at lien or a mortgage. See, basically HUF is an arrangement between the family members, so there will be natural love and affection. So fraud and all things mostly does not happen over here. Okay. Then there is freedom for Karta. He can choose any kind of a business, no matter. Okay, so this were the benefits or merits of HUF. Now, how to register your HUF and where your HUF is registered? Basically, registration of HUF is only done with the income tax authorities. Okay, yes, we have to take a PAN and then only you can open your bank account. So HUF registration happens. So how do you register your HUF? If you have an agreement in writing, then only you can register, right? Yes. So first of all, the main requirement is to create a HUF deed. Deed will be on the non-judicial stamp paper. Okay, and stamp paper value will be determined on the value of the property. Okay, so in that you have to give all the details of Karta, co-partners, address, and where is the source of fund, from where you are getting money, also where you got your ancestral property. So all the details has to be there. Very important, deed is not compulsory, but it is always better to have things locked in writing. Understood? After that, it should be written on the formal document, that is on the stamp paper. If you write on the normal A4 size paper, it does not have any value because you have not done on the stamp paper. Then eldest member will be a Karta. Even females can be Karta, no problem at all. Then all the name of members of HUF and name of HUF should be given. After that, name of HUF should be written with the name of Karta, as I had wrote. The HUF was made by king, so king was a Karta, so the name of the HUF was King Karta. If I make HUF, it will be Vandita HUF. So surname will not be there, only the main name will be there. After that, HUF shall be affixed. Okay. After that, HUF deed also should have capital by which HUF has started its business. Very important, declaration is required in the HUF by every member of the family, that is all the co-partners, that they give their all right to the Karta, all authority to Karta, and Karta can take all the decisions. So Karta has all the authority, and Karta also has right to do all the transaction on behalf of the co-partners. After that, HUF should have a rubber stamp. Okay, rubber stamp should be there, that should be there on the HUF deed. After that, it should be notarized. So it will be signed by all the members along with the Karta, and it will be notarized. This is how you make an agreement. It's a normal agreement only. Okay, once done, we have to register the deed with the income tax, obtain the PAN, and also open the bank account. Okay, now there are certain key points relating to the HUF. Most of that we have discussed, but we'll have a look at it. HUF is a separate entity as far as income tax is concerned. That's why it's differently taxable. Individual slab rates are applicable, as I discussed. We cannot transfer our money to HUF. Only ancestral property can be transferred. Okay, so only ancestral property can be transferred. Then if we transfer money or to the HUF, then it will be taxable in our hand. Okay, then whatever income earned by HUF property, HUF can also invest that, where in the instrument like share, mutual funds, etc., etc. Okay, it can be invested. So what is the requirement? Property's existence is not a prerequisite, but family is a prerequisite for existence. So if nobody has a family, they cannot start with the HUF. Whatever gifts will be received by the members during birthday parties and all, that can be transferred. Okay, because you will get exemption in the gift, right? You remember 50,000 rupees. Yes. It will be taxed as a separate person. It will also gain tax slab income, that is 2.5 lakhs first exceed, that is 2.5 lakhs first exemption we get, it will be available to the HUF also. Also it will get exemption under ATC. If you invest in the PPF, you will also get exemption under ATC. Now all these points we have already discussed. Okay, so you can just refer to this. Yeah, that's all for our HUF. Please go through HUF very nicely, remember all the points. You may get a case law or direct question on this. Now let's start with the last topic of this particular chapter, that is your MSCS, that is Multi-State Cooperative Society. I think you have never heard about this, but we might have heard about something called as a cooperative society. Okay, now this is not cooperative society where you live, okay, that is a different society. But this cooperative society, basically it is registered at state level. Okay, it is registered at state level. So what is this cooperative society about? This society will consist of few individuals, okay, having a common interest. Few individuals will come together, they will be having a common interest. Like we had a producer company, we have learned in chapter number 2, right? So in the same way, this is also a cooperative society. Mostly your producer companies are the cooperative societies. So this cooperative societies, the individuals will be there having a common interest. Like for example, common interest example I can give you. Person who deal in dairy and dairy products, or agriculture allied activities or products. Few people who are doing the insurance business, insurance products, etc. Okay, so these people who are having a common interest, they will form an cooperative society. So when we talk about a cooperative society registered at the state level, the individuals have to be from within the same state. So all the individuals from Maharashtra who are having same interest, same goal, they will form a cooperative society. They will register that with Maharashtra Cooperative Registrar. Okay. Now these people, what will happen? This cooperative society which they have registered, this cooperative society shall deal only with its members. Okay, so this cooperative society can give loan, provide credit facilities to its members, then it can deal in product of only and only of its members. So all these facilities are available. It's not a non-profit organization, but it's a profitable organization. But cooperative society where one common interest will be served by all the people, for all of their interests they'll be working together. Okay, if Mr. X member requires loan, it can be taken from the credit from the cooperative society and he will be given discount on the interest rates. So likewise, okay, so these are the cooperative societies at the state level. But over here we are going to discuss about multi-state cooperative society. So this is at the interstate. Okay, this is interstate. So now what is MSCS? Let's understand MSCS now. Over here, few individuals or even cooperative societies. So even cooperative society can be member of this MSCS. Few individuals along with the cooperative society having common interest. Okay, Now this individuals and cooperative society, they should belong from different states. So few members from Maharashtra, few members from Gujarat, they want to open a cooperative society. They cannot register a state cooperative society, but they have to form a multi-state cooperative society because they are dealing in multi-state. I hope you understood this. Okay, so which is a governing law to this MSCS? The governing law to this MSCS is Multi-State Cooperative Societies Act 2002. Original law was made in 1984, but now it has been modified. It was modified in 2002. I hope this is very, very clear. Okay. Now, under this MSCS, now let's go to our notes. So MSCS Act was enacted in 1984. It was modified in 2002. So now we have MSCS Act 90. We have MSCS Act 2002. So now this is for incorporation of cooperative society who has object in several states. So they want to operate in various states. They don't want to operate in one particular state. So in this, two kinds of cooperative societies are there. One, primary cooperative society. In primary, individual plus institutional members will be there. And in federal cooperative, only institutional membership is there. So only and only cooperative societies will be forming a multi-state cooperative society. So both of these are covered under this MSCS. Now, what are the different kinds of MSCS? This question is asked many a times. So we have to remember different kinds. Multi-state solar cooperative society, farming cooperative society, credit cooperative society where loans and investments are done, agriculture cooperative society, real estate cooperative society where construction related activity is done, dairy farm cooperative society, transport cooperative society where transport activities are carried on. So these are the various forms of multi-state cooperative society. Now as I told you, what will be the main object of MSCS? It will serve the object of the members. So it will be serving interest of members of more than one state, then only it is a MSCS, otherwise it is not an MSCS. Okay, it will also provide for economic and social better help. It will provide for self-help, also mutual aid. Mutual aid means what? And self-help means what? If I have excess money, I can give loan, I can keep that money as a deposit with the MSCS, and someone who is in need of that money can take that money and give me the interest on that. So this is called as a self-help and a mutual aid. Now, can net profits be distributed among the members of the MSCS? The answer is yes. As I told you earlier, it is not a non-profit organization, it's a profit organization. Hence, net profits can be distributed among the members. Is it a separate body? Yes, it's a separate body. And it also has a limited liability of the members. It does not have a corporate legal status like your company and an LLP. Can they contribute to the political parties or can they give loan to the non-members? No, it is prohibited. Please remember this point. It is prohibited. They cannot contribute to the political parties, neither they can give loan to the non-members. Can MSCS do investment? Yes, but only and only in the recognized securities, means securities wherever permission is given, only those securities it can invest. Is it required to do annual audit? The answer is yes. MSCS has to carry out the annual audit and that is mandatory. Whenever CG requires a special audit to be done, because if CG thinks that some fishy transaction is going on, some fraud is going on in the MSCS, it may order for a special audit and it may appoint a officer also to do a special audit. After that, now what about the membership? Let's learn about the membership of MSCS. registration of MSCS. Okay, so how many members are required? The first one, when only and only individuals are there. When only and only individuals are forming MSCS, then minimum of 50 individuals are required. How many? Minimum of 50 individuals are required from each state. From each state we require 50. And how many states it should involve? Minimum of 2 states it should involve. Okay, so when only individuals are forming MSCS, minimum of 50 individuals from each state. After that, when 2 or more cooperative societies are forming MSCS, can they form? Yes, we have seen the Federal Cooperative Society, right, where only institutions are the members. In that case, these cooperative society we are already registered at the state level. Now it want to make a MSCS where they will operate interstate level. Okay, so they will have to appoint an authorized representative, because cooperative society does not have existence, right? So it requires an individual. So it will appoint an authorized representative of at least 5 cooperative societies. So minimum 5 cooperative society are required to form an MSCS. Okay, understood? And now these 5 cooperative societies, they have to be from different state. To be from different state. Minimum 2 should be from the different states. Okay, this is a provision regarding cooperative societies. After that, the third one. First we saw about the individual, second we saw about the cooperative societies. Now third one, where existing MSCS and existing cooperative society, they both want to form a new MSCS where the operative areas will be broader. In that case, we require authorized representative from each society. What do we require? Authorized representative from each society. Over there is no minimum requirement of 5 or 50 because already MSCS is involved. That's why it's not required. Okay, after that, now the fourth one, MSCS is there plus cooperative society is there plus individuals. So this is a hybrid version. So MSCS, cooperative society and individuals want to come together and form new MSCS. Okay, in that case, first of all, as far as individuals are concerned, at least 50 individuals shall be required from 2 or more states. So from at least 2 states we require 50 individuals each. And as far as authorized representative is concerned, authorized representative from the cooperative society. Okay, we require minimum 2. How many we require? Minimum 2 from different states. So minimum 2 cooperative society should be from different state. I hope you have understood this. Let's revise. If only individuals want to form MSCS, then minimum 50 individuals should be from each state. If only cooperative society want to form MSCS, then minimum cooperative society should be 5 and authorized representative of 5. If MSCS and cooperative society want to join hand and form MSCS, then authorized representative of all of them. If your cooperative society, MSCS and individuals want to come together, in that case, At least 50 individuals from each state, that is 2 or more states should be there, and cooperative societies authorized representative. In that, at least 2 cooperative societies should be from different states. I hope you have understood the membership part. Okay. Now, there are certain important points we shall be learning it here. So, this we have learned. Point 8, 9 and 10 you can do from the written notes, because if you find this confusing, that would be helpful. Now, what are the various benefits under MSCS? Why do we form MSCS? MSCS gives loan at reasonable rates. So, instead of members getting loan from bank, they can get loans from the MSCS. Can MSCS give loan to the non-members? The answer is no, they cannot. MSCS also can start branches all over India. It's not restricted to one particular state like your Nidhi company. It has a very low compliance cost. It does not have high compliance cost like your companies. And whoever are the members, they are the owners and customers both of society, right? Because MSCS can only deal in the products of the members of the society and nobody else. Now, how to form this MSCS? Formation of MSCS is very easy. When a cooperative society is registered at the state level, they will go to the registrar of cooperative society, which is located at each and every state. But now this is a multi-state cooperative society. So over here, the governing body is Central Registrar of Cooperative Society. Who is the governing body? Central Registrar of Cooperative Society is the governing body for the MSCS, because this is located at New Delhi and MSCS shall be registered centrally, so it can operate in all over India. Okay, so the location is at New Delhi. Now, which form we have to file for registration of MSCS? We have to file Form 1. Okay. Now, along with Form 1, we have to attach all these documents. Now, what are the documents? First one, a certificate from bank about a credit balance, that MSCS has this much of credit balance to their account and this will be transferred to the MSCS. This is a requirement. After that, we have to explain a scheme, that what is the scheme of MSCS and which products they will be dealing into. After that, like companies have articles of association, MSCS also have its own rules and regulation. These rules and regulation are called as a bylaws. Okay, so in bylaws they contain rules and regulations. So 4 copy of such bylaws. Then what is the proposed area of operation? Initially, registration will be given only for 2 contiguous states, means states which are near each other, immediate contact like Maharashtra, Gujarat. Okay. After that, they can go beyond the boundary. Then for individuals, as I told you, at least 50 members should be there from each state. So whenever individuals are forming, they have to give list of all the members, name, address and all other details. So ID proofs will be required, and there will be a person called as a chief promoter. Who is a chief promoter? Chief promoter means a person who will be handling the formation of MSCS. So he will be one of the member of the MSCS only. Clear with this? Understood? After that, that chief promoter will be certifying each and every member's ID proof, that he has gone through everybody's ID proof, verified and it is true and correct. No member is bogus. Okay. Then if we have already a cooperative society, okay, then we require a resolution from the members of cooperative society that they want to form a MSCS. So certified copy of resolution passed that they are going to form an MSCS. After that, we have to give contact number, email address of chief promoter, because central registrar of cooperative society shall be in contact with the chief promoter only. So in case of any discrepancy or any other document requirement, they will be contacting the chief promoter only. So these are the basic documents. But now when your MSCS has object relating to thrift and credit, okay, that means it is going to take loan, give loan, it will be the main activity of your MSCS, then you have to attach the following other documents. Only 2 are there. So one, we require NOC from Registrar of Cooperative Society wherever your area of operation is. So if you are going to operate in Maharashtra and Gujarat, then you have to take consent NOC from Registrar of Cooperative Society from Maharashtra and Gujarat. And second, we require credentials to be certified. That means the promoter, the chief promoter of the MSCS is a clean chit. He has not done any fraud, so his credential need to be certified. Now, who will give the certification? The Registrar of Cooperative Society, where your head office of MSCS is located. Okay, these are the two additional documents required in case we have object of thrift and credit. So all these documents has to be submitted in form number 1 to the central registrar, fees to be paid, and it shall dispose of your application within 4 months. If you don't receive the reply within 4 months, then it will be deemed to be accepted. So your MSCS is incorporated. So if it is not disposed within 4 months, then it shall be deemed to be accepted and it will be a conclusive evidence. So whatever certificate you will get from the Central Registrar of Cooperative Society is the conclusive evidence. You don't require any other proof on this. Okay, so that's it with the MSCS. I hope you have understood this chapter as a whole. It was a very easy chapter, guys. Only 4 concepts were there: sole proprietor, partnership, HUF and MSCS. I hope you have understood your chapter number 6. Now let's quickly solve the past paper questions. The first one, Paramveer and Associate, it is a partnership firm, that is a practicing professionals firm. In that there are 3 partners, each one is holding 1/3. So name of 3 partners are Ashok, Paramveer and Veer. Okay. So your Ashok and Paramveer thinks that the activities of Veer are not in interest of the firm. So both of them want to remove Veer from the firm. So we have to advise whether Ashok and Paramveer can do so by quoting provisions of Indian Partnership Act. Now we will go little bit into the Partnership Act, and if similar question is asked, you have to write this answer. So as per Partnership Act, a partner can be removed by following the conditions. So what all are the conditions? The first one, expulsion has to be existed in the contract. We have always discussed that partnership firm can do whatever is written in the contract. Okay. So if in the partnership deed it is written that any of the partners, if they think that any of the partner is not doing activities for the interest of the firm, majority of partners can remove. This provision has to be there. If this provision is there, it can be removed. Also, power is exercised by majority. So first it has to be in the deed. Second, it is exercised by the majority. Third, it is exercised in the good faith. Now how can you understand it is in good faith? The expulsion is in interest of partnership first of all. Second, it is expelled by giving notice. So Veer has been given notice and opportunity of being heard is provided. Without giving opportunity of being heard, nobody can be removed. I hope this is clear. Okay, so this is how we have to write. So if Ashok and Paramveer, they have complied with these conditions, then only they can expel Veer from the firm. Without complying with these conditions, they cannot expel. Clear? Next. Srimati H is head of family consisting of her husband who is physically challenged and 2 sons. She heard there are certain benefits in terms of management, decision making, taxation in HUF. Okay. So as a professional, we have to advise key points what Srimati has to take care as far as creation of HUF is concerned, and we have to cover the tax points also. So what we have to write? Provisions we have understood, but what we have to write, we are going to check that. Okay. So under Income Tax Act, HUF will be treated as a separate entity. Same tax slabs like individual shall be applicable to HUF. Then ancestral property is there and income is earned. It will be always better to transfer it to HUF because income earned out of that property shall be exempted. Understood? That means if individual is there and HUF is there, he has transferred the property, then from HUF also that limit will be exempted. We can transfer the money received on sale of ancestral property to HUF, no problem. Income from HUF, it can be invested also in various instruments. Then existence of property or multi-member is not a prerequisite. What is a prerequisite of HUF? Family is a prerequisite of a HUF and membership is by birth. So HUF is taxable as separate person, hence first 2.5 lakh will be exempted. Apart from 2.5 lakh, it has ATC deduction also. So extra 1.5 lakh deduction is also available. Okay. This was your HUF. Okay. Let's go to the next question. Now, the next one. B is a sole proprietor of BN Metals. Business of companies to manufacture parts of boiler used in turnkey power projects. Previous year turnover was 348 crores. B is now participating in big tender having cost estimate of 145 crores. Sometimes, no guys, they give you rubbish information which is not useful for your answer. Just stick to what is asked. Okay. However, as per tender, B is qualified to submit, but in view of consultant, form of business should be a company or LLP. So, explain limitations of sole proprietor. So, what is the question? You have to explain limitation of sole proprietor, that's it. The other part is not relevant. So, first, management skill, resources, liability and continuity. Straightforward questions. Okay. After that, Pratik has studied about mass farming and is keen in uniting farmers in various states and form MSCS. So brief Pratik on documentary required for formation of MSCS and authority with whom we have to file. So we have to ensure give them full details how to form MSCS and also the authority. Okay, that is Central Registrar of Cooperative Society. So I hope you have understood all the questions. This was very straightforward. Now let's go and see what are the questions which you have to solve. Okay. The very first question. Babu Rao has cleared his MBA and wishes to be entrepreneur and is confused in choosing form of organization. Advise Babu Rao on aspect which should be considered before deciding the form. All the aspects which we saw in the starting of the session that we have to write. Okay. Second, Miss Lovely wants to start a partnership form of business but is confused what will be effective partnership is not registered. So we have to give effects of non-registration of the partnership firm. Very simple again. Rajkumar wants to start HUF. Advice relating to key points in formation of HUF and the deed. Again straightforward. What are MSCS? Types of MSCS? Mention types of partners. Agrawal want to start a partnership firm with 2 or more partners. Advise him with registration procedure. Again simple. Are partner liable personally in the partnership business? The answer is yes. What is liability of Karta in HUF? You know the answer. It's unlimited liability. Understood? So that's all guys with your chapter number 6. I hope you have understood.